match our expectations.
I think you got a point here. You know, just to reiterate, we've been talking all week, actually, before the consensus sort of rang the bell on CNBC, which is either a 25 basis points hike and a dovish call, or a pause and, hey, we got your back on inflation. If it keeps creeping up after we take the break, then we'll act. So that's where 100% consensus is between those 2 points. So obviously you have to look on the margin of what consensus is not baking in, and I think it's the dot plot. But Rand, there's something really weird. People don't know this, but the dot plot is actually calculated 2 weeks before every FOMC. And 2 weeks as of today was 1 day before SVB. And so there's a question now, and it's not unprecedented that they revise their dot plots in the interim. But the dot plots we might see might actually be stale by 2 weeks. And funny enough, 3 weeks ago, he was guiding to a 6% terminal rate. Remember that? So it's
very clearly,
is sort of
very clearly
coalescing the 3 weeks, and whether they actually huddled in their emergency meetings that we don't know about and revised their dot plot. I hope they did. Otherwise, we might actually see a dot plot that is 5.5 to 6% terminal rate. And I tell you, market is going to tank on that.
I mean, surely, given the circumstances here, they would be smart enough to do that. I mean, I hope so. I can't imagine that they would come out with a 2 week old dot plot that is, you know, before the collapse of SVB Bank.
Yeah, I would say one thing that's been really noticeable in this crisis, and it's something that I'm sure the Fed has noticed, is that communication is almost as important as the actual policy. Part of what happened to SVB, now SVB was previously SVB, is that it was only after the CFO said, like, everybody, you need to stay calm, that investors started to pull out money. Jerome Powell's been really, really tight on forward guidance, being really careful about what that communicates, knowing that the dot plots have signaled important things to markets. So if they've changed direction or are going to pause, I'm certain they're not going to leave like stale dot plots, particularly because I think everything else is so complicated and confusing. Like, basically the Fed is looking at 3 big buckets of activity: financial markets, labor markets, and inflation. Inflation, while it is slowing, there are still several portions, like ways that you can slice it, that are pretty rough. Like short run core PCE is higher, short run core services excluding housing is higher, year over year core services excluding housing is higher. A lot of things that are particularly sensitive to monetary supply and inflation are still going up. Labor markets are kind of mixed in that the job growth rate is still pretty high, but wages are starting to slow. And then financial markets are, you know, all over the place. It's really uncertain. Like First Republic Bank has basically become like GameStop. It's like up 50%, down 50% every quarter. So I don't think that the dot plots, if they're released, will be inconsistent with whatever decision the Fed makes today. The 25 basis points is probably the most likely. If I were the Fed, I would pause entirely, but sort of not how they generally do things. But regardless of that, what I do expect is that whatever the rate hikes are, they will be very consistent with whatever the communication is, both in the presser and in the dot plots.
Okay, and what do you expect? What are you expecting? Are you expecting 25 or are you expecting 0?
I would recommend 0, but I think it'll be 25 because the Fed is still, historically, it's been more. They've if you look at the minutes and like the communication and all of that, they've been felt really, really burned by the fact that they like missed transitory inflation. And historically, like central reserve bankers and so on tend to be much more worried about like inflationary concerns than they are sort of immediate financial like economic activity. I'm just worried about what happened in the Great Recession, is where we kept on hiking rates way too late into it and people thought everything was fine. So I think they will go only to 25 basis points, but I would have asked them to pause because I think things are too uncertain.
So I spoke to a friend of mine who's a banker in the States, and he said, you know, the one thing that you got to remember is that the Fed is actually not looking for financial stability. That's not part of their mandate. it's an unspoken part of their mandate, but their mandate is unemployment or employment and inflation. And he says, look, if you're banking on the fact that the Fed ain't going to increase or is going to go light on the increases because of the banking collapse, he says, think again. He says that's not part of what their mandate is, even though it's an unspoken part of their mandate, which is obviously the responsible thing. It's not a spoken part of their mandate. And as a result, it is, he says, he's banking on a 25 basis point rate hike and actually quite a hawkish Fed.
Yeah, I mean, I think the sort of dovish argument would be that like this, even if the bank panic has subsided, this is going to have like huge effects on lending conditions and credit conditions that are flowing into the system already, and that will have downstream effects on inflation. But of course, like you can't see that right now, so the Fed has to make a lot of predictions based on a lot of uncertain data.
Sorry, go ahead. Let me quickly read out a few quotes for you, Rand. Just gonna highlight your point of how everyone is split. So I'm gonna read out a few quotes. Philip Mary from U.S. strategist at Rabobank. If the FOMC now aborts its mission to stamp out inflation from the system, it loses credibility as an inflation fighter, and long-run inflation expectations are likely to become unanchored. But you've got at the same time the chief economist at Goldman Sachs. We see considerable uncertainty about the Fed's path in March and beyond. It is hard to be too confident at this point, but he expects a pause in March. So I've got a whole bunch of them here. I'll read them out throughout the space, but it's just almost 50-50 split.
It's a 50-50 split, Mario, but I think one important point, and to speak to what you guys are speaking to, and I see Mike McGlone in the audience, and he's the best person probably on the planet to talk about this. And
yeah, Mike, we've sent you an invite.
Right.
Just let me let Mike know. Mike, we've sent you an invite via message, Mike, so you got to accept it from there. I'll send it to you again now. But go ahead.
Yeah,
sorry.
I mean, Mike has made the point countless times, more times than I can remember, that all forces right now on commodities, which is he's the head of at Bloomberg, are deflationary. Everyone's talking about what the Fed should do right now, and you can't look back, but we all know that the Fed always overshoots massively in both directions. They have a 100% hit rate of being wrong, and they've already likely overshot and should have already started cutting or stopping the hawkish rate cycle in the past. We shouldn't even be talking about rate rises right now. I would much rather have Mike speak about this, to be quite frank. But the fact is they've already overshot. Every single indicator that Mike will tell you about will tell you that every indicator is crashing and that deflation is actually the bigger issue.
Well, good news. Mike's here. Hello. Mike, we're going to hand it over to you.
Thank you.
Yeah, how are you,
sir? Hear me okay? I was listening and caught your voices, but you can't miss that Scott Melker voice. Man, so appreciate it. Now, that's the key thing, I think, what's happening right now. In the macro, we're facing what I see as a tilt towards a depression. And that's based on the simple facts that ECB and the Fed are still hiking, despite vast majority of the forward-looking indicators are not falling, they're collapsing. So we can start with banking crisis. What's the main issue for the banking crisis? We have reserve assets that are declining rapidly. And assets, why? Because the Fed was hiking. Okay, well, that's a problem. And we have commodities collapsing. They're down on a year-over-year basis. The Bloomberg Commodity Index is down 22% about that. The Fed, going back to 1960, has never tightened in that environment. They either stopped tightening or started easing. And it's the macro is, those are the key things. And looking forward, I see just doing the simple math of producer price index. When that prints on July 13th, it's going to measure June from the peak in commodities. It's going to be negative. And that there's precedent for that. The last time and the most extreme ever was July 2009. It was down 6.9%. So of a year-over-year measure, it's going to show deflation. So to me, this is the macro. Everything's tilting downward, yet they're still focusing on inflation numbers that are completely lagging. So that's in the macro. Just the fact we're talking about tightening means this is an example of academics falling behind people who actually understand running money. Now, there's some hedge funds that are going to make a lot of money on this, but this is part of accelerating the pain. And I'd like to say it less bluntly, but I have to warn people that this is pretty bad, I think. So the key thing I'm worried about today is we've had a significant bounce in the number one asset on the planet that matters, and that's the stock market. The S&P 500 is above 4,000. And even our equity strategist who's spot on, Gina Martin Adams, says 5% T-bills are a big headwind for stock market. So if it starts turning downward, which I expect it to stay downward from 4,000 to head to 3,000, that, like a rug pull for the whole tide. But the cool thing is, it's shocking, it's impressive to me that Bitcoin is showing that divergent strength. It's showing inflection to equities, and it's showing it's trading more like gold and long bonds. And I think at this time next year, when we're speaking, we're going to be talking about enduring deflation, and that's just normal part of long and variable lags from the greatest, most aggressive rate hike schedule on a global basis ever.
Mike, why do you think Bitcoin's running? Like you said, you were quite surprised. I think there are other people that are surprised. I want to say that we know that when Bitcoin runs, it runs very fast. I'm starting to get phone calls from the friends and family that only come out into the Bitcoin market when the Bitcoin price starts running. It's starting to feel like that part of the season again. Why do you think that we're starting to get a run on Bitcoin?
I think if you keep saying the same thing, you'll eventually be right. And I've been talking about this inflection point for a while, and I just had to wait for it to show that key point. It had to break above that 25,000. It did. And the macro to me is significant. The Bitcoin was born of the last financial crisis, and this financial crisis is defining its value. Now we see, if you're a money manager on a global basis, you're seeing, okay, well, I've kind of got risk in banks unless someone backs it up. Well, that's a problem. Even if I'm holding dollar assets, they might be fractional reserves, and you have stable coins and crypto dollars that are fully reserved. Now, they're not perfect, but to me, this is a defining moment for this technology. And then I look at the macro of Bitcoin. It has low adoption and increasing adoption and definable diminishing supply. Now, last year when people were talking about the commodity super cycle, I said, yeah, we'll look to Bitcoin. Yes, it's had its correction. I think people are realizing the super cycle is happening in Bitcoin, and this crisis may define it. So there's a lot of macro reasons. I fully expect it's still going to come under pressure. If I'm right, the stock market does have a major down move, but I think bids are more likely to be showing up in Bitcoin and offers more likely showing up in equities. And this is just the tilt. It's the bank crisis now. And the key thing I like to point out about the bank crisis is it's early days. It's only been 1 year since the first Fed rate hike. It was actually last week. And long and variable lags have barely started. I mean, I just look at the rollover in the housing market. It's happening quicker than it did in 2006, 7, and 8. I look at the rollover in commodities quicker, the rollover in unleaded gas demand. And that stuff to me is we didn't have that stuff back in 2000. We didn't have Bitcoin. To me, this is part of that defining moment where the world is seeing, okay, these people like me, 10 years ago when I thought it was silly internet money, every day that goes by, you realize nothing breaks this. It's just another one of those 1,000 cuts that it's surviving.
So you agree that there is some kind of banking crisis, because Janet Yellen is denying the fact that there's a banking crisis.
But she's a vested.
And I'm trying.
Well, Go ahead. But here's the key thing about people in those kind of positions. They can't be fear mongers. We have to take what they say as a grain of salt and say, she can't say there's a banking crisis. The Fed can't come out today and probably say that, although they should, because it will cause panic. But the facts from people like me to analyze and say, there is clearly the beginning of a banking crisis based on just what you saw with interest rates going up that fast, risk assets declining. The key thing is banking crisis is a tree in the forest. FTX was a tree in the forest. Celsius, they're all trees in the forest of declining assets that are going down fast. But the thing with banking is the stuff that I've always been buying the last few years is treasury bonds and things. They've gone down a lot, but they are at the point where their reserves are supposed to not be marked to market, or they're having to sell. And it's just getting started. I mean, I can't see how this is just the tip of the iceberg when you see what's happening to risk assets. So the key thing I like to point out, that really got me started bearish on this, is when they started this hiking cycle, the U.S. stock market was the most expensive ever versus GDP. It was the most expensive ever versus global equities. It was the most expensive ever versus U.S. housing market. It's just starting to roll over. And now we have people like boomers, when they saw 5% on 2-year notes and thinking, okay, in 2 years, I'm getting 10%. Give me that trade. To me, that was the inflection point. And it's just getting, to pull your money out of the bank, give me a T-bill and say, thank you, goodbye. Why should I take the risk of fractional reserves in any other bank except the strongest in the planet? And to me, this is just getting started. Now, of course, this potential they're going to back up all deposits is just showing how bad it might be. I don't want to be a fearmonger, but I have to. If I see a storm coming and I don't warn people, then I'm remiss. And I'm just warning this storm is just getting started.
Whoa, scary stuff, man. Scary stuff. Neely, I see you got your hand up.
Yeah, I was just going to pivot a little bit back to the basics, and I think this really speaks to what Mike is talking about. I did pin something up in the nest because it has a link for anyone who's following along and they want to get a little bit more Fed literate, as it were. About 4 times a year, you have the Fed does something called the Summary of Economic Projections with the SEP. And Rand, this is what you were talking about earlier with the dot plot. The dot plot is one of the components of this SEP. So you can, through that link, you can actually go see what we last said in December if anyone wants to go and quickly compare all these changes. But some of the things the Fed is committed to doing, and this is where I think this is the interesting tension, is they give their updates on what they think, GDP, unemployment rate, PCE, core PCE are some of the key elements that we obsess about all the time here on these FinTwit spaces. But even going further into the document, you'll see that they vote. It's kind of like back in school when everybody had their head down and you had to make secret votes around who wants to vote for what. They actually do a head count on voting on different matters like, hey, how much uncertainty do you have in this GDP estimate that you just made? Or how much uncertainty do you have, or what do you think the risks are to GDP growth, et cetera? And so just some context around what is going to come out. It isn't just about the statement or just waiting to hear whether or not Papa J. Powell talks about, the job to be done, right? Or sufficiently restrictive or some of these terms that we obsess about. It's also about these numbers that will be released as well. So I just want to give a heads up to that before I head out to my meetings, but peace out. Love what you're doing here, Mario.
Awesome. Okay. Great point. Scott, are you still here?
Yeah, I'm here.
Yeah. If one of you can try and bring up Leia Halpern, we're trying to get her up, but on my spaces I can't see her. So I wonder if anybody can.
I'll sort it out. I'll sort it out.
Yeah. Henrik,
go ahead.
Go. Scotty, go.
I was just going to say that interesting. I know that Mike was in the audience yesterday when you and I hosted Saylor, and kind of he addressed this exact same questions. That was the first question that I asked him about why Bitcoin was running. And I found it very interesting that even he, obviously, who's arguably the biggest cheerleader for the entire space, said that his view is that Bitcoin is rising right now from liquidity on altcoins and stable coins. And I said anecdotally, and as you even know from last weekend, I hit you up and said, hey, what are your thoughts on USDC, right? And I moved a lot of my USDC when I saw the banking crisis happening right into Bitcoin, right? Of course, I'm a Bitcoiner, but I do think that the beginning of this move is a reaction to the banking crisis, but within the crypto community. And anyone can go back and listen to the 24 points that he offered for 30 minutes and rattled off. But I do think that now it really is starting to cross into the mainstream. And I'm even anecdotally starting to hear my Wall Street friends talking about it again. Maybe I should just buy a little Bitcoin. They all bank with Silicon Valley or First Republic, right? Every single one. And I think that people are starting to move into that. I mean, I know that doesn't have much to do with what's going to happen in 1 hour with FOMC, but there's very few places to hide right now, and I think that's the most compelling point about it is regardless of what the Fed says today, where do you want to be for the next 6 months or a year that you can actually opt out of this dog and pony show of obsessing over what this one man is going to say, and then we'll forget about it by tomorrow, and then it'll be CPI, PBE, come up with any 3 letters that you like, that we'll obsess over a day later. And I think people are really starting to open their eyes and say, well, at least I can buy this. And Mike, to you, it was funny. I don't know if it was this Monday, I think, but Dave Weisberger, when Mike and Dave and I were speaking on Monday, said, listen, if Bitcoin didn't exist, gold would be $2,500 today. And I thought that was the most compelling point.
Brian, can I follow up on that, or you got something on that?
Yeah, go ahead, guys.
So I have to reiterate and compliment what Scott said, because that's the connection I have once. I don't talk with customers anymore, but a lot of times I get the question. So one of the smartest guys I know in the business, retired hedge fund type guy. He calls me up in December and says, Mike, what's this GBTC thing? So that reiterates what I think the hot money's seen in the world. They said they've seen this 80% correction. I had to mention that today because as of now, this GBTC Grayscale Bitcoin Trust is up 100% in a year. Now that maybe is a good sign of a good resistance, but this attracted the hot money who are just doing what some of us, you figured out a long time ago, it's nothing kills this. So to me, that's the inflection point. And that's what's happening in the macro. And I just, the question is how much we're going to have bumps in this road, because this is the inflection I think we're looking for. Like Scott mentioned, when you attract those type of people, you know that they're trading the hot money. And I know he's been hedging some of it, but it's just and the key things like this litigation is already starting to tip against the SEC. Now there's precedent for this. This happened in Canada. That's how we got the Canada ETFs. They worked it out in courts, and they were able to launch them in Canada. It's just happening here. It's a little more litigious here. So I don't know what else to add to that other than that this is really a Bitcoin story. And if this pans out the way I think it should, it's gold, Bitcoin, and long bonds may rule this year.
Oh, Wahid, I want to ask you a quick question. Are you there, Wahid? Well, seems everyone's dropping out. Kobasi, how are you?
Hey guys, how's it going?
Good, mate. Good. We see Twitter Spaces are glitching. I see a bunch of speakers dropping. Don't worry, Ron. I'll sort it out in the background. But Kobasi, would love your take. Yeah, go ahead, man.
I see we've also got Heinrich in the crowd here. He's got a very good thesis about how high this market's actually going to go. So maybe let Kobasi go up and then Heinrich as well.
Yeah. So you guys talking about rates? I kind of just jumped in here. You guys talking about rates or Bitcoin or?
What do you? No, it's mainly what do you expect to see in the FOMC meeting today? Yeah. And how do you see? Actually, the question, I'm going to pivot the question something a bit more about, focus more on the markets. How do you think the markets will react to a hawkish stance versus a dovish stance?
I mean, I think it's pretty. I think the definition of hawkish and dovish has changed a lot. I think we're calling for a 25 bips hike, which is in line with consensus, generally speaking. And I mean, I don't know. I think that we've been on these spaces for the last couple of weeks with the collapse of the banking system, and I think people are just discounting that the Fed really does think that everything is under control. The FDIC, they really think the system is sound. I mean, I don't think we're on the verge of a broader collapse. I think the regional banking system is still in turmoil, but I think the Fed's going to be more hawkish than most people are expecting. And I do think we're going to see at least, including today, 2 more 25 basis point rate hikes this year. As far as how the market reacts, I mean,
Before you answer, before you talk about the markets, and I know we're going to Heinrich next, but the question is, are you worried, and Wahid is back up, so we'll go after Heinrich, we'll go to Wahid, but aren't you worried about more things breaking? It's like the Fed keeps increasing interest rates until things break. Well, things are broken. How can we still be hawkish when we already have bits and pieces of the system broken? We've got a top 15 bank down, we've got Credit Suisse down, and we've got a whole bunch of other smaller ones.
Well, I think number one, the problem is that the regulators haven't handled this crisis correctly. We've kind of been going back and forth with Bill Ackman. I know he's been tweeting about this too. That the FDIC needs to just temporarily back all U.S. deposits. That's the only way to fix this. And the reason why we think they have to be hawkish is because the inflation is still a problem. I mean, we have 6% inflation. Even if we have disinflation, it's still a problem. And if you're going to start cutting rates or just taking a dovish stance, then inflation is going to start rising again. You have supply side factors. So it's not as black and white. It's not just like saying, we had some regional banks fall. Now the Fed can just lower rates again and we're in the clear. This is a multifaceted issue, which.
So you think the Fed should keep fighting inflation while the FDIC is there to back up the system to make sure it doesn't break further. So it should work together for us to fight inflation while not jeopardizing.
That's right. And the crisis is contained to regional banks right now. I mean, it's entirely contained. The large banks are not feeling anything from this crisis. If anything, they're benefiting from consolidation. And, a temporary back, and I'm not saying that we need to have a 6% Fed's fund rate like we were expecting 2 weeks ago, but I think we're going to see a couple more rate hikes at the minimum, and I don't think we're going to start cutting rates by 100 bips like the current Fed futures are pricing in by the end of the year. And I just think that, I've been saying this since the regional banks collapse started. Markets they're really giving a lot of credit to an immediate Fed pivot right now when it's not even clear that that number one, the whole system is collapsing, which we don't think that's the case. And number two, I mean, the Fed really does think everything is kind of under control based on all their statements they've been saying. So in that case, I don't really think an immediate pivot is that urgent.
What do you think about the ECB decision? Last question, Kobayashi. ECB decision, does that give you any indication of what the Fed could do next? I mean, usually the Fed doesn't follow the ECB, but it's a hint.
Yeah, I mean, the ECB hiked 50 bips. They were adamant about, the Europe inflation picture is a whole different story, but I mean, that's in line with what we're saying. I just don't see any of these central banks just immediately saying we're going right back down to 2% rates within a year. I think that's going to be even more detrimental in the long term when you look at inflation entrenchment within wages and throughout the economy.
Correct me if I'm wrong, but is there any possibility that the Fed increases rates in March only to reduce rates in May? Like, it just sounds. That is a full admission of a mistake, I think. Like, if the Fed increases interest rates in March only to decrease interest rates in May, which is, by the way, what the market's saying. It's saying that the Fed's going to increase rates in March to decrease them 2 meetings from now. So not May, but the July or the June meeting. The June meeting. It just sounds crazy to me.
Yeah, and
maybe I'm wrong, but
that's what my point about it's not going to just be a rapid cut rates overnight type of thing. I think we're going to start. It's going to come with a pause before rate cuts start coming. And that pause could be all the way until July. That could be till September. There's still a lot of data that's needed. And it's really not a entire system-wide banking crisis right now. It's pretty contained. If the FDIC comes out and backs all deposits, which we've been calling for the last 10 days, immediately, without even, and everyone's saying, how are you going to pay for this? Immediately, once you have the full faith of the U.S. Treasury behind the banking system, the bank runs are going to stop. I mean, this is just a product of human behavior. You calm people down, panic goes away, and then we're right back to what we were dealing with before, is dealing with inflation. And we can even put in some new, regulations or rules to avoid this kind of bank run situation happening again.
We have Henrik. Are you with us?
Yes, I am with you. Hi, guys.
How are you feeling about this? Because you had what did you call it? A Goldilocks scenario. What did you call the scenario that we were speaking about?
The Goldilocks scenario, the Goldilocks phase. That's when you have an economy that is not in recession, inflation is coming down, and that's what we see right now. And that's why you have and liquidity starting coming into the system again, not just from the Fed. It's been coming into the system from central banks around the world, from Japanese, from China, over the last many months, and now it's really picking up, and that has been forecasted from what we see from Asia, and now it comes to the Fed, and it's not a surprise, and that's why you see Bitcoin go first, and then you see risk asset, and then you'll see altcoins go later.
Okay, so how does this play out? What happens next? Just like walk me through. The Fed continues to increase?
No, first of all, we pay way too, I say this every time, we will pay way too much attention to what the Fed does, because the Fed just follows the market. And we saw that we had a huge decline in the 2-year, and that will tell us that we were at the end of it. First of all, I think the Fed, if they could today, they would do zero, but they would know that would actually scare the market. And that's why they're going to come out and say 0.25. Because they say, it's all in control. And actually at this point, it doesn't matter with the kind of liquidity that they were adding into the market. So whether they do 0.25 today, it doesn't matter. So the liquidity is coming in, but the economy hasn't rolled into the recession yet. The banks are now safe. We had all the fear in the market, and now the markets are going to rally now like nothing we have seen anyone in a long time, I would say, because you got liquidity coming in like a tsunami now, and you actually have an economy that is okay strong still. It is I still have the deflationary buzz coming later this year, but for now, we're not there.
So go ahead, Mario.
Go ahead, man. No, I'm just going to read out a few more quotes, and a bit of information is coming in now from the team, but I'll let you finish off and I'll go through them.
Yeah, all good. It's all yours. Mike's yours.
Yeah, so I'm going to read out, the team did send me some breaking news and then they deleted it. So I'm like, is it true? Is it not true? So I'm waiting for them to send it again. But I'll read out a few more. We've got here. Chair Powell said that the US central banks was prepared to increase the pace of rate hikes, and that the ultimate level of interest rates is likely to be higher than previously anticipated. I'm sure that this is dated.
Yeah,
let me go.
That's Mary. That's the speech from 3 weeks ago. That's
exactly. What I'm trying to see. I think I mixed up two sheets. One of them is outdated, one of them new. So let me get the team to clean it up, and I'll get back to you with a few more close. But Wahid, I want to ask you a question. If the Fed comes in a bit more hawkish, how do you think markets will react? Because there's two ways of looking at it. One way of looking at it is like, hey, maybe things are not as bad as we think. The system is not breaking, and they're still fighting inflation. But the other way of looking at it is like, the Fed doesn't give a shit. We're going to help.
No. I don't think. I see a lot of this discussion, in the press. Oh, the Fed doesn't want us to think that we're missing something. Maybe they know something we don't. I think the world has finally come to the grips that they don't know more than we do. And I'm not saying this arrogant. I'm saying this: markets have had a perfect track record vis-a-vis the Fed for the last 40 years. And as the previous, as Henrik just said, you just follow the 2-year, and it says it all. And so if the Fed is more hawkish, then basically that is a mispricing of the yield curve, looking at the back half of the year. And I think the market will have a very bad reaction. They're not going to say, hey, the Fed knows more than we do, because they know the Fed doesn't know anything. Okay, and I'm not saying this tongue in cheek. That's point number one. Point number two, he's probably very happy with what's already being discounted. Otherwise, he would have had, the Fed whisper, Nick Timirios leaked, and that hasn't happened because obviously they've been in a quiet period. I think if they continue on a path of 25 per meeting, i.e., maintain a certain trajectory, things will continue to break. Because on the margin, the Fed doesn't really have that many tools to help the FDIC. I've done a lot of work on that in the past week. I asked the whole crew here if the Fed could actually loan to the FDIC. It turns out not to be the case. And so they could do a little bit of patchwork with guaranteeing deposits for the next year or two. But ultimately, this is going to go to Congress. And in the face of a debt ceiling fight, I just don't think that's going to happen. And that's another thing. That's a very big catalyst looming in June, July, that I do not think the Fed wants to rock the boat in front of. So I really think the Fed will have plenty in the discussions today that they're going to wait and see. They'll do 25, and then they're going to actually take a break, and they should.
What do you think happens to the markets, and what do you think happens to Bitcoin? Bitcoin's now 28,580, and the markets, the Nasdaq is at 4,000.
So Ryan, let me just take a step back. Okay, if we had the news that we had today in any other environment, okay, pre-QE, pre all the money printing, etc., bank failures and unhinging of the system, deposit flight from small to big banks, war in Ukraine, Taiwan, you name it, the market would not be where it is today. Bitcoin would not be where it is today. There's a reason why markets are where they are, and it goes back to the whole thesis I've been keeping talking about: structural inflation and the need to hold these risk assets. Because, and just to reiterate for anyone who's not heard my boring spiel, you cannot fight through 330 trillion of sovereign debt globally, 180 trillion of corporate and consumer debt, and 220 trillion of unfunded pension liabilities without some structural inflation. And so that's my next point. If the Fed and the ECB jawbone that 2% is the holy grail, and by hook or by crook, they're going to keep raising rates till they get to that 2%, and not take a break and not let the system reset or normalize or take a chill pill, if they're going to keep jawboning, the market is not going to digest that, because you cannot keep raising rates in this over-leveraged world. And I think the markets acknowledge that, Ran, which is why Bitcoin, gold, silver, and markets in general are staying so resilient, if not going up. Because I think the world is finally discounting the fact that we have structural inflation. We need the structural inflation because the economy is too levered.
Can I jump in on this?
Please.
Sure.
I have to disagree. I don't think we're seeing structural inflation here. I mean, we would be in a completely different place with gold and commodities and what we've seen. We've seen a spike in inflation because of an artificial situation after Corona, where we had the administration, we had the Federal Reserve coming out and doing a stimulation of an economy that was in a supply crisis. So this was all artificially created, and this was, a mistake. What we see now is inflation is coming down strongly, and that it's been doing that ever since June of last year, and we are.
Before you continue about inflation coming down strongly, just for the audience as well, can you very, very briefly explain what structural inflation means?
Well, as I see it, structural inflation is that when we have an economy that is starting to move up, where the economy actually moves up as a part of the economy doing better. So it's a different kind of economy there. It's a demand-driven inflation.
So it's like, would you feel like a fundamental change in inflation based on supply and demand?
Yes,
based on supply and demand,
and also based on the regime that the economy is in. So you've had all this debt for many years that's been pushing down on it, and that's going to change at some point, and we're going to see, as was said, structural inflation starting to pick up.
And what you're saying is that this is not structural inflation. No. This is the what happened during COVID. We've got the geopolitics that's happening in Ukraine that's causing the inflation we're going through now, which is not structural, and these are temporary events.
For me, structural inflation also has a very nuanced definition, which is that we're moving to a regime of 3 to 4%.
Yeah, but I think if you look at a housing market and you look at the normal lead of the housing market on rates, you will see that rates are coming to all-time lows at within a year or two. So I think that is that's not really founded in what we have seen early on. We're not at that point yet, and I do think we need to get to that next point where the Fed and central banks around the world is going to go one more time to get throw everything at the fire when we get that deflationary bust. Because right now we're talking about too much inflation. There's actually the inflation is what we see in the CPI numbers coming out. They are lacking 3 to 4 months. So what we see actually, if you look behind the hood, and there's a truthflation.com, you can take a look at that, and they actually do a pretty good analysis of that, and you actually see that the right kind of inflation we have at this point is down to 4%. So there is a difference because in that, and in terms that the inflation is lacking. So I think, and the Fed knows this, actually also going into the financial crisis, we saw inflation was even going up while the Fed was cutting, and also first of all pausing and then cutting at a later stage while inflation was going up. So they do know that there are other factors than just inflation. They don't just sit and wait for CPI numbers. They look at also, as I said, at the 2-year, they look at the housing starts, they look at all the leading indicators, the lagging indicators as well, coincident indicators. And what we see right now is that the leading indicators are, coming down with like nothing we've ever seen before. And that is going to create the crisis 6 to 9 months from now. But for now, they are not going to hike for a long time. Why would they? They're not in this business to destroy the world or destroy the economy. They want to do a soft landing and they want to fight inflation. But they can definitely see now with the things that are going on in the world that this is coming to a stop. So 25% today, 0.25 will be because they have to. Because otherwise they would really show that they have been scared by what they've seen, but that's it. And then we got you got a pause, and he will probably hint that today. Market may think 0.25 it may go down some today or tomorrow maybe, and then it's going to say okay. But he also said going to be a pause now, and I think it's going to react rather positively to that. And then also taking in the effect the liquidity is coming into the market right now. This is whatever they call it. It is QE. It is liquidity coming into the system, and it's going to spur one final, hurrah on the stock markets, on equities, and the like. And the technical setups are just, extraordinary bullish, I would say.
I see we've got Vinny in the audience. Vinny, you've been calling for a 25 basis point rate hike for quite a while. What are you thinking tonight?
I'm sticking with it. I think it's going to be 25. I don't think Powell can't do anything. I mean, if he cuts, he has to resign, literally. So there's no way he's cutting. Doing zero I give it a small chance. I think there's a better chance of 0 than 50. Obviously, some people are calling for 50. I think 25 is the crowd pleaser for the Fed. I think it's going to get. I think everyone on the Fed committee will probably be okay with 25. Very few will be happy with any other option at this point. And I think he does go in with a hawkish undertone. And I do think he says, "Look, we're gonna pause after this, and then wag his finger as usual." That's kind of where I'm leaning at the moment on balance. But
do you think
he's 80%?
Do you think he's going to pause, or he's going to say we're going to be data driven and we're going to wait for the data?
No. I think he's going to signal that we're going to pause for an extended period of time to say basically don't discount cuts later this year. It's going to be higher. It's going to be at this level for longer. Maybe not much higher, but this is roughly the level we think is restrictive for the economy. But we are not anticipating any cuts for the rest of the year. I think he's going to make it clear to the market that it shouldn't start pricing in cuts in Q3 or Q4 because for lots of reasons, political and otherwise, projecting cuts in is going to counteract the inflation that he's trying to fight. So he has to threaten that it could go higher, but he's going to have to at least say, look, we're going to pause, but not go lower for sure.
Yeah, agree with Vinny. Vinny, I'm so happy you're here because I've had your voice stuck in my head for the last few days from a previous chat we had, and it's nice to hear the consistency. And the reason it was stuck in my head is because what you just said there and what you had said previously is exactly how I led the show. 25 bips, and this firm speaking to that will continue to raise rates if we have to. And it's great to hear your voice, one, and to hear that you're consistent with that message. I'm
Douglas, let me get a quick market update. Wahid, are you with us?
Yeah, sure. Go ahead.
How are the markets looking?
So equity markets were up, 10, 20 basis points. Now they've sort of fizzled. The S&P is hawking around the 4,000 level, plus or minus. A lot of derivatives trading, bouncing that back and forth. Bond markets, it's a lot has been spoken. 3 weeks ago we were, discounting 6% terminal rate. We're now at 5 and change. The 2-year is 20, 25 basis points either side of 4%. The move index, which is the volatility of the bond market, is. I mean, let me give a stat. We've never had this volatility in interest rates. In I think 200. I mean, like since they've ever recorded them. So we've had record move volatility, and so that says a lot. That's basically there's a lot of uncertainty on interest rates because of the Fed position versus what the market is discounting, which is disinflationary forces. If they keep doing what they're doing, and that they need to start cutting unless or else the market would implode. We've had a record amount of inversion, but in the last 2 weeks, we've had a very dramatic steepening of the curve, which usually happens right before a recession. So you always have a very, very inverted curve, but like 2-3 months right before a recession starts, you get this knee-jerk steepening, and that usually is the alarm bell that we're just about starting a recession. So that's what the markets are
just make sure we're clear with this. Do you guys agree that even if a recession starts, unless inflation goes down, they're not cutting rates to fix the recessionary problem? They'd rather have the economy slow down or contract a bit to get inflation under control than cut rates into a recession and cause inflation to spike. And Powell's been very clear about this. If you cut too early, you're gonna have hyperinflation in the 70s, or at least high inflation in the 70s. He's not going to do it. So I don't. This recession thing is kind of weird because the Fed's saying we don't really care. We're trying to create a recession, and we're not going to cut rates into the recession. Everyone seems to think that, and the market's pricing. I think the market's mispricing the situation right now. I'm just from a market perspective. I think Bitcoin's going to tank down. I think all the risk on assets is going to tank down after the speech today because I just don't think that I think everyone's getting a little ahead of themselves, and the bond market's not always right. I mean, we had a situation with interest rates, I think 2 weeks ago, where literally went from a 5 handle to a 3 handle in 24 hours. You've never seen that happen before, ever. I think it was the 2 year. It's crazy. Like, I don't see how the market is so bullish right now.
Well, that's because the Fed keeps jawboning, or had been 3 weeks ago, and the market was trying to tell it something else. Actually, the bond market was right, Vinny. You look 4 or 5 weeks ago, the bond market was saying you're harping on a policy error. Then he jawbones the shit out of the markets 3 weeks ago. The markets readjust, but buy and hold, the markets were again right.
But the market is pricing in what should happen, not what Powell's going to do. That's the mistake here.
Why wouldn't you be bullish at this point where the economy is actually adding jobs and you actually have inflation coming down, and it's coming down rather strongly, and you now have liquidity coming into the market?
Do you think, and we can add Henrik's point, but are you worried about it? But is anyone worried about contagion? Because that was the whole narrative just less than a week ago.
Not when you have the bazooka, not when you're printing money left, right, and
exactly.
You can plug every
exactly.
Agreed.
Yeah,
agreed. The contagion risks aren't there. I mean, they've already shown they're willing to backstop. The FDIC's got some issues, but the Fed has got a balance sheet. Look, guys, the Fed could double its balance sheet right now, and yes, there'll be crazy amounts of inflation, and the system won't collapse. I think when you go more than 2x past this point, then it does. So I think they've got some breathing room.
But you're not getting inflation just from printing money. Let's just get that out first. You're not getting, but that's why. I'm not. Okay.
We're not. Here's the point of contention here. Powell is not. Look, there's a political player, and he cannot be seen to be backing off the rhetoric that he's had for the past year and a half.
No, but he already did with the QE that they launched now, so we can see right through that. But the thing is, you're not going to get this about saying we're going to get inflation because if they start to print money, or even if they were starting to, if they did a rate cut, they're not. And you can see Japan has been the example of that. They've been, printing like nothing else we've seen. They are up, I don't know how many times since the 1990s or 1980s actually, and you're not getting that. And that's a misunderstanding about inflation. Inflation comes when you have an economy that thrives. And when the business cycle starts to turn over like it does right now, I mean, it's topping out now. There's no doubt about it because you got the rates now starting to come down, the market rates. And that means that the business cycle has turned the cycle or turned the corner. You're not going to get inflation, but you're going to get a deflationary environment. And the problem is you've got so much debt in the world that this is what the Fed is really worried about. And I can tell you that they will know, and they know already. That's why China and Japan already started this some months ago. They can see the deflationary environment now starting to approach again. So I think it is too narrow-minded to say, yeah, we're going to get inflation because if they print, because they're not.
Henrik, I'm not disagreeing with you. We're arguing about different points
All right.
here. If you look historically, Powell has always made the incorrect move just about at every single turn. So why do you think he's going to make the correct move at this turn?
I haven't seen him make the incorrect every turn. I don't believe that.
Well, he was late. He was late to raise rates. They called inflation transitory. They raised it too quickly.
Yeah.
They basically collapsed the bond market. And
no, they did.
So let me Charles. Sorry, guys. Charles Gasparino just a minute ago tweeted, breaking on First Republic, bankers involved describe its balance sheet as problematic and difficult to sell without a government backstop. As I was reported yesterday, bankers looking at a possible AIG insurance type deal with government taking warrants in exchange for capital to stabilize. That just came out 2 minutes ago.
Super.
Okay.
I think
So one other point I'll make quickly is that the inflation target of 2% does seem unrealistic, and I agree with Faith about that. And it needs to be raised, probably. Are they going to do it? Probably not. But targeting 2% is insane, and 3% is probably a good resting point at this point to try and get down to. And just like at the current rates of interest, first of all, Powell said he wants to get real rates positive across the board. He's trying to get there. He's not going to get there without raising rates today, so he knows that. He's going to raise. Inflation's got to come down a little bit more, and even when it comes down, he cannot just drop rates straight away because of the rebound effect that they've seen in the 70s. So I don't know how, Hendrik, I don't know how you play that out because Do you want it like the moment inflation goes below to the target, you want them to just drop?
But I need to emphasize this again. Inflation follows the market cycle. Leading indicators are declining like nothing we've ever seen before. Incident indicators follows that. That means the unemployment will start to rise soon, and I think we've seen the bottom in the employment in the unemployment number. So we've seen the bottom there. I think they'll start to come up, and they can do that for a certain amount of time before they start to deteriorate the economy. But you have to the market rates, the rates on the economy, inflation, they are lagging indicators. They come later. So this that you see, but you actually. You're talking about this, that we have high inflation right now because you see those in the numbers. That's not correct. You do not have high inflation right now. Actually, I would suggest that you see, and you saw some of the numbers also coming out from Europe, just a few weeks ago. It does not look good. And I can tell you it's coming down with vengeance right now. So they are not too worried right now at this point about inflation being too high. They know that the business cycle is turning. They think they can soft land it, and they do not want to scare the market by, they don't want to cut, obviously. But they do observe this also, and they do observe the housing market, decline that we have seen. The NAHB is looking terribly. And we got a complete setup that looks like what we had before the Great Recession. Or the financial crisis, I mean. So I think there's paying too much attention to something that will absolutely come down over the next coming months. You see oil is down. You see commodities, lumber and the likes are coming down like strongly. So I think we're looking in the rear mirror right now in terms of looking at where the inflation, where it was, if you just follow the CPI numbers, absolutely, then we are looking in the rear mirror. So they know that, the Fed knows that, and they will try to soften. They think, okay, we can maybe just get it down to 2%, and we don't want to scare the market. But the inflation is not that big a problem anymore. In 6 months, you'll have absolutely different kind of headlines. I can tell you.
I think the big difference. I think those are great points, but I think the big difference between and us is, the U.S. is that. The Japanese don't have the world's reserve currency, whereas the United States does, and I think that puts us in very
your mic,
position.
your mic isn't great. I'm not sure why.
Oh, I'm sorry. It's because I'm at the airport. I'm about to go I'm at GDC Gamer Developer Conference.
Yeah, all good. Yeah, it's better now. It's a bit better now. Yeah, all good. Yeah,
awesome.
Go ahead.
Yeah,
You were saying?
I'm about to board my flight to the East Coast, but I have a lot of thoughts on the Gamer Developer Conference. By the way, AI is really hot here, and a lot of thoughts on AI. But on the inflation debate. Japan does not have the world reserve currency the way the U.S. does. So I think that gives us very, very different, the United States, very different sort of tools to handle that. And of all of the evils that the Fed is facing, having modest inflation, while, it does punish the middle class, might end up being sort of the Pareto optimal strategy, right? In the game theory that JP is playing. And I agree with Vinny that I think JP is not well regarded by the financial community, just because he has been, really behind the ball in a lot of ways. In many ways, it's hard to be in his position because he's stuck between a rock and a hard place. But I do think modest inflation ends up being the, sort of the best strategy out. And I think that's, something to consider. I will say just, real quick before I head my flight to the East Coast, that the Gamer Developer Conference is, back with a vengeance. And I would say the most interesting thing is that AI is absolutely the most interesting sort of theme here. So I know this is not on topic to the FOMC, but just so that folks are aware, just on the ground, there's a lot of excitement. Game developers are really excited, and AI is absolutely the most talked about thing. So don't want to distract from that, but wanted to at least report on that on the ground here in San Francisco.
May I just comment on that? Because if you do not have the world's reserve currency and you start printing money, the risk of creating inflation is not lower, but bigger than if you have the reserve currency. So that's actually a counter argument to what was said here. Because if, for instance, here I live in a small country, Denmark, I can promise you, if we start to print money tomorrow, and then say, okay, we're going to finance things with that, like just to make an example to what we said about Japan, we would have runaway inflation here. So that's not an argument for that. I mean, actually, that would be the opposite. So that's just a comment on what was just said.
The interesting question. I brought this up before, but the Swiss Central Bank is now backstopping the UBS, but the Swiss Central Bank, the SNB, has had one of the worst years last year, right? They had the biggest losses ever in Q2 2022, and their balance sheet is less than $1 trillion, which, by the way, is less than the assets of UBS. And people here talk about how banks are black boxes, right? Just normal banks, but even national, central banks are black boxes. They have less, like for example, Swiss Central Bank has so much less operating room than JP and the Fed do because of the fact that this question is going to be about interest rate differentials, right? So where's the U.S. interest rate going to be relative to Denmark's or the Swiss? It's going to be one way or another, but it's almost like the past models we've relied upon are not reliable in many ways. But I'd love to hear your feedback as to.
Yeah, and I've got another quick question as well. I'm going to add to Eugene's question, and we do have another guest that will be joining us in about 5 to 10 minutes, and then we've got. How far is the FOMC meeting, Ran? How long do we have? Ran, anyone? Ran is off his mic.
The decision comes in 20 minutes.
20 minutes, cool.
20 minutes, and then
I've got a question for Wahid and Kobeissi. I've got a question for you guys then. So there's a statement by the Bank of England. It says the following. That was in a letter to the Treasury Committee 5 minutes ago. Came out, no, a bit more, 7 minutes ago. There are still channels through which stress in the global banking system could affect UK economic conditions. So it kind of leads me to the previous question I had. And I want to ask you again, just get more opinions on this. Is there concerns of a contagion? Because I spent days covering the story, and most people, I'd say maybe 60-70% of analysts shared those concerns mildly or had serious concerns in some cases. Is this just over? Like after Credit Suisse, it seems that things kind of quieted down. Now we saw the news with First Republic and the potential bailout, but beyond that, is the worst over? Are you on that page, Kobeissi?
I mean, I think it's clear that governments and regulators around Europe and the U.S. have made it clear that if things do get bad enough, they're going to step in and stop things, backstop maybe the whole system. So I think that has put a lot of fear, removed a lot of the fear from the markets. I don't think that's over for regional banks. I still think that they're in a bad situation right now, and I still think the backstop does need to be put in place. But as far as the whole system collapsing and what everyone was expecting and kind of panicking about a week ago, I don't think that's the situation anymore.
You're on that page as well, do you agree? Wahid? Whoever was jumping.
I think it's Ran. I think that the reason why there's no more risk of a bank run is because the Fed have practically told people that there's no chance of a bank run because we're going to backstop deposits. So for as long as they're going to backstop deposits, no one has an incentive to run for the bank and get their money out. But if there are cracks that maybe the Fed won't backstop certain depositors, then I think that we get into a completely new paradigm. But for now, there's no risk of a bank run, which is why I think the Fed has got the margin to raise rates again today.
Yeah, I think in Europe,
right into what we were saying too, is that the system in their eyes is not as fragile as everyone thinks it is right now, and they know that they do have the backstop of the Treasury if they need it. So I still think inflation is their primary focus, and it's definitely not a collapse of the whole banking system. So that
let me get, before you jump in, Douglas, I want to get the audience. The audience has been a bit quiet today compared to usual. Where do you stand? What do you expect of the meeting in about 15-20 minutes? And what's your stance on crypto? I want to see how many people from the crypto community are in the space. And whether you're bullish, and that's the next question I have after Douglas speaks. And Michael Green, by the way, I know you're in the audience. I'd love you if you can come up as well, just to balance out the discussion since we are referring to crypto. But Douglas, love to get your thoughts. I want to go to Ryan and other speakers on crypto in general. There's been a narrative that the bull market is back, the worst is over. I think I can't remember who it is. Gaurav came to me a few days ago, Ryan. He's like, Mario, there's the oracle of crypto, I'm not good with names, said that the bull market is fucking back or something along those lines. And I want to see if you agree with that statement.
The real oracle is Vinny Lingham, and he's here. I mean, the real oracle is Vinny, and Vinny's in the crowd. Vinny, do you think the bull market's back?
Thanks, Ron. I think it's back once we get over 31,000, 32,000. I always
why have you chosen such a random number, 31,000?
Before you answer, Vinny, just before you answer, I would just want to welcome Jay as well to the stage. He accepted to come in. So a special guest number 3. We'll give him the mic in a bit. Jay, you just came in literally as we started speaking about crypto. So it's coincidental. Don't get annoyed. But yeah, Vinny, I'd love you to answer, and then we'll go to Jay to get
I'm not going to be able to talk a lot, but go ahead.
Oh, good. Vinny, go ahead.
I think this is also a good time to just tell everyone, listen, a lot of effort has been put into getting these speakers. It's not coincidental. They're not just jumping on and off. A lot of time has been spent recruiting them and actually getting the best speakers here. So if you're not already following all the speakers, this is probably a good time to just quickly follow the speakers that you're not following, because this is probably where you're going to get your alpha from. Vinny, I'm handing it back to you, bro.
Yeah, Ron. So I think, thanks. While we're below 30,000 psychologically, we're still in the 20s. And I think, confidence tends to return at these, like, when you change from 20 to 30, for example. So just above 30, I'd be more comfortable. A lot of people think it's 28.5, but there's a lot of resistance there, as we've seen. And so I use it a bit of like, there's no exact science to it. I look at a whole bunch of charts. I look at some technical analysis.
Ryan, your mic. Ryan, your mic. Yeah, go ahead, Vinny.
And I look at the technical analysis across a couple of traders that I trust, and it looks like 31 would be the point where I'd say just go all in at that point, on a bull run happening. But Ron, the other thing is, you look at the Bitcoin dominance is approaching 50%. You and I.
That was my next question. That was my next question. Is this run different, Vinny? Is this the only run that we have where it's only Bitcoin and the altcoins never follow, or is this like pretty normal?
No, this is normal. But what's happening is, I think the funds flow. So crypto, what people don't really appreciate, they think about it. Crypto is like trickle down economics, right? In a sense, money flows into Bitcoin and Ethereum at the top, and then the people who have been in it for a while diversify. You don't find institutions and family offices and people who are new to crypto who are buying Bitcoin, Ethereum. They don't go and spread their bets into the altcoins. That's the existing ecosystem people doing that. And so that's how the money flows, right? So if a billion in net buyers comes into the market, most of it goes into Bitcoin, and then people like you, me, whoever else have had the stuff for years, we sell, we go buy other coins to increase our portfolio size. But the money, in the event of like the global financial crisis, people worrying about money, inflation, or people are going to be buying Bitcoin probably 80-90%, maybe 10% Ethereum, and that's the new money coming in. But then the rest trickles down into the ecosystem. I think Bitcoin dominance stays above 50% at some point.
I want to go to Jay. Jay, how are you? I know you don't have much time to speak. Sorry, I just want to jump quickly to Jay. Good, man, good. What's your stance? What do you expect in the meeting in 15 minutes? How do you think markets will react?
So, I mean, the main thing is the reaction is not going to be, in my opinion, you're going to have a knee-jerk reaction at 2, and then you're going to have a bigger reaction at the press conference at 2:30. The actual decision is going to be less important than what Powell actually says. So whether it's 0, whether it's 25, that's really not going to make much of a difference in the existing state of the economy. The tightening has happened, and it's going to slow down the economy, and lending is going to slow down. What I want to say is, the larger banks have a lot of liquidity. They put about, I think yesterday, they put $2.28 trillion in the reverse repo. I got to run like 2 seconds. I'll be back. But there is an insane amount of liquidity at the big banks. And I do think that it makes sense for, once this banking system is stabilized, I think the smartest thing to do is going to be, to do a couple raises and then stop. It looks like the small, PacWest, from what I understand, and this is public information, they were trying to do an equity raise last night. They went to a couple of private equity guys, and the private equity guys said, we're going to bid you much lower than the current stock price. So PacWest freaked out, and they went to this asset financing as well. They lost $20 billion of their deposits. Now, deposit outflows have stabilized, but my view is that over the next several months, you're going to see more and more money coming out of the small banks and going into the big banks. That's why you saw this reverse repo spike. The big banks don't know what to do with all the money. So what is going to result from this is that the small banks do like 70% of the lending to commercial real estate and small businesses. And that lending is going to dry up, and it's going to slowly cut at the real economy. And the Fed has no way of tracking this in real time. So I would not be surprised if, even if you do get 25, you get some sort of language, even if the language is like, we're monitoring the banking system, right? And you could get some whipsaw reaction. You could get one sharp move in about 10 minutes and then another sharp move from 2:30 to 3:30. So I got to run, but we'll come back. We'll come back in a bit. Thanks.
Great point.
Thanks, Jay. Thanks. But I've got Gareth on stage, by the way, everyone. Yep. Yeah,
I see that. So it's a good time to get Gareth on because there's 11 minutes to go before we get the knee-jerk reaction, which is just the press, the pack and the decision. And then after that, half an hour later, takes the market about half an hour to process that, and half an hour later, Powell starts his press conference. By the way, we will be streaming the press conference live here with you guys. So it will be live. We will be streaming it, so you don't have to tune out and tune in. We'll stream it, and we'll probably take the first couple of questions. But Gareth, 11 minutes to go. Just want to put you in the picture. Bitcoin's at 28,500. The S&P is at 4,000, give or take. Nasdaq 12,800, give or take. I'm talking about the futures. What do you think happens today?
Hey, thanks for having me on. And, so I'm in the camp, as the last gentleman was saying, where the likely result is going to be 25 basis points. The key is going to be the language, right? So it's that press conference where I expect Jerome Powell to kind of throw at least a little bit of an olive branch out and just say, hey, we're monitoring the banking situation. We're ready to do what's needed to quell any sort of bank runs that could start up again or anything like that. I think they're still going to say, hey, listen, we're going to still be harsh on inflation. They have to be, right? They still have to be vigilant on inflation, but they're going to leave the door open to make that monetary policy adjust slightly, whether it's another 25 basis point after that, or they're going to pause to just make sure that they don't create. The last thing the Fed wants to do here is create more fear, right? They want to kind of calm the banking situation down at this stage. So that would be my expectation, is for them to at least extend an olive branch and make the markets feel a little bit more secure about what's going on with Credit Suisse having been bought out by UBS, and obviously Silicon Valley Bank and those other banks that have failed. In terms of market reaction, that's a bigger question, right? I mean, here we have a situation where we've seen Bitcoin and tech stocks rally because the banks have been selling. We've seen this money flow leaving the banks. So the question that I have, and I honestly don't know the answer to this, is if Powell helps the banks catch a bid, does it come at the detriment of something like a Bitcoin, gold, and the tech stocks? And again, I honestly don't know the answer to that. It's something I'm watching really closely over the next 10, 15 minutes, and then with the press conference.
Do you think that Powell mentions the banking collapse? Do you think that he acknowledges it? Or do you think that it's not his business? And the reason why I ask if it's not his business, technically the Fed has two mandates, which is unemployment and inflation. That's pretty much what the Fed is looking at. And then they have the unspoken mandate, which is financial stability. So as I mentioned earlier, we imagine that the Fed has no business talking about the banking sector. The question is, if Jerome Powell does, do you think he acknowledges it or not?
I do think he at least mentions it a couple times, and again, we could play a drinking game with how many times he does see it and see how drunk we get. But basically, I do think he has to think about the bigger picture of the economy, right? Because if the banking collapse continues, and we've seen banks before the deposits were guaranteed and everything, there was an issue of whether or not the employees could get paid. I mean, certain things that really do affect unemployment and the stability of the economy. So I actually think this banking crisis has helped the Fed. Weirdly enough, it's probably has slowed the economy even a little bit more and potentially raising unemployment a little bit. So it's kind of going along the lines of what they want, which is a very weird concept to think about, that in a weird way this worked into the hand of the Fed to slow things down a little bit. But I do think that they do mention it, and I do think it is a key piece of what's going on. And honestly, if they didn't mention it at all, that would make me a little uncomfortable. Like, you need to acknowledge the elephant in the room here a little bit.
I know you're a degen, absolute degen. So are you in long or short? So I'm going to ask you long or short. Just give me an answer, long or short, into the FOMC. So Bitcoin, long or short?
Slightly short, ever so slightly short Bitcoin.
All right, so 28,500, slightly short. Gold, long or short?
Neutral. I took my positions off gold a couple days ago when it was at its high, and just waiting around. I think gold could pull back a little bit more, and then I'm a buyer of gold. S&P 500, I'm slightly short, and I'm more short tech stocks in specific. Nvidia, Tesla right now. I'm short those tech stocks right now as they've just had a monster run.
Okay, so net you're short, and gold you're neutral, but otherwise everything else you're short.
Yes, correct.
All right, that's good. Vinny, I want to ask you the same questions. We've got 5 minutes before the decision. Are you going into this long or short Bitcoin?
I'm short. I think the Bitcoin, look, I think the downside right now is much bigger than the upside on an asymmetric basis. So I think we could see Bitcoin retest down, 25K-ish levels.
And I take it that if you're short Bitcoin, you're short everything else as well.
No, not necessarily, because because the dominance rose in Bitcoin, and the alts didn't really rise with it. And so, if this is not a good session for, if the Fed doesn't, if the Fed tanks the markets and you go risk off on crypto as well, I think Bitcoin just tanks faster because it's had the run up without the rest of the crypto economy supporting it from a dominance perspective. So I think Bitcoin's overstressed right now in the short term. That said, I think Bitcoin will probably be up significantly by end of the year. But for this particular meeting, I'm expecting it to drop.
Okay, I'm going to pin a tweet onto the spaces now, which is what I think is going to happen. It's a tweet which someone hand wrote actually, and it basically says it's going to go down and then go back up, and that's exactly what I think. I think it's at 28,500 now. I think it goes down to 27,500, and then over the course of today and tomorrow, it goes straight back up again. Yeah, I think that's what happens. Kabisi, I want to hear your views, long or short into FOMC, because if everyone's short, then the market's going to do the exact opposite.
I think the initial reaction is going to be pretty muted, and then I think Powell's going to come out and be more hawkish than people are expecting. So I think futures are going to end lower after it's all said and done.
Wow. Okay, everyone's negative.
Before Michael goes on, I want to while you ask the panelists, I want to go through the audience members. Tell me, bottom right corner in that purple circle, let us know where you stand. Are you long or short? Are you bullish or bearish on the markets? In the meantime, we've got 4 minutes before the decision is made, another 30 minutes before the conference. I think it is 34 minutes. So make sure you share the space, you reclout the space, panelists as well, tweet, reclout. Let's prepare for the decision. Ryan, I'll give you the mic while I go through the comments.
Yeah, so look, this is probably a good time to just mention that we've got 3 minutes left for the decision. Just two things, housekeeping. If you're not following the speakers, again, just give them some love. They are here giving up their time. They're all very highly curated. Also, this is a sponsored space. So this is one of our sponsored spaces. It's brought to you by NordVPN. We always encourage people who are surfing, specifically in crypto, if you want to mask your IP address, which is very, very, very important, use NordVPN. So we have pinned a NordVPN tweet, which gives you like a 50% discount on using NordVPN. Use the link, give them some love, because they enable us to bring you these amazing spaces. And these spaces take a long time to put together. It's curating the speakers, reaching out to them, et cetera, et cetera. So give us some love, give them some love. We have 2.5 minutes left.
The comments, Mike, everyone in the I don't get it. The panelists are bearish. The audience is bullish. I'm going through the comments. Bullish, long, bullish. Barely anyone bearish. 1 or 2 bears. So yeah, go ahead, Mike. But the audience seems to be more bullish than the panel.
I don't know, maybe the audience is right. I'm going, as I said, down Bitcoin, straight back up, down to 27.5 and then straight back up. I think that's pretty much how I'm seeing it, unless Powell says something stupid. And
we're 2 minutes away from one of the most important FOMC meetings in a very, very long time. So it's pretty exciting day. And by the way, everyone, so the decision's in 2 minutes, and then we've got the conference in 32 minutes, which is really, really important.
We're gonna stream.
Many of us are gonna be reading, so don't call on us while we're reading.
Okay, no worries. We'll be streaming.
When you read, just let us know if you when you read, just let us know like if you're reading anything. Specifically, I'm looking at the dot plot. That dot plot is everything today. It really is. It's everything today. We got to look at what the Fed expects rates to do. That's really all we care about here. We care about How is the Fed seeing the rates going forward? That's it.
When does the dot plot come out? Exactly the same time as the decision?
No. 2 minutes. Well, it comes out in a pack, and it takes time. What I'm going to try and do, because we have a banter research group, and on that research group, people drop info. So I see some of our researchers here in the comments. Guys, if you could just be super active on the research group so that we can give the audience here the information. We have less than 60 seconds left till what I think is the most important FOMC rate decision that we've had in a long time. Right now, the probabilities, just in the last minute, the probabilities of a 50 basis point rate hike, I'm just waiting for my internet to refresh, 83.4% for 25 basis points, 16.6% for no interest rate hike at all. Bitcoin, 28,600. The NASDAQ is, hold on, let me just get my charts open in front of me. Okay, NASDAQ 51 points up. The Dow Jones 32,555. I'm talking about the futures here, not the spot. The S&P is at 4,000. It's always volatile. We've got 1 minute left, or less than 1 minute left. Couple of seconds left. I'm waiting for the decision to drop. I'm also watching some of the big accounts that I know drop the information first. One of them is a Tier 10. If you're not following Tier 10, TIER 10K. He's usually the first account to drop the news. I'm just sitting here and I'm refreshing.
25 basis points and 5% peak.
Okay, 25 basis point, 5% peak. That's what we got, which is a little bit higher than the market expected. Bitcoin just jumped to 28,750, 28,000. Bitcoin's about to 29,000. The S&P is pretty flat. So far the information that we have, and as the guys read through it, we will bring you the information live. 25 basis points. We're talking about a 5%. What they are saying is that there is a 5% peak interest rate, which is, that's pretty much what the market is telling us. I am watching the research group here. As soon as more stuff comes on the research group, I'll obviously share it with you guys. So we've got our 25 basis point, guys. It's that's pretty much where it is at the moment.
Everything looks flat so far.
Yeah, Bitcoin did have a spike.
I had a tiny spike, yeah.
Okay, they're saying the Fed says that some additional policy firming may be appropriate. That's one of the quotes that came out of it. The Fed median forecast shows rates at 5.1% before end of 23 and 4.3% before end 24. That is much more aggressive. That is much more aggressive than the market was expecting. So that should bring the market down. And that's why you're seeing Bitcoin come down now, 28,320, because the market was forecasting, I'll quickly read it to you. The market was forecasting a 5% terminal rate, but the market was also forecasting 3 cuts this year. And the Fed's telling you no cuts this year.
You're welcome.
The Fed's telling you no cuts. I guess Vinny was right again. That's why they call him Oracle. That is why they call the man the Oracle, because
the summary of the
it's exactly what I said early on. Like they're going to do 25 and no more for the rest of the year, but definitely no cuts. It's exactly what I said.
Okay, wait. There's more information. Wait, hold on, Vinny. There's more information. More information is that the Fed is adamant that 2% is still the target. Yep. So they are not relenting on 2% inflation. They're sticking to their guns. That is what we're getting so far. I am looking for more information. Of course, as soon as the information comes, I'll be breaking it here. So yeah.
And I'm looking at the dot plot, and the dot plot is there's definitely no cuts this year, like from what I'm seeing. The majority is at
the SP. So we got the SPX spike 25 points. Crypto is back down to where it was. The spike is short-lived.
Yeah, this is a much more bearish scenario than we thought. Not much more bearish, but I did say before that the market's being...
Powell's been saying higher for longer. Now he's gotten to the point where it's restrictive. And now he's going to say, we got the higher right. Now we're going to play out the longer. And that's it. He doesn't care about like what happens to inflation in the short term, etc. He doesn't care. He wants to make sure it goes down to 2%. It should be 3%, but he's a hard nose. So he's going to go down to 2% and we have to just wait it out.
I think this is exactly what I was.
Yes, exactly. We were about to say the same thing. Crazy. Sorry for cutting you off there, but It's exactly how the vast majority of us thought this would play out. And you're going to see in less than 30 minutes, generally speaking, I would think that Jerome Powell speaking is not going to be what people want to hear. It usually goes in that direction. The more he talks, the more he says, the more the markets don't like that. But there's the 25 basis points. There's the continual thought that inflation's top of mind. Never did I think that cuts would be happening this year. And he'll go meeting to meeting.
So we got a message from Name Redacted who's sending me a lot of information on this. The dollar sold off big. Just send me that message now. So I'll be reading out anything he sends me.
I think the Fed wants to, like Douglas is saying, I think he's spot on. The Fed wants to keep the door open. Inflation is still their top target. They're not worried about the banking system as much as markets might think they are. And I think that he's going to be more hawkish than expected in 30 minutes.
Yeah, he's going to toggle. So I think he's exactly right. He's going to be hawkish in his talk. Nobody's going to like it. That's pretty consistent with him. But to be able to now toggle between further hikes at 25 basis points and if shit gets weird, do nothing is a really sweet spot for him to be, because he can continue to say in any Fed speak that, we'll raise rates if we have to. I think it's maybe somewhat of a win that, there's no 50 basis point scenario at this point. And he's going to be able to continue to thread this needle here until such time as he can come out and say, we fucking dealt with inflation and we're marching our way back to this 2%. Yikes. 2%. Be interesting if it was 3%, but that's exactly what's going to happen here. I wouldn't be shocked. Who knows which way the day will end, but I wouldn't be shocked he starts running his mouth and the market goes south.
That's exactly what's going to happen, in my opinion.
Yeah, it always happens.
So yeah, the US dollar index has dropped a fair bit. You've got SPX continues to rally close to highs of the day. So we've got the conference. So the conference call will be in, just for the audience, we've got 25 minutes of conference call, which is really important to see what their stance will be.
It's the press. It's not a conference call. It's a press conference. Just a heads up. Yeah. If you're looking at the Dixie has just taken a major drop, which means that effectively the markets underestimated how much they were going to cut rates. The Dixie is now trading at 102.51.
That's
which
what
is
I said.
that's
the
a big
mispricing this move. Like the market got this wrong.
Yeah, I agree with you. It's the only way that I can see it, because to me it seems like the Fed is being more aggressive here. I mean, if I just read what's being dropped,
being consistent. No. They're being consistent. But Powell's moves have been telegraphed, 6-12 months in advance, and he's sticking to it. He's not changing his tone. He doesn't want a 1970s mess again. Like they're not moving off this.
So listen to the dot plot. The dot plot is 5% for the end of this year, 4.3% for the end of 2024, which means a very slow and long period of higher rates, and then 3.1% for the end of 2025. Now, I just want to give you some perspective. The market went into this, according to CME futures, believing that interest rates were going to be at 4.25% at the end of this year. The markets, the Fed's come back and said, no, we think it's going to be 5.1. And the market was expecting a 3.5% in 2024, mid-2024, and the dot plot is saying 4.3%, so higher at the end of 2024. This is a much more aggressive stance from the Fed than the market was anticipating. And yet, for some reason, I don't understand. The Bitcoin price is going up. The dollar is going down.
I mean, just hold on the Bitcoin stuff. I mean, there are lots of factors at play there. I'd wait until Powell opens his mouth. Then, and if people don't like what he's saying and the math doesn't check out and people think they'll call his bluff by buying Bitcoin in foreign countries. I mean, That's, but Bitcoin is not a US traded asset. It's a globally traded asset. And remember, it's priced in other currencies around the world. So, we've had this conversation before.
So just another thing worth noting, again, name redacted, says the following, worth note, and we have, just FYI, we have Robert Wolf that will be joining us any minute now. We're it's a pleasure to have him again. So he'll be joining any minute. In the meantime, name redacted sent me the following, worth noting on the space that this decision to hike 25 basis point was unanimous. And he says, I thought there might be a couple that wanted to pause. Wahid, what do you think? Oh no, hold on, he dropped out. Yeah, let me get Wahid up.
I mean, it was a crowd pleaser. Like I said, that was the crowd pleaser number.
Gareth.
Yeah. So one of the things I think we're not mentioning that's important is that the fact that the Fed is so united here sends a strong message about the security of the banks, right? So it could be that the markets are rallying on that backside, right? The fact that they're not saying, hey, we need to be very, careful here because the banks are close to collapsing. The fact that they're just like all unanimous 25 basis points is basically telling us that they're not concerned about the banking issues at all, which is a confidence builder for risk assets.
Robert, how are you?
I'm good. I'm sorry. I was just on TV, so I'm outside. I don't know if you can hear me or not.
If we can hear you perfectly fine. This is the time you say I told you so.
Well, I can't say. I wish I bet on it once in a while, but as I said, I don't day trade. But I mean, listen, I've been all along saying that inflation hits hardworking Americans every day, and monetary policy for the Fed is absolutely the number one priority right now. And if I've been more concerned, I think. I've told you, Mario, in your group, I was at 50 basis points after the last.
Sheldon, I'm not hearing you, bud.
Yeah, I'm also not hearing Sheldon, but I'm here.
Can you hear me?
No, Robert. Yeah, no, we can hear you. We can hear Robert. I think.
Can you hear me, guys?
I don't know why.
There we go. It's better. We can hear you, brother.
Ron, hold on. Ron. Hold on.
So where are we?
Oh, okay. Yeah, sorry, hold on.
Into the interest rate decision today. Just
can you
to
hear?
show you guys where we were and where we are now. When we went into the interest rate decision today.
All right, what's happening?
The market thought that we were going to get one rate hike today.
Okay.
One more rate hike in May, and then a decrease in June, nothing in July, a decrease in September, nothing in November.
Ron,
1 second.
Yeah, Ron, can you hear me? Okay. Yeah, so I think he's not speaking to us. Ron, you gotta mute your mic. Ron, you gotta mute your mic. All right, so I'm not sure what's happening. Yeah, Robert, sorry, you were speaking. Ron had a hot mic. Ron dropped out. Robert dropped out now. Space is glitching. While I get Robert back up, Wahid, jump in. I'll fix that, Robert.
Yeah. I didn't catch any of the comments, but I was paying attention to the press release. Look, I think the message was actually pretty dovish, right? He was hedging all over. He was trying to give everyone what they wanted to hear, the politicians, retail, everything, right? So he basically used language he's never used before. He said firm up, and maybe firm up. It might warrant it. Things could be unstable in financial conditions, but maybe not. So everything was super hedged. I think we might actually get a Greenspan-like, very opaque conference call where he basically says, look, let me just do my 25 basis points. And honestly, guys, let me just wait and see, and let's pivot to hawkish or dovish, depending on what the data shows and what the market conditions show.
I mean, I disagree with that. I would just tell you, I disagree with that. I think he's been clear, and I've said all along, when they say something, listen to it. They moved the Fed funds rate for year end to 5.13. That is at least another quarter of a point. They also moved the rates for year end 24 higher than it was in the past. So that means you may have slower cuts. And he was very clear that he said that there's a hot labor market. I think he's being clear. There's at least another 25 basis points. I said last week I thought there would be 3 hikes in a row. But I think with core CPI showing an increase month on month, and the labor market, including the participation rate, showing some real strength, I actually think we're at least another quarter basis point.
Another quarter basis point for me is dovish. I mean, I'm looking at a 6% terminal rate 3 weeks ago. I'm measuring versus that.
Yeah, I think people were between 5 and 6. I mean, I think 6% was the high, 5% was the low. I was probably closer to you at 6% than 5% as well. I think I think we're going to probably be mid-ranged in between.
So, question: have you ever seen a hedge press release like that? I mean, they always
His first one, when he came out of the box dovish and then he turned hawkish and then went 50 basis points. I think that, listen, he didn't want to hit himself at all with respect to financial stability. So the way he framed it was, we're okay now. I think the way he spoke about tightening credits has for the most part everything to do with the recent financial stability as opposed to just rising rates. Listen, I think he kind of threaded the needle on this one. I think that 2 days ago 50% of the market or more was at zero. So I think the idea that it was unanimous in raising rates tells you that inflation is still 1, 2, and 3. I'm sorry, I missed your comments before.
And my question is just to remind the audience, the press briefing in 15 minutes. What are we looking for? Why is that so important?
Well, I think the most important thing, and I'm not sure he'll answer it, but I think people will ask him about deposits. I don't know if he'll answer it, but people are going to want to know what he's saying on a flight on deposits, because that will really give you a sign on where he is with respect to financial stability. I'm not sure he'll answer it, but I think that's in some ways going to be more important. I think he already told everyone where he is from an inflation basis. He didn't really say anything about banks. I don't even think he used the word banks.
Let me read out, Ron, let me just quickly read out. I've got messages from our panelists, Eugene and name redacted. I'll read out exactly what they said. So Eugene says the following: options, calls, puts on 10-year treasuries largely flat from before and after 25 basis points announced today. However, context is that last 1.5 weeks have already been very high volume and therefore higher option prices in fixed income markets. Name redacted says S&P 500 has rolled over and given all gains back. All that matters is a press conference in 15 or now 14, 15 minutes. So again, just for the audience, that press conference is to many panelists even more important than the decision. Go ahead, Ron.
I think that the market misread it initially. I think that this is a very negative FOMC press release. I'm not sure why the dollar has taken such a sharp move down, and how the S&P is still at 4,000. You're talking about the market was pricing in 3 rate cuts this year, and the Fed has basically told them, guys, not only is there not going to be any more rate cuts, there's another rate. Expect another rate increase sometime this year, and no rate cuts this year. And the market was expecting a much higher rate, much more aggressive rate cutting next year. And the Fed has basically told them, you can price in 2 to 3 rate cuts of 25 basis points the whole year. That's pretty much what the Fed has said here.
But he's telling, but isn't he telling that the economy is okay? I mean, let's not look at this. Is not just about liquidity. This is also about understanding that the Fed looks at the economy and they say it actually looks good, and that's why the market then starts to react in a positive way.
Yeah, they're saying that the economy looks very good. I guess the big thing that we can look out for, is, does Powell mention the banking collapse or anything to do with the banks in his talk? If he does, then we're off to the horses.
Why are people thinking he's not going to? I mean, financial regulation and financial stability and bank regulation is under his purview. Of course he's going to talk about it. They're responsible.
He's definitely going to talk about it. That wasn't my point. My point is someone's going to ask about deposits, and how he answers that will be the telling sign on what's happened over the last 48 hours, right? We know what happened Friday when there was 30 billion injection in First Republic. Didn't seem to solve anything. We know what happened over the weekend with Credit Suisse. We know the markets have been volatile. But we know Schwab announced they got a big deposit influx. but we really haven't heard anything of general deposits with regionals. And my guess is that's where people are going to ask questions, because they're going to want to know, is this problem fixed, or are we still seeing a run on the weaker banks?
Douglas? And by
it
the
will
way,
be interesting if he answers that.
Yeah, man, just before I jump in, Douglas, also want to just give a welcome to Michael Green back on stage. But Douglas, jump in.
Oh, Michael Green's here. We should listen to him and not me. So I'll make it quick. Yeah, it's interesting. You know, the market kind of gave back that bump to reconcile the hawkishness of the notes there. And if you think, I just think when he starts running his mouth here, he's going to emphasize those points even more. I think he will talk about the banking system to some degree. The focus will be on inflation. The more he can focus on inflation, the more he can feel justified in having that additional rate hike coming our way. It makes sense to me that the Dow's flat, the S&P faded there back to pretty much flat. Kind of shocking is I was watching tech more than anything else. Tesla came out of that feeling hot and now just retreated. Nvidia just crushing it today. But that's my commentary. If you thought that little fade was deserving, just wait till he starts talking in just a little bit. Typically, it does not lead to a positive close. But
just Douglas, do you want to remind the audience on why that press briefing, the press conference in 11 minutes is so important?
Because he's going to elaborate on the decisions that have been made here. And I think he's going to continue to focus on the threading of the needle he needs to do. He's got to leave that door open on his inflation narrative. Closing the door to rate hikes and certainly not, cutting rates. Closing that door would have made for a completely different outcome today than leaving it open a bit. He's going to get what he wants here, and I think he's going to talk up his points in a very similar way to the last times he's engaged in the conference, and we're about to find out.
Michael, I'd love your thoughts on the decision as we wait for the conference in 10 minutes. Would love your take, and thanks for joining us.
Sure. I mean, you guys are all talking about markets that I guess I wouldn't really be following right now because they're all secondary reactions. If I look at the euro dollar market, it's very clearly said that this was the end of the rate hiking cycle, and you see cuts being further priced in. That's why the dollar is tanking, et cetera. It looks like, the new move to 25 is the market's basically saying, okay, he's finished. He had to do this, exactly as many of us have been saying. The majority of us have been saying that he had to signal it. We do have to wait and see what comes out of the press conference, but it does feel like the downgrade to GDP expectations that you see in the expectations for 2024 is what the market is really keying off of, and basically suggesting with this hike, they probably accelerated that slowdown and made it significantly worse, would be my interpretation of what the market is saying. If you look at the Russell 2000, which is bank heavy, and the KRE, they're both down. If you look at the duration sensitive names in the NASDAQ, they're performing better than you would expect. I mean, I don't know. To me, this feels very much like the market said, yes, you walked into the trap. Thank you very much. We'll play again another time.
Wahid?
Hold on one second. I'm on the phone.
No problem at all.
Just look at the 2-year yield. I mean, I'm looking at the US 2-year Treasury yield. I'll quickly just give it to the ticker symbol for anyone who's following is US02Y. It has just come down. Let me just quickly get the actual number. It is down to it's back up to 4.058, but it went down to 3.95. That's a crazy dip. You don't expect the 2-year to do that. The market is telling you the Fed's bluffing. Not bluffing, but the Fed's wrong here.
So, hey guys, sorry, I'm back. What was the question, Mario?
Yeah, all good.
Yeah, I caught what Rand just said. So, I agree. I think the market is going to jawbone, and the Fed will try to jawbone. I think we're going to get a crescendo. I think the market is saying we cannot handle higher rates. And
And that's what Michael was hinting towards that as well. That the markets, he's not referring to the secondary markets. Looking at the euro and US dollar, it just shows that we're pretty much done, and we should start seeing a reversal. So would you consider this, Wahid? Would you consider this good news now?
Look.
Because I'm getting mixed messages even from the panel. Like on one side, it's more bearish than expected. On the other side, like, hey, they're bluffing. The worst is over.
I saw a much more sort of measured and opaque press release. I mean, I think he put enough hedges there for him to change his mind and monitor what's going on. I think the press release will echo that. I really do. I actually think the press release will be a little bit more dovish than we think. And everyone has sort of point of view of what should happen, and there is a way for Powell to make everyone happy by basically saying, look, here's our dot plot and we have an inflation mandate, but things can change, and but the deposit things scare us as well, and but this and but that. And ultimately I think we're going to get to the point where he is going to remain behind the curve, watch what the market discounts, and see how the economy progresses.
Let me read out what Ophir Gottlieb, who's a regular on the show, he sent me the following. This was a hawkish press release. The market was pricing in cuts this year, and the Fed reiterated higher rates, not just through 2023, but also 2024. A bullish reaction is simply the market, quote, disagreeing with the Fed, as it has done several times prior.
But cutting rates, if they signal that we're going to cut rates, it was because the economy will be in a bad place. So this is good news to the economy. This is good news. This is because the economy is strong. It's because the Fed expecting the economy to do well over the next coming months, and that's good.
And they're not worried about they're not worried about the banking contagion or more things breaking. Correct?
Exactly. That's why. So it's a positive bullet. It's a bullish signal. This.
I think the moment of truth happens in about 20 minutes. In 5 minutes, Powell's going to read the press conference, the press teaser, which we've pretty much already read. And then what we'll see is after that, the questions and answers. So probably we're more interested in the questions and answers.
So, yeah, and then this one thing, name redacted sent me. Bottom line is what Michael Green said. The Fed removed some hawkish language from the statement. So that's from name redacted. So again, I think we're all trying to we just don't have the conference. The press conference will give us the answer. By the way, Rand, you've got a hot mic. But the press conference will give us the answer. Let's see. Vinny, your thoughts on what language we can expect in the press conference?
I'm not changing my tone. He's going to go in there. He's going to be, he's going to leave the door open for another 25 and say, look, it's not certain, but there's possibly another one. And I think he's going to say, there's no cuts expected this year. So don't even think about it. And I guess the market's trying to second guess it, but he wants 2%. He, mission accomplished at 2%. That's his view, his worldview. He's not changing it. Now, something would have to seriously break for them to reconsider, and maybe something does. But I think he's gonna. I don't think he's gonna be as, maybe not as it'll be a hawkish undertone, but I don't think he's gonna be extremely hawkish. But he's just gonna make it very clear to the market to stop pricing in cuts this year. That was his goal.
Yeah, we're going to stream the press conference. It starts in about 4 minutes. Just so you guys know, I am watching it. I have got my eyes on it. I'm sitting here in the background. Right now, there's just the Fed music playing, and I don't think I should bore you with the Fed music. It sounds...
It's 47,000.
Yeah, it's very bad Fed music, but I will... As soon as it comes on, we will be live with the press conference. Yes, you won't have to leave the spaces.
Yep, Henrik dropped as well. I'll be bringing him up shortly. But okay, Gareth, so, any quick thoughts about?
I'm actually gonna drop. I'm gonna drop because I'm gonna go somewhere anyway. So I'll be listening on.
Yeah, all good, Vinny. Just send us feedback. Okay. Either jump back on, or just send us through via DMs and we can read it out in the space. Gareth, quick thoughts. We got 3 minutes before the conference starts. Cheers. Thanks, Vinny.
Yeah, I think at least for me, it's really now all coming down to this meeting, and we've seen the markets pull back off of their highs. So it was initial quick reaction to the upside, then kind of a retrace. Still trading up about 0.25% on the S&P, but again, 0.25% is not a big move. So I think for the most part, the Fed is trying to stay the course, trying to build trust in stability, and that they're going to be hawkish or at least keep rates elevated to get control of inflation. I think that for the most part, they wanted to show a united front considering the banking crisis right now, which is why you had the universal voting for the 25 basis point. And then really it's going to come down to the market trying to figure out, will the Fed, is this the Fed wavering even though they're saying rates will stay high for the next, 12 months, let's say, or is there room for them to kind of budge on that? And I think that's what we're going to get in this press conference.
Yeah, I'm pretty surprised that that was unanimous by the Fed. I would have at least imagined that you'd have some, it was absolutely unanimous, and that's quite unusual for a situation like this. So I guess that
I'm going to take the other side of that. If it had been not unanimous, that would have been an astonishing event. They had to present.
Why is that?
Front this time.
Okay.
Because they had to present a unified front. There was zero chance this was going to be a disputed move.
Yeah, I was agreeing with that. And in times of uncertainty, you don't want more uncertainty, right? So I really don't think they really had a unanimous decision. That's just what they're saying. I mean, they probably voted unanimously. Yeah, I think
that's absolutely right.
Right. I mean,
somebody has a few smashed fingers would be my guess.
Yeah, I'm still here. I'm watching.
Like, there's not actually a vote. So, just remember that. The only time you ever hear a dispute is not actually if there's a legitimate disagreement, it's scoring political points.
Yeah.
And Michael,
yeah.
Michael, just a quick question. And I think we've got seconds before the press conference starts. So Ryan, whenever it starts, just jump in, interrupt us, and
okay,
stream
so
it. Michael,
go
ahead.
Paul is coming up live now, so I'm gonna cross over to Paul. Just give me 1 second. Here we go. So we are getting an audio feed. It's just they're just waiting for Paul to come up, as far as I can see. I think the mics aren't on, so yeah, let's just. I just want to test my sound just to make sure it's coming through.
Play back here in 2050.
Yeah, it's working. Yeah, it should be working.
Just give it a test run. Can you play? Can you stream it? If there's any.
I can't stream it because there's no talking, but I can tell you that Paul's now walking up the podium. Hold on. I don't hear him, unfortunately. Oh, there we go. His papers are ruffling.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, so that's pretty standard. I think the next part of it is the press questions, and this is usually where it gets
Colby
pretty
Smith
juicy.
with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
That's the first time he's mentioned that he's not actually going to raise.
Can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick?
Good questions by Steve Leisman.
Nick Timmeros, the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermediate period pointed to stronger inflation.
Super interesting to see that Powell's not relenting. He's sticking to the speech. He's sticking to policy.
This latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves, if we can, we sat down and said, let's do this. And he was obviously going to lead it. So I don't, I get briefed on it, but I'm not involved in the work of it.
Howard.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times. The process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So it's maybe it's a feature, not a bug. But yeah, absolutely, absolutely the same. The story is intact. So it's really 3 parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's
so. We'll stay live with them for just a few more minutes, because I think we pretty much heard everything. We'll just give it the benefit of the doubt for maybe 1 or 2 more questions, and then we'll go back to our regular
attention
chat.
to the actual and expected effects from that.
Gina's scary. Every time she asks a question, the market collapses.
Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that, and then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Go to Mike.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized, and I really don't see that as at all analogous to this.
One other question: would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things. And we have responsibility for price stability. The Federal Reserve has responsibility for that. And nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic. And then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
This is a great question.
So
this is a great question.
13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements. But it seemed to be the right place. So with the FDIC, we're lending to the. In effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC. So there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
Thank you. Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Kyle.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer term securities. Large scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Katerina.
Hi, Chair. Katerina Saraiva with Bloomberg News.
Let's do this last question if you want.
The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates has gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations
Ron, we can start breaking.
Yeah,
we can start breaking it down. Yeah. I think what I'm going to do, Ron, is the team is actually listening as well. So what we're going to do for the audience is we're going to highlight key points because the conference is ongoing. I think Ron was saying in the background, like, guys, I don't think we should keep streaming it. They've said all the important stuff. But what I'll do is while we kind of analyze what was said so far, and Wahid seems to be pretty happy in the background. So we'll analyze. We'll have our panelists. We've got more panelists joining, analyzing what was said so far. I will jump in and mention, highlights from the ongoing conference. So you don't have to listen to everything. But Ron, do you wanna kick it off? What do you think?
Yeah, I mean, I'm glad to see that he started off talking about the banking collapse, because that was one of the big things. Would he actually acknowledge it? So good to see that he acknowledged it. But he was very, very, very adamant that it's a management concern and not actually a because the Fed is tightening rates. So a little bit disappointing there. I think he stuck his course. We're going to follow the data. We're going to increase. We're going to follow the data. We're going to assess the data as it comes out, as and when it comes out. So I think from that point of view also, I think just basically on script and unrelenting, and we're focused on our mission, and that's pretty much all it is. That's all I heard there. I don't know if anybody else got any other tidbits from there, but that's pretty much what I got.
Yeah, so I agree with you, Rand. So what you were referring to, Mario, is I was sending you messages, sending the team messages that, God, this is really, really dovish. So everything was going according to what I had sort of suggested, that he'd be opaque. He basically hinted to a pause. Look, we may raise, okay, whatever. Raising rates comes indirectly from the credit conditions. And so that was very dovish. What really turned was when someone specifically said, hey, what do you think of all those interest rate cuts that have been discounted? And he jawboned those out. And that was viewed as very hawkish. That was the turn in the conference call.
This is David Towell. I'd like to focus on a different piece of the conversation, which was Powell's denial of the Fed rate hikes having anything to do with the banks and just simply blaming it on mismanagement there, and then saying it's really limited in scope and there's really not much concern. And then also his response to the question about commercial real estate and that, the debt that's coming due in the maturity wall rings so clearly to me like his responses earlier on inflation, a year ago regarding its transitory nature. And this man is, he seems to have blinders on in terms of what his mission is, how he's going to do it. I understand he doesn't want to raise concern in the marketplace about those matters, but I don't think he's talking truth to those matters at all.
I fully agree with you there. I can't stress to you how much I agree with you. It's as if he brought this whole thing down to management issues and the bank growing too fast too quickly. And he completely ignored the fact that other banks are collapsing all around Silicon Valley Bank. And I was, I guess, super surprised there. I thought a little bit more honesty would probably be, I maybe expected a bit more honesty. Ophir, I see you've got your hand up.
Yeah, hi there. I think that I basically agree with everything that's been said. I think he was opaque and non-committal, and we can make an argument as to whether or not that was appropriately opaque and non-committal. But because he was, it's basically a tautology that all three camps are going to have something to lean on, right? So Dubs can say, well, gosh, there was a change in language. He did directly address the potential disinflationary pressure from the bank failures, right? As a second derivative effect from tighter credit, which they did not do in the press release. That sounds dovish, sounds like they're aware of something. You could also be dovish and say, hey, 5.1% is only one more hike. So there's something for the doves. Certainly there's something for the hawks. Higher end of year inflation target or forecast. No cuts for 2023. Smaller cuts for 2024. And then there's a sort of deeply concerned camp, which is neither dovish nor hawkish, which is he twice referenced idiosyncrasies of the Silicon Valley Bank failure. Certainly didn't, at least outwardly as I heard, and I think that's been confirmed from what you just said, he did not really address the fact that there is also a systemic risk, or at the very least, that some of the idiosyncratic risk from SVB was exacerbated by what the Fed is doing. And then he kind of didn't really care about commercial real estate. So I think there's something for everyone. I think everyone has to decide how they're investing, how they're trading. It's like, are you dovish, are you hawkish, or are you in the sort of concern/panic realm? I have a certain opinion, but I think that's what Powell did, and I think he had to be appropriately opaque and non-committal. I don't think he had a choice.
Robert?
Hi. Well, as someone who had the Fed sit outside their office for over 4 years, I actually think he was incredibly articulate. I'm not saying I agree with everything he said, but I think he was very clear on a few of his points, and that's what you want. That doesn't mean we have to agree. I certainly didn't agree with him when he said it was transitory. I didn't agree on QE 3 or 4. And I probably don't agree on a lot of other things he said. That being said, he started off by taking a bow with respect to financial stability. They believe they did a great job. They threaded the needle, and they have calmed the markets, and they don't view it systemic going forward, and they believe it's in check. We may disagree with that, but that's how he sees it. He also was clear that deposits are looking better. So that's one. He was equally clear that Silicon Valley Bank had a management problem. Actually, I would disagree with some of the people on the phone who said they didn't. I think they made a decision. Their equity went from 40 billion to 13 billion valuation in a year. Their deposits doubled from 100 plus billion to over 200 billion. And they extended their maturities to make money, going into things like mortgages that obviously in a rising rate environment, we know what happens. They extend and the prices go down. So they made bets and they were wrong. Thirdly, I don't know how more clear he has to say. Inflation was hotter than expected. The labor market was hotter than expected. He said it multiple times. So in my opinion, he's clear that inflation is 1, 2, and 3. Monetary policy is going to be used to stem inflation if needed. I certainly think they're going to do another hike. At the next meeting, at least 25 basis points. I think he was also clear that they don't expect any rate cuts on the back half of the year, which a lot of people are on the other side of that. I also think he was clear that to him, alongside with rate cuts, the tightening in credit because of the fragility of the banking system that may or may not have continued to take place will also steer direction. So in my opinion, it's once again clear they came in nervous about inflation and they leave nervous about inflation. I'm not saying I agree with a lot of his comments, but I will tell you he was clear in his statements. I don't think he was actually that opaque.
Do you mind? I was going to ask Wahid to give us he's dropped out. Someone can give us a market update. But go ahead, Ron.
Yeah, I'm on it. So when the results came out, or when the press release came out, I said to you, it doesn't make sense that the market's rallying when it was a very bearish set of minutes, a very bearish press release, because no rate cuts when people admitted that there were rate cuts. Sorry, there's someone that's not on mute. Maybe Rob, if you could just mute yourself. And so now what we're seeing is we saw Bitcoin come down from 28,500, 28,600, now 27,350. I'm looking at the Nasdaq. The Nasdaq's pretty flat. The Dow Jones about 0.5% up. The US 500, which is the S&P, just under 4,000. So not really much movement. The Dixie is at 102.5. And I was looking at the US 2-year Treasury yields, 4%, 3.975%. So all in all, I think Bitcoin was the one that responded the worst, and I did think it was getting ahead of itself. And that's why I said, as the results came out, I said the market's not reading this correctly. They are talking, the market's still celebrating this, but this is actually quite a hawkish set of results. So yeah, I expect over the next day or two, Bitcoin will probably climb back to 28,500. I mean, if everything else stays the same. So yeah, but I mean, for now, the market's pretty much pricing it right.
Naeem, anything to add before David jumps in?
Yeah, I just want to say, in my opinion, their press release, the statement actually was dovish, and the reason is they changed the word will to may, and the changing of the language was the committee anticipates that ongoing increases in the target rate will be appropriate. So that was the old statement, and it was now changed to the committee anticipates that some additional policy firming may be appropriate. So that's dovish, and that's why you got the initial rally. You have anyone in the market, understands that you have a lot of algorithms that just respond to headlines. So that's why you get a lot of volatility there. But if you look, and that's why we also saw, even with a rate hike, the dollar index sold off pretty low. But then now during the press conference, he was a little more hawkish, and they obviously are not going to, when asked the question of rate cuts, he said, no, they are not factoring that in. And in my opinion, but okay, then you have the bond market, the 2-year yield is now back under 4%. So you're seeing rallying in treasuries on the longer end of the curve. So 2 years below 4%, down like 19 bips, 5-year, 10 years at 3.5%. So, and then you see during the press conference, the dollar index rallied, got most of it back. So that's what's happening.
There is a little bit of breaking news from Janet Yellen, the Treasury Secretary. She says, we are not considering insuring all uninsured bank deposits. So that just came out
a few minutes ago during the conference. I've got a few things that she did say. I'll read them out briefly. So the failure, let me read out what she said. They're all mixed up with Powell's comments. So $2.5 billion cost of FDIC's Silicon Valley Bank resolution is only an estimate, final cost unknown. We are not considering insuring all uninsured bank deposits. That was about 17 minutes ago, but I didn't want to interrupt. She also says the failure of a small or community bank could trigger bank runs as much as a larger bank failure. It's a really interesting comment. We have not considered or discussed anything to do with bank insurance or guarantees for assets. Then we'll continue with case-by-case determinations of systemic risk in the event of bank failures. So it's at the same time as Powell was speaking, and I've got one more comment here. She says just now, about 2 minutes ago, Silicon Valley Bank run created fears that uninsured depositors would be wiped out or take several severe haircuts. I've actually summarized, so the team was adding all the comments from Powell's press conference, which ended a few minutes ago, and Yellen's comments, the key comments, in the thread under. So if you see the pinned tweet on my profile, which is a tweet for this space, is an actual thread, and the team added all the highlights from the press conferences, and you'll see comments from Yellen mixed with Powell's comments as well, if you want to have a look at it. But it's, I was talking to Naeem Redacted about it in the background. Naeem, you didn't think it was too major, whatever Yellen was saying.
Yeah, I don't know where she's speaking, but yeah, that one comment about not insurance or not they're not in discussions of ensuring all bank deposits, I think is significant, but I'm not surprised by that.
Was that? Yeah, I was going to say, like, it's not surprising though. You wouldn't expect her to say otherwise.
I would think it would take something from Congress to be able to do something like that because they don't have the.
They don't have the
powers.
authority anymore. Yeah, after 08, they don't have the authority to ensure all deposits. So that needs Congress approval, but they can request Congress, I guess, which doesn't seem like they will. Jump in, Amy.
Thanks. Yeah, so I mean, I feel like anytime we have these Powell press conferences, it's kind of like spring break for the markets. It's a combination of fear, greed, and algo's gone wild for the duration that he's speaking. And as the previous commenter mentioned, that market grabbed that language switch from the May and some with the rate hikes as opposed to the ongoing, which was the prior language. And the market started to run as soon as it heard that. But then he sort of started to walk it back. And I do feel like this is another one of those talks that he's given where there's enough ambiguity that anybody taking any position can sort of argue their case going forward. So, I was really
Amy, was that intentional just to see how markets react? The level of ambiguity and mixed messages, because even the panel he's mixed, is that intentional from them to determine further policy changes?
No, I mean, I think I don't think it was it intentional, like he was trying to bait the market to see the response, or.
Yeah, so the mixed messages you saw and then saying one thing and then kind of taking it back a bit.
No, I mean, I think he just always tends to leave this opening for like he wants to leave this opening to see what the credit tightening is going to do. If maybe the credit tightening from the bank situation is going to leave them a little bit of room so that they don't have to hike quite as much. So that's what gave him that ability to switch that language and leave that variable open. And he seems like
let me jump in. Sorry, Yellen just said, and I'll give you the mic back. Sorry, Amy, I interrupted you 3 times. So Yellen says, I am focused on stabilizing the banking system and improving public confidence in it. We can debate in the future whether to raise the FDIC deposit insurance limit above $250,000. So I'll say this again. She said the following: we can debate in the future whether to raise the FDIC deposit insurance limit above $250,000. And then she says, I'm not going to weigh in on deposit insurance limit right now. And then 5 minutes ago, Bank of England says it warned U.S. regulators over Silicon Valley Bank risks before its collapse. Governor Andrew Bailey defends his team's supervision in letter to parliamentary committee. That was 6 minutes ago. Sorry, go ahead, Amy.
Yeah, I mean, I feel like there's been this ongoing push and pull sort of between Powell and Yellen as this entire hiking cycle has been going along. She is obviously trying to leave more of that opening for this, is this going to turn into some sort of systemic crisis? Is this banking thing going to be more severe than we thought? Is it going to lead to this credit tightening that, in and of itself, this credit tightening could lead to a recessionary response in the economy and without requiring any further rate hikes? And I think that Powell at least had to acknowledge that in his speech, but he certainly came out hawkish to begin with. He said inflation, our focus is inflation. He came out really, really strong on that to start with. But then he left that one little bit of language in there just to show that, like, yeah, I am acknowledging that that's out there and we are going to take it into consideration. We're going to continue to see the data as it comes in. And it's just that little bit of dovishness that I think he tends to leave in every sort of press release that he does that causes this volatility in the markets. Like the Wall Street Journal was just saying yesterday, there tends to be like more volatility in the markets on the day Powell speaks than any other prior Fed speaker. And it's just, well, I mean, it's algos now as opposed to, past Fed figures that we've had. We haven't had quite as much algos and the 0 T options and all that stuff is all new now. But some of it is just that he always walks back that language just a little bit. And I don't know if he's doing it to appease, for political reasons, or if he's just trying to. But I think he wants to be hawkish. I think he wants to fight inflation. And, you know, as far as the markets today, I think the meaningful information that we're going to get is going to come at close. We'll have to wait to see how's it close. And that'll tell us, you know, a little bit of how, that'll give us a more solid picture of how the market is interpreting this particular 25 rate hike and the comments around it. But I think that overall, the discussion and the language had just enough ambiguity in it that it didn't strike me as fully hawkish.
Rob, Kobeissi, Douglas, and Jay, what do you guys think after this press conference?
I mean, I think this is exactly what we said before this all happened. The decision came out. I think this is a more hawkish than expected outcome all around, but I think the market is kind of looking at their ambiguity as a dovish sign. But I still think we're going to get another rate hike in May. You could even get one in June, depending on what happens. And I do think that they're just confident that the Treasury is going to make sure that if this gets worse. I know Yellen's saying they're not considering a backstop anymore, but if it got worse, they definitely would bring that back. So I think Powell is just kind of saying, you know what, I'm going to let them handle that, and we're still going to try and get inflation to our 2% target.
Does anyone else think, does anyone share Wahid's enthusiasm that this was dovish, this was better than expected? He was pretty excited in the back channels chatting to us. Is anyone in that same boat? Rob, Jay, anyone else? Raul?
Could you repeat that, please? Sorry.
Are you dovish? Anyone more dovish after this press conference? Because, you know, Wahid was in the back channels pretty excited.
I think, well, what you saw was that there is a, you know, at least a hint. This is all about threading the needle again. And I think he does this better than anyone. He does it better than Bernanke. He does it better than Yellen. I think there is an idea that this could be, you know, one of the last couple rate hikes. But then he put in that caveat, right? So I think that the market is telling you that this, you know, that this could be dovish. The S&P, while everything was higher versus market expectations, I think that just the fact that, you know, we may not see more than one or two hikes and that the banking system is doing his job for him. I think that is what the market is focusing on right now, even though, you know, for the next meeting, we may still see a hike. I think that is essentially what the Fed is focused on right now, or what the market's focused on right now, that this could be, we could be close to the end of the hiking cycle. It doesn't mean that we're cutting, but it could mean that we're at the end of the hiking cycle.
We've got to be really, in terms of, I know I'm going to speak in definitives and I don't mean to, but in many ways we've got to, because he's got to wait, or the committee's got to wait to see how this plays out, and obviously the regional bank issues that are transpiring and have transpired, and what that means for the general economy. Because the problem that they've got is that if the interest rates continue to rise and they don't allow time for that to sweat down to regionals and therefore down to, and I've talked about this on previous spaces, you know, mum and pop shop, small businesses that are trying to get lending, whatever, they won't really see the full effects of the rapid rise of interest rates. This is really going to become deflationary because small businesses are going to struggle to get more better lending terms because of this hike, and the pressure that puts on banks, mostly regional banks that give these people their loans. That will take care of the inflationary issue, and therefore it really doesn't. I would suggest it is more dovish in the sense that he really won't really need to put up interest rates anymore to achieve his goal. He's just got to wait for this to play out. And I think that's pretty much what he said. He was playing the line unbelievably well in terms of just straight down the middle of not answering anyone's question in particular and not playing to any particular side.
Made it very hard to be a trader.
Right, yeah, because there was nothing to go on, right? There was just, he played, I was actually really sort of interested to see how he would play this today, and he played it down the middle. I didn't actually think he could play it down the middle, and yet we got off the call and I didn't really feel like he'd taken anyone's side in particular. So that was impressive to listen to.
Yeah, I think this press conference was really risky. I think that Powell is now risking, you know, if something does happen to the US banking system, and maybe not even the US banking system, but the banking system globally, because of the speed at which interest rates are increasing, I think this press conference would go down in history as one of the biggest failures in history. Because, you know, I think he came out, I think the problem around why the banks are collapsing is not isolated to Silicon Valley Bank. And he multiple times said that
he couldn't have said anything outside of that. You understand that?
Yeah, so Yellen just said, like, on this particular point, right, I'm just going to add, it's perfect timing. Yellen just said 3 minutes ago, Silicon Valley Bank was an unusual bank due to its business model, interest rate risk, and high percentage of uninsured deposits. And then she says 3 minutes ago, situations like the run on Silicon Valley Bank may more readily happen in the future. Regulations may need rethinking. So that was Yellen a few minutes ago.
Yellen's got to say that, though, isn't she? In terms of, she doesn't want to speak. She's the one having to bridge the gap between the government being blamed for but regional banking failures and the fact that she has to create the insurance policies. So she's not going to come out and say, you know, anything other than that, is she? In terms of, you know, there's going to be a few examples where Silicon Valley Bank isn't alone, but it's rare. We all knew that. Regional bank pressures are very different, and unfortunately it kind of played out in the week as other banks being pulled into that, including European ones. The problem that they've got and the pressure that they're under is to keep on, you know, from Chairman Powell's perspective, he's got to keep on pushing this inflation down whilst presiding over a banking system which went through the week, or the last 2 weeks it just went through. And I think, you know, in fairness to him, he played that line.
Sorry, I forgot to unmute. I want to go to Raul as well to get his thoughts on this. Raul, Douglas, and I brought Michael up on stage. Michael, to have you back. Raul, Michael? Robert, you're still with us as well. I saw you unmute and he dropped out. I think he's glitching for speakers. Raul, Michael, Douglas, can you guys unmute, or is it glitching for you too?
Right here. Sorry, I'm just actually... Unfortunately, I'm actually kind of...
So, yeah, it's two Michaels, and then we'll go.
To do today was to sell, you know, the 40+ vol that was implied, and basically sit and watch. There's no real moves that I would argue are happening of any consequence in the equity markets. There is outperformance of, you know, safety over kind of the junk stuff. You know, to those banks, you know, probably among the worst performing areas. But this is, you know, this is the market basically saying, I said it before, you know, this is the market saying he didn't know what he was talking about. Rates are going to be lower, not higher, and they've missed an opportunity to convey that they were seriously addressing the issues.
Mr. Green, Mr. Michael Strain.
Yeah, I agree with that. I think that, you know, the markets are wrong, and the markets have been wrong in the sense of being much too sanguine about the inflation outlook. And I was disappointed to see Chairman Powell repeat that mistake. It's hard to imagine that the Fed will be able to stop at 5.1 or 5.2%. You know, this all hinges on the extent to which we'll see credit tightening as a consequence of turmoil in the banking sector. But I think even if we were to see substantial credit tightening, you know, that's probably only worth 25 or 50 basis points. And, you know, in my view, the terminal funds rate is likely around 6. And so that knocks the terminal funds rate down to 5.5. If you're being generous. And so, you know, I think that the markets and the Fed just still haven't fully grasped the magnitude to the problem. Last month we had 6% CPI inflation. 6%. You know, we've been living through 2 years of record high, 4-decade high inflation, and I think that has kind of inured us to just how rapidly consumer prices are growing. 6% inflation is an emergency. At the same time that's happening, the labor market is arguably heating up, not cooling down. If you look over the past 3 months, the average monthly job gains was about 350,000. That's the fastest pace for a 3-month average since September of 2022. Wage growth is faster than is consistent with the Fed's target. So, you know, the fundamentals are the same. We have inflation, underlying inflation that's at least double the Fed's target. Every month, that's getting more and more embedded. We have a labor market that is not slowing down. And yes, we've had some turmoil in the banking sector, but that turmoil seems to have subsided. We haven't seen other banks fail. Reports out of the Fed yesterday and by depositors to withdraw money from community banks had slowed, stopped, or reversed. And we will see some tightening of credit standards, but that's not going to knock the terminal funds rate down to 5.1%. So, you know, all in all, I think this has been disappointing.
I don't see inflation going up more and more. I think that we had a rebound that was possibly due to the warmest January we've seen in many years. And goods inflation, I think, is still negative. I think real estate is going negative, and wages will stay sticky for a year. I think 2 of the major categories are headed negative, and one of the major categories has been stubborn, but I don't see it going higher and higher. The UK number was a little bit higher, but when it comes to the US, I would be surprised to see it higher in 6 months.
Well, I would be surprised. I would be surprised by that too. But look, we still have, you know, we have 5.5% core inflation. If you look over the past 3 months, core CPI grew at a 5.2% annual rate, and the Fed is going to have a harder time getting inflation from 4% to 2% than it did getting inflation from 6% to 4%.
That part is true because, you know, the wage side is just less sticky, and real estate is on a delay because OER is, you know, it's going to reflect what we're really seeing in the real estate market months from now. So yeah, that part I do agree with.
And I think you're right about goods, you're right about housing, but the really troubling part of the economy right now is services. And services is the part of the economy that is most exposed to wage inflation. Still see wages in lower wage industries growing way faster than average wages. And it's just going to be really difficult, I think, to get wage inflation down to the point that services inflation can come down and hit the Fed's target without destroying much more demand than has been destroyed. Now, again, maybe you say that tightening credit will take care of a lot of that demand destruction.
And more people are coming to the labor force, right? You know, I went to Chipotle with my niece, and it's normally really, really packed because there aren't enough people there. And today went before the presser, and, you know, there wasn't as big of a, you know, this is all anecdotal, but I had enough time to go up there and teach the guy how to roll a proper burrito, right? Normally, I don't have time to even talk to them. I think that you're going to see more and more people, especially with some of these minimum wage areas, they've raised their wages so much. You could earn, you know, $25 an hour at a gas station. Arguably, it's a dangerous job. You know, I wouldn't be surprised if people, you know, see their portfolios later in the year and say, okay, well, I can earn $25 an hour, and that's going to cover a lot of my living expenses. So you might see, you know, the 3 million people who left, maybe 500,000 people come back. I think all this data is lagging, and we don't know how it's going to play out.
Yeah,
Jay,
and
I have a
so
question for you.
if you see those people come back, then on the one hand, that will reduce wage inflation because there'll be more workers. On the other hand, they'll be earning more income.
Wait. Say that again.
if you see workers come back, then that increases the supply of workers in the labor market, which should put downward pressure on wages. But at the same time, those people will be earning higher incomes, which will increase the demand for goods and services in the economy, which will put upward pressure on prices.
Right, but goods inflation is going to be so negative, it won't matter.
I think you're right about goods inflation, but again, think about the argument. The argument is that
by May or June, the comps are going to be so difficult. You just look at last year, the comps are just going to be so difficult in the next few months that it's very tough to see if 500,000 people come back into the labor market that they're going to change. And by the way, those are the low wage people, right? They're not going to be buying Maseratis. I doubt you're going to see. So you're going to see like big ticket spending come back, right? Like TV prices are going to go down, car prices are going to go down, housing prices are going to go down, commercial real estate prices are going to go down. All big tickets are going to go down. Barbecue grill prices are going to go down.
I think a credit crunch will affect automobiles, will affect major purchases, and it will. And those are purchases of goods. But again, the inflation that we're worried about is coming from the services sector, and it's true. People buy Chipotle on a credit card, but I think the credit crunch is not going to have a really big impact on the part of the economy that really matters right now to inflation. And we might see inflation kind of come down, underlying inflation come down to 4%, maybe come down to 3.5%. 3.5% is still almost double the Fed's target. 4% is still almost double the Fed's target. A reduction in goods inflation is not going to do all the Fed's job for it. The Fed has to cool off services prices, which means the Fed has to cool off wage growth, and counting on tighter lending standards is, I think, not gonna get us there.
Well, that's what we'll see. I personally think that you're just going to see a lot less lending. If you saw, that couple $100 billion on the discount window, that is not free money, right? Especially in the new facility, that money costs 4.7%. The money that these banks are borrowing, that money is not going back into the economy. It's not like QE at all. That money is being used to shore up the balance sheet, and it is very expensive, and it's going to destroy NIM. And when it destroys NIM, it affects valuations. When it affects valuations, the banks have to raise equity at even lower prices and raise prefs and hybrids at above, 8-9%. And when they raise that more expensive capital, it becomes a cycle. And then that cycle means that they're going to lend even less. And given that rates are moving in this direction, there's a lot of short-term funding that is rolling over. And as that short-term funding rolls over, you're going to see a number of these banks just say, hey, no, I can't roll you over at L plus 1%, L plus 2%. I'm going to have to charge you 8% for this first lien loan. And then the property manager and the sponsor are going to say, well, I can't do that. I bought this deal at 4%. I'm going to have to leave this loan. You're going to have to take the building. And that's going to happen over and over and over again. And that money multiplier effect is going to go through the economy. And the shadow lending market is 90 trillion versus banks at 30 trillion. The shadow lending market is potentially just going to shut down. And that I think that $90 trillion market is going to effectively do the Fed's job for it.
That strikes me as a potential but optimistic take on this. Again,
nobody knows exactly what's going to happen. That's kind of just how I'm thinking about it. Yeah. I think there's a high probability.
I just want to emphasize.
I'm thinking about it outside the. Oh, go ahead.
Go ahead, Michael.
I'm thinking about it more through the kind of lens of the services sector. And what's going to stop me from going out to dinner? What's going to stop me from going out to lunch? What's going to stop me from going to see a show? What's going to stop me from going to see Springsteen? Well, very little would stop
I think what's going to stop you from doing that is when earnings come down dramatically and lending stops, and you see the stock market down, 20, 30% over the next year. And I think that will stop some of the higher end spending. But again, nobody knows the path or how fast that's going to happen. But earnings are going to be coming down dramatically.
It'll stop a little. Look, I mean, the big banks that are trying to analyze this suggest this will take GDP growth for the year from 1.5% down to 1.3%, maybe 1.2%.
But they have no clue. They have no clue.
I agree.
And the lending market is a lot more powerful than they give credit. They give credit to.
That may be, but even if they're wrong by 50%, the Fed still has a lot of work left to do, and the Fed can't stop at 5.1%.
If no, I don't agree with that. If you're saying they're wrong by 50% and GDP growth goes to like 0.5%, that's going to feel like a recession.
So in the vein of trying to figure out what we can look at to see how tight financial conditions are, Powell went up today, and we heard yesterday on this space, I don't know if it was you, Jay, that said this, but the financial conditions indexes that we've been using, whether it's from Bloomberg or Goldman Sachs, none of them saw the funding stress that we saw emerge in the U.S. banking and then European banking over the last 2 weeks. So with that in mind, Powell also reiterated our measures of financial conditions, they aren't accurate at all. With that in mind, how can we gauge the slowdown in credit growth? What specific things are you watching so we can actually monitor how
there are a lot of things that I'm watching. Like I follow the structured credit market, right? Multi-trillion-dollar market. You're just seeing fewer and fewer deals. Now, these deals are deals from Upstart, and Upstart is lending to consumers, right, with 620 FICO scores, which banks don't lend to. And then you see it flowing through to auto securitizations. You aren't seeing very many lenders willing to increase their auto lending because when you think about a loan-to-value ratio, the V and LTV, the denominator, okay, is coming down, which is making the L look bigger and the ratio look bigger, and it's not as exciting to lend at a couple percent to the auto sector. So, you go to get auto financing, you're going to get 9 to 13%, and it means people are going to spend less money on cars. You look at securitization for single-family rentals and multifamily, that's coming down. So I'm viewing it from the shadow lending market, and I'm seeing the shadow lending market start to freeze. And those are indicators that I think it's hard to find unless you're hooked into a dealer network. But those are things that I'm looking at, and I think that it's forecasting a contraction in lending.
Fantastic. Thank you, Jay. Now, I want to bring it back to this statement really quickly. I'm not sure if you guys already spoke about the differences between the February and the March statement. What do we think of the change to further firming of the policy rate may be needed rather than further rate increases may be needed? I immediately caught that when I saw it redline across my terminal. But are we interpreting that as a pause? Or are we interpreting that as they're opening the floor to potentially pausing and basically just being wishy-washy? How are you guys
discussed that earlier? And
I interpreted it as a dovish signal, and it informed a lot of the comments that I've already made. I mean, again, looking at kind of specific credit products and specific lending products is a useful gauge into the economy. But I think when what's the Fed ultimately care about? It's the macro economy, it's the aggregates, it's the consumer price index, it's the PCE price deflator, it's the unemployment rate. And I think that change of language in the statement suggests that the Fed thinks that the credit crunch is going to have substantially stronger effects than I expect it will have.
I guess that's part of where maybe Jay and I are a little bit in shock to imagine that the credit effect is not going to be huge.
I think the credit effect is going to be massive.
Yeah, that's where I am.
I think that banks are in a very tough situation. And Yellen said that she's no longer providing a higher guarantee in the near term. And I just want you guys to look at what's happening in going into the close. And if there is no broader guarantee, what could actually happen to banking conditions? And just think about it logically. If these bank valuations tank, these loan officers are going to get a tap on their shoulder, And the risk manager is going to say, if they have a risk manager, unlike SIVB, if they get a tap, they're going to get a tap on the shoulder and they're going to say, hey, raise rates, don't lend to risky people, lend to wealthy people at a higher rate.
Yeah, we're seeing, I think after Yellen's comments, the XLF financial sector is getting hit. It's at the lows of the day now. And
Yellen and Powell spoke. They're just going to let the banks do the work for them. They're going to let the shadow lending market, and they're going to let the banks do it for them.
Well, we'll see what happens with the First Republic, because that's a fluid situation, but that's at lows of the day again, down 16%. And then there's an issue.
You guys understand what's happening, right? Like if you need to raise money, you're not going to raise money above a stock price. You're going to raise money below a stock price.
Oh yeah.
And when you're raising money of that size, okay, it is going to be hyper dilutive. And so just something, to think about without naming anybody, something to think about, and then think about what those prices, reflect on the confidence of people working at those institutions and their customers.
Fantastic. One thing I wanted to ask about, we've seen the front end on the Treasury curve now rally 25 basis points on the day. It's now, I'm talking about twos, they're up 22 or down 22 basis points on the day. So pretty substantial rally. Obviously, we've seen crazy bond volatility over the last few weeks, which certainly hasn't helped financial conditions, in my purview. For anybody up on stage, do we think that this front end rally will, in part, it's sparked by Powell. Powell explicitly said, and I don't think he needed to say this at all. I feel he was, the statement worded it quite well about sort of leaving the path for policy open-ended. But Powell said during the presser, we no longer expect that ongoing rate increases will be appropriate. I don't think that this sentence was necessary. Do you think that this was a method of easing financial conditions for these banks that have somewhat, they're sitting on these huge unrealized treasury losses? Do we think that that was sort of a bone that was thrown to them? And that's why we've seen the front end rally so considerably, right? And saying we don't expect ongoing rate increases. The front end obviously is sort of a proxy for forward rate expectations. Do we think that was intentional from Powell to just sort of throw a bone to some of these financial institutions that may be hurting?
Jonathan, jump in. Anyone could jump in.
So I wasn't going to address that question. I just wanted to ask Jay whether he could give a better sense of where he thinks the CMBS market will be, by the end of next year. Because, Powell basically said that in the long term, rates are 4.5% into 2025. And we saw the CMBS market stall.
Just sorry, Jonathan. Sorry, I'm going to interrupt you. This came in 1 minute ago. For anyone in crypto, you'll find this interesting. The U.S. Securities and the SEC on Wednesday. That was on Wednesday. So is that today? Yeah, today. Came out a minute ago on Reuters. Sued Chinese cryptocurrency entrepreneur Justin Sun. I think all of you know Justin Sun from Tron. Some people love him, some people despise him, accusing him and other defendants of illegally selling crypto securities and scheming to artificially inflate trading volume in crypto assets. The lawsuit was filed in Manhattan federal court. That came out a minute ago, which is interesting news, to say the least, for anyone in the crypto space. Not sure if Scott, are you listening? No, Douglas and Scott are deep in the crypto space, especially Scott. Did he even use it? Yeah, go ahead, Douglas. Did you about Justin Sun?
What else is new? Another crypto pumper pumping crypto, and celebrities getting caught into it. How many times have we seen this story? I don't know Justin. I think I can recall his avatar, and I know he had a lot of hot takes. But this is no surprise. We've seen this movie before. What else is new?
So I have a question, Mario. So anyone on the panel, I'm not involved in crypto. I have my opinions. I'm not going to share them, but let's look at what the market's doing right now, okay? You have the S&P 500 at the lows of the day, down 1%. You have the Russell 2000, which you see that more reflects the banking sector, which is getting hit pretty hard right now. The Russell 2000 is down 2.5%. NASDAQ's down 0.5%. You have the dollar is still down on the day, about 80 cents, and Treasury, your yields below 4%. But you have gold rallying, almost up 2% on the day. But why is Bitcoin down 5%? Why is crypto selling off heavily today?
They're all risk assets.
Yeah,
Well,
all risk.
I know the
all
answer
risk
to that.
on.
I just wanted to. I know the answer, Jay. I just wanted to hear from the crypto people on this.
Yeah, Bitcoin. Bitcoin's the highest beta of the bunch, right? And so on a day that has poor risk sentiment, you see stuff like this. And also, that it generally doesn't help that the SEC is suing Justin Sun. But what else is new, right? The space is filled with utter shills, securities fraud up and down, and really after 2020. Regulatory authorities, the relevant agencies that oversee, whether it's the CFTC and SEC, they're trying to save face, and so that's what you're seeing now. It's that combined with the fact that it's a bad day
I guess
for.
I just wanted to highlight as the trade that continues to stand. Hold on a second. Is that you when you see sell off in risk assets, equities, and you see rally, you see a bid come to treasuries. The dollar's down, gold is rallying. When you have risk assets selling off equities, you still are seeing crypto in that trade. So the argument that the crypto people make is that you're going to see sort of a decoupling of that is still not happening.
Well,
let me ask real quick, did Justin Sun and his ovations to take over Credit Suisse the other day, does that put this lawsuit into context? Was this a play to find some legitimacy and cover because he knew this?
He does this every time. No. So anyone in crypto knows this, Justin. And for anyone outside of crypto, this might not mean much to you. But in crypto, by the way, George, I see you in the audience. If you have time, it would be great to have you come up. But yeah, so Justin, when FTX collapsed, like, yeah, I'll buy FTX. Nothing happened. He's done this before that as well. And now with Credit Suisse, when he tweeted about it, people just didn't take it seriously. Now, I don't know Justin personally. I know he's got a lot of haters. But yeah, the announcement is, look, I don't wish anyone bad, and I want to move away from crypto again. Just go back to the FOMC meeting, what that means to the markets. But I don't wish anyone bad, and I don't judge people based on what I see online or what I hear from others. I'm a very fact-based person. The only good thing out of this, at least in my opinion, is that one thing that's been bothering me for a long time. I've been in crypto since 2017. Is that I see a lot of people do the wrong thing and profit massively from it just because of the lack of regulation. And me and obviously others, Ron was on stage earlier, Scott was on stage earlier, Scott Melker. We've said no to a lot of shit just because of that worry. That allowed us to survive till today without getting any ACC letter. At least I can speak for myself, and I'm sure Scott and Ron are on that same boat. But one thing that bothers me is when I see everyone else doing the wrong thing and getting away with it, like it's fine. And it's like different rules. They play by different rules to the rest of the markets. So what I like is I love to see the law catch up to them. Obviously, if they didn't do anything bad, I hope nothing happens to them. If they did, they should be penalized. But I'm glad that crypto is getting more regulated, because if you're deep in the space, very deep in the space, you have to understand the rules that you guys play with or we're used to in crypto are just illegal in most cases. And anyone outside of crypto, it's a good thing as well, because it just brings more legitimacy to the space. We saw some of the influencers get fined a few days ago related to the FTX collapse. I don't know much about it. I know a friend of mine, Tom Nash, is one of those people, but he again, not everyone's guilty, and that's not necessarily a bad thing if you promote a project doesn't end up being good. But then in many cases, a lot of the wash trading, a lot of the pump and dumps, those things to me are probably the thing that bothers me the most. And I'm really glad to see the SEC take action despite them being late. So just wanted to get that off my chest. I know it's unrelated to the discussion, but back to the FOMC meeting. And Justin, good to have you back. And I've got a few more speakers. Let me send out a few invites. But George, I appreciate you accepting the invite. How are you?
I'm well. Thank you very much. I appreciate the invite. I don't have much to add here. Most of the guys are pros. I'm just merely an amateur. But just going back to the debate, inflation, disinflation, I kind of look at it from a more macro standpoint, more of a monetarist standpoint. And if I think about what created the inflation in the first place, it was an increase of demand. You could call it an increase in deposits, M2 money supply, and a decrease in the supply of goods and services. And if you think about the supply side of the equation, that's probably coming back online, although there's still significant disruptions there. But then if you look at the M2 component, the deposits, that's actually been going down significantly over the last few months. And I think the main reason, because credit, loans, and leases, at least according to the Fred website, has been going up. So the main component there, I think, is maybe M2 going into institutional money market funds, and then potentially going into treasuries that are being used to pay off banking entities, so that M2 kind of goes to M2 heaven. But I think now that we've seen the problems in the banking system, it would lead one to assume that there's going to be a lower issuance of credit by the banks moving forward. And we all know that means fewer currency units. So if we see the deposits continue to go down, but go down because of credit going down, then that's actually going to impact the purchasing power or the aggregate demand of the consumer. And so if you assume that because aggregate demand went up as a result of M2 and deposits going up, that's what caused one of the components that caused the inflation in 2020, 2021. If that starts to go down, assuming the supply side stays the same, you would have to assume that would sway the probabilities towards disinflation, even though, we're at 6% right now. Month over month, I think we've gone from 0 to 0.4 to 0.5. There's going to be some base effects that probably bring that down to 4. But and I don't have any conclusions based on that. That's the only thing I would assert, just for kind of food for thought.
George, some other questions there around the flow of money, the funds that people are looking to shore themselves up or otherwise. Two issues. One, the discount window, the huge end of the week, last week, I believe it was, or maybe a week and a half ago, where the discount window borrowing just went through the roof, and really the return was so low. It was like, well, why are people doing this? Because, it could be used as, asset sort of potentials there. And then the recent leaked report yesterday, this was called out by Dan Snyder, about FHLB, right? And how the assets and advances towards the end of the year, those were published and they were through the roof as well. Is that concerning to you, both the discount window, the FHLB? What do you know about those sort of mechanisms that people are using as sort of a issue of last resort to get the funding they can't get on the open market?
Yeah, it would definitely be a red flag, especially when you consider the fact that the discount utilization, the discount window utilization, last time I checked was like 160 billion. To give some context, going back to the GFC, I believe that got up to about 115 billion at the peak in 2008, the peak of the insanity, if you will. So that's never a good sign. I think the swap lines, the Swiss National Bank, are being utilized. I think that's a red flag that my good buddy Jeff Snyder has pointed out on several occasions. And another thing that he pointed out, I want to give him credit for it, is the delta between the reverse repo rate and the 1 month T-bill.
Right.
And I haven't looked at it today, but I'm assuming it's around 75 basis points. And in fact, I think even the 3 month now is below reverse repo. So that means that there's a lot of entities out there, financial institutions, that are trying to get their hands on any type of collateral to shore up their balance sheet. And I think that's a big red flag. I don't know if you want to call it a canary in the coal mine or something like that. But I just looked at the curve today, and this was a few hours ago, but the only yield, the only maturity that was above Fed funds was the 6 month T-bill. So we're very close to the entire curve being below Fed funds, if not below reverse repo. And that's just such a massive warning flag. I don't know how anyone could be extremely bullish in this type of environment. And I know if we just kind of freeze the data as is, you've got low unemployment, consumers got a good balance sheet, and there are some things there that would lead you to believe that inflation is going to be a persistent problem. But when you look at the yield curve, I think there's also a strong argument that the Fed isn't going to have to do much to bring down inflation because you might have that, I hate to use the word crisis, but you might have that recession coming on sooner than later. And also another thing I'll point out, I think someone else mentioned the fact that the 2-year Treasury, I think the yield was down maybe 20 or 30 basis points today. And so we're getting awfully close to the 10-year. And as most of the people know that are on this call, historically, It's not the inversion of the curve that you really worry about as far as timing. It's the steepening. And when that curve uninverts, if that's a word, but when the inversion goes away, from a timing standpoint, that's when the stuff usually hits the fan. And I again, looking at the action between the 2-year and the 10-year, I think we're getting closer to that point.
So, George, I have a follow-up question. Then, if you can just add to this. So, looking at the 2s and 10s, they got inverted as much as like 108 basis points, but now it's de-inverted, I guess, today or right now it's at 50 basis points. So what does that move do to your timing of how quickly we enter a recession?
Yeah, and I'd like to point out that last week, if my memory serves me well, it was even closer. I think the 10-year was around 3.5. And I think the 2-year got down to maybe 3.7, 3.8. I haven't followed it too closely because I actually dislocated my shoulder.
Yeah, I have it up. It got as high, I think, as 35 bips. But
as close as 35 bips.
Yeah.
Okay. Yeah. So that's something that I'm paying very close attention to, because once that 2-year goes below the 10-year, to where there's no longer an inversion. If you look at a chart of the yield curve going back to the 1950s, you see that we don't usually get a recession. I think it happened a couple times in the 70s, but we don't usually get the full brunt of that recession while the yield curve is inverted. You usually get it just afterwards. So once I see that 2-year go below the 10-year, assuming it does in the next couple of weeks, that's when I want to really, really be paying attention.
Is there any fix to this, or is this just something we're going to have to absorb?
Well, I don't know what the fix is, because I'm the more I look into this stuff, and again, I want to be very clear, I'm not an expert. I'm not like, I know Mike Green is on here, and I can only learn from people that are on this call, but just kind of analyzing it my own little way and doing whiteboards and whatnot. It seems to me that the banks, balance sheet capacity is not an issue. They can create liquidity, they can create dollars, they can create all these things that Silicon Valley Bank or Signature or Credit Suisse, they need. So the question is, why aren't they? And I think that's when you go down that rabbit hole, I think the answer is because there's a significant increase in perceived counterparty risk. And then once you understand that, you realize that the glue that holds the entire global monetary system together is simply confidence. And the Fed, I think, can only temporarily instill confidence. And I think there should be a debate whether or not the Fed instilling that confidence longer term actually decreases confidence. You look at QE 1, 2, 3, now we're on 4, 5, who knows? Is that on net balance over the long term? Does the market, are they more confident as a result of that, or less, as far as these banks in the global monetary system providing the liquidity needed to really make sure that the global economy is functioning? And so I don't really know the answer to that, but I think for people that are a lot smarter than I am, there should be a debate there. And so I guess what I'm saying is I think that the confidence is really what's gone. And I don't know that there's a quick fix or a 4-letter Fed facility that brings that back to where it needs to be in order for us to avoid whatever storm clouds are coming our way.
Amy, is there any way we can find that super glue confidence back into the market here? What are your thoughts on our current state?
Yeah, I want to piggyback off of what George said, because there was a speaker on earlier who had mentioned that, I don't know that the Fed's done enough, and that the tightening from the banks is going to be enough to bring down inflation, especially he was talking about services and wage inflation. But I think that George raised a lot of valid points. Have we even seen the full effects of the rate hikes that have been done so far? I would argue no. I mean, there's a policy lag, and we just hiked rates at the fastest pace in history, and we haven't even seen the full effects of everything that's been done so far. And I do think, like he mentioned, the housing market, it's frozen. He kind of waved off the questions about the commercial mortgage market, but I think there's a lot of things out there that are more precarious than we're being acknowledged. And, any of those things could send us into a recession, and it's going to end up being a lot more deflationary than people think. Despite, like, if you take a snapshot in time, and George said this, it does look like the data right now looks inflationary. It looks like that needs to be what we're fighting right now. But, is it possible that we've already hiked enough and we're just waiting on a policy lag, and what's really going to give us the answer is time?
Yeah, I think that's what the yield curve is telling us.
I mean, it may be what the yield curve is telling us. Amy, I think that's a reasonable view, and I think it's hard to know for sure. But looking in any individual sector gives some window into the economy. But for every commercial real estate sector, there's also a leisure and hospitality sector that's on fire. Commercial real estate looks like it's heading into a really bad place. The demand for meals out at restaurants is still through the roof. And when you look at macroeconomic aggregates, what you see is that even at 475 basis points, the federal funds rate is still lower than the underlying rate of inflation in the economy. By that measure, real interest rates are negative. You still have two job vacancies, 2 job openings for every 1 unemployed worker. The unemployment rate is still 3.6%. Wage growth is still, on average, throughout the economy, wage growth is still faster than a level consistent with the Fed's target. Wage growth in service sector industries, which is where the inflation is coming from, is even faster than wage growth on average. Consumer spending picked up in January. It didn't decelerate. Consumer demand is still very strong, and the labor market is strengthening as measured by the number of jobs that are added every month. The labor market is strengthening, not weakening. And
okay, Michael,
that
the data you're looking at is lagging. And not only is it lagging,
maybe
that's a long time. When the banking issues weren't there a month ago, and even this month's labor is not going to reflect that. Number two, the JOLTS data is not accurate, right? I think there have been a number of studies where there are job openings that are being double counted because there are a number of different platforms. The same company will have different job openings on like 40 different platforms. Sometimes they'll be under different names. So that 2 for 1 is probably not 2 for 1. Who knows what the real number is? Is it 1.5 to 1? Is it 1.8 to 1? And then number 3, even though restaurant spending is robust, you think about it, it's going to continue to be strong. People are just stuck at home, right? January, like I said earlier, is much warmer than I don't remember. There are a couple cold bouts in certain parts of the country. I don't remember a warmer January, and I've traded natural gas, so I haven't seen a January like this. So that means people are probably out and about. So I don't think you can look at 1 month and say, "Oh my God, the economy is accelerating and so strong."
I'm looking at 2 years.
2 years. I mean, so let me provide some perspective. In March of 2021 through May, I was very focused on the inflation from supply chain, and then by May of 2021, I was like, there's so much, because I was getting calls from people, right? And I was getting calls from people, hey, can you manage money for me? And I would always say no, because I don't have time for that. And I would get calls and I would say, well, where did you get this windfall? And people would say, well, I had this consulting firm. I got like $3 million from PPP. I just never hired anybody. It didn't pay it back. And I was like, holy shit, I don't want to talk to you anymore. But there's so much money in the economy And there's so much, wealth, $7.5 trillion of wealth that was created in the real estate market. People are taking out home equity loans, borrowing against their homes. Now, what happens when those home values fall? And if they do need to borrow, when it comes to home equity loan, they have to borrow at 8%. It is going to pull a lot of those levers that, that you were talking about that created that strength over 2 years. The key thing you said was, I'm looking at the economic strength for the last 2 years. Well, that doesn't matter. That's in hindsight. The only thing you need to care about is what's going to happen in the next 6 months, in the next 12 months. And I don't think anyone has the data. Frankly, the Fed doesn't have the data to say, hey, the economy is going to be really strong 6 months from now.
Yeah, I just think that if you assume that credit creation is going to go down, you have to also assume that the money supply is going to go down, and therefore aggregate demand will go down as well. I may be just overly simplistic, but that's kind of how I look at it.
And I would go even further than that and highlight that when we think about the dynamics of liquidity components, first of all, Jay was 100% right on the JOLT stuff. I've been screaming about this for a long time. The data is now increasingly unequivocal that is a terrible data series. It does a very poor job of actually isolating what they think it's isolating because of the change in technology and the change in methodology. They also introduced the birth death components to the JOLT surveys, which they did not have prior to 2012. That data, I've highlighted the challenges associated with it as well. So the idea that the labor market is quote unquote strong, if you actually look at aggregate wages and the average wage, that is now decelerating sharply. It's down to about 4% in the private sector on a year-over-year basis. The Atlanta Fed wage tracker that everybody wants to follow, that's tied to the median wage, that's going to outperform when the lower end worker is in shorter supply relative to the higher end worker, but it misstates the aggregate economic effect in terms of wealth creation. And then just the last thing that would highlight is if you think about the dynamics in terms of what QE is and how it translates into the economy in terms of liquidity provision, you need to think about the components of the total balance sheet of the Fed, less the Treasury General account. And obviously I'm stripping out foreign central banks who play a role here as well, less the Treasury General account, less the Fed reverse repo dynamics that indicate deposits flowing out into the money market space. The Treasury General account is drawn down from $1 trillion to roughly, I think it's 230 billion remaining right now. They're rapidly approaching the point that they're going to just run out of cash to actually spend into the economy rather than tacking on the debt component. That puts the debt ceiling front and center. And then the reverse repo, we don't have it in the Wednesday data closes, which is typically the data sets that you're looking for. We'll have that at the end of the day. So a lot of people's liquidity metrics are showing that there's a big jump in the liquidity. That's just not really the case because we're already seeing the indications that on the daily reports from the New York Fed that the money is being drawn out very rapidly and flowing into money market funds where there is no multiplier. So every piece of data that we have prior to basically the last 2 weeks is just somewhat pointless or guiding in almost exactly the wrong direction.
At the end of a bull market, things just go ballistic, right? Wages go up dramatically. Companies show their best results. Cyclical companies show their best results right before things turn and go the opposite way. And it's impossible to time it perfectly. But if you look at any bull market, you look at 2006, 2007, like people were perplexed. They're like, in 2006, why are stocks going vertical? Why are these financial services companies reporting like earnings? Because none of the MPLs were crystallized, right? None of the loan losses were crystallized. So you were looking at the benefits of easy money policy. And, the Fed had also been tightening for a while, but you were looking at the benefits of the last 3 years, but you weren't seeing what was going to happen on a forward basis. And just like in May of 2021, March of 2021, when I was concerned about inflation, today,
really are actually going to do. And they've just told you that credit is going to decline. So that's what's going to happen. So you should position accordingly.
That's what I'm saying, actually. You just confirmed what I said.
Throw another grenade into the mix here. She seems to be throwing bombs all day. This one coming out here, FDIC may have some ability to determine which banks are charged special assessments after SVB and signature failures. But she goes on to say that Congress should discuss trying to pass
well,
the
Congress,
hot
what do you think
potato?
Congress is going to do ahead of a debt ceiling? Republicans are going to want to throw Democrats under the bus. This is not going to be a quick fix. This is going to take several months for people to get to conclusion and actually raise. I'm not even saying it's right or wrong, but if you expect the FDIC limit to go up, it is not going to be easy. I think Yellen realized there was going to be pushback, and she realized that she didn't want to overstep her bounds, and she realized that these banks were unique cases because they had very high uninsured deposits, and they were taking very big bets on duration without hedging. And it's going to be up to Congress. And until you see that, the longer this situation, the longer the uncertainty is, the tighter the money multiplier effect from lending is going to happen. If they do something sooner, you may not see that. But the longer it takes to result in whatever Band-Aid they have in mind, the faster lending is going to come down.
Deer Point Macro, hand is up. Have at it. Let's hear what you have to say.
Yeah, I mean, there's been a lot touched on here. I'm not sure why we give so much precedence to the Fed. I'll start there. I mean, for us to assume that, monetary policy is going to bring down the rate of inflation, I mean, you would have to assume velocity a constant. That was, the whole idea of this kind of, quantity theory of money that was put forth by Friedman, which isn't true. The problem is, again, I think we focus too much on demand. The West and most industrialized nations or well-developed nations, let's say, at this point have a much bigger issue. And Rahul had a space a couple of days ago with somebody from the Treasury, and we were kind of talking about this, is we focus so much on the Fed, and sure, the Fed can get demand destruction, but I think that we're going to have a couple of issues. One being currently, and again, I guess it depends on if we assume, decent kind of return rates on these surveys. But if you look at where consumers are expecting forward real wages to be, they're going to be high. And so therefore that's going to pull consumption forward. And I think that we saw that in the January numbers. And so, consumers are continuing to consume because the expectation is for a higher real wage. But let's just say that we get demand destruction. That's all fine and dandy. We have a different issue, and that's the fact that essentially since the 80s, we have capital stock or capital consumption outstripping investment in the capital stock 2 to 1. That's a massive problem. We have a decreasing labor force. That's a massive problem. We have declining aggregate output. That's a massive problem. We have declining total factor productivity. That's a massive problem. So we're trying to give all this precedence to the Fed. And the Fed, sure, let's say they get demand destruction, but you're still going to have a supply curve that's still shifted to the left and can't catch up with current demand. And for some reason, nobody wants to talk about that. Let's say the Fed gets us down to 4%. I don't think the Fed has the ability to go any lower than that. And again, I wouldn't say inflation's coming down because the Fed's raising rates. Again, for that logic to stand true, you have to say that velocity is a constant, which it isn't. So therefore, that just throws that whole kind of idea of monetary policy right out the window. And so we're trying to give the Fed a job that they have no ability to actually be able to do. And the only person who can do anything about getting growth back on track and getting inflation down would be the fiscal side of that equation. But again, nobody wants to focus on that. And I think Powell is actually going to go down as being much worse been Arthur Burns. His fear is becoming Arthur Burns, and I actually think he's going to end up surpassing Arthur Burns. I mean, we're seeing massive kind of destabilization in capital markets. I mean, I wrote almost a year ago about cocoa bonds, and now everybody's on that. Well, you're about a year too late if you're looking at cocos now. And, you know, if you start to look at everything that's kind of happening and you know, deviations in covered interest rate parity and so on and so forth, essentially what we have is an economy that has never repaired itself since 2008. And, you know, we're not addressing that problem, and everything that the Fed's doing now is just exacerbating, you know, constraints of balance sheet capacity that you see through deviations in covered interest rate parity. And so I just think the Fed's going to end up, you know, sinking this whole ship and most of global financial markets down with it.
Blake,
Well,
I'm
to your
glad you
point,
raised your hand there. Oh, go
to your
ahead. Sorry.
point, isn't that itself deflationary? And I remember last year you were calling for a pause in September of 2022. What has changed your mind now?
Nothing. I still think that they should pause. I mean, I 100% believe that the natural rate of interest, or R star, in the economy is 0. I do not believe it's 5%. I do not believe it's 2%. I believe it's 0. But again, the Fed's trying to do something that they think that they have the ability to do, and they can't. And we've seen the implications. I mean, I wrote 9 months ago that Credit Suisse would go under. I wrote about perpetual cocos and the problem that that has, right? And, you know, most of the Europeans were holding these things because, you know, they performed better than bank stocks, and you hadn't had an issue within the, you know, economic conditions within Europe. So therefore perpetuals massively outperformed fixed tenor cocos. The problem is that's like 80% of all cocoa issuance in Europe. I mean, like, all of these things that the Fed is doing are having spillover effects. You're now having banks not be able to go and access wholesale dollar funding markets. That creates a whole different issue for money market funds who, you know, essentially provide that liquidity to a lot of these, you know, global banks, because they don't have access to US dollar retail deposits. And all of this is getting exacerbated. And I mean, if you look at essentially what has happened, whether you look at swap spreads or cross-currency basis swaps and the widening you've seen across those, you know, covered interest rate parity, that's all a function of that. And the Fed is making all of that worse. So again, I believe the Fed should stop. And I mean, I'm sticking to that. Has it been wrong? Yeah. But I mean, we're seeing now the implications.
Well, now you're seeing the implications, right? And it's not going to change overnight. You're likely going to see February inflation being a problem, right? Then everyone's going to say, oh, we're right. Look at February inflation. And then you're going to see inflation 6 months from now on the goods side and on the real estate side just tank. And it's going to take everyone by surprise. Do you think that there are other financial institutions or other weaknesses in the financial system, like you were talking about cocos, like you were talking about CS? You know, what are some other weaknesses in the system that you would point out?
Well, I mean, I think it's duration, and I've talked about this a couple of times. A lot of people are talking about SVB, but nobody nobody I've seen on FinTwit has talked about the ECB's financial year-end statement, where they had to take 2 billion euros of risk provisions, which doesn't matter, it's a central bank, right, to cover losses just from their treasury holdings, right? I mean, that's 2 billion euros. And now they've allocated another 40 billion euros in provisioning, right? Because they're not expecting 40 billion worth of losses, but they're expecting continual need to pull down risk provisions to cover losses on all the US dollar assets that they have. So, I mean, we're talking about massive implications, not just for banks, but I mean central banks, right? And a lot of those central banks in Europe, I mean, everybody knows SNB is essentially a hedge fund, but I mean, you look at a lot of those central banks in Europe, and I mean, it's absolutely ludicrous. So I mean, I think that this is all going to end up being further exacerbated, and I actually think the Credit Suisse UBS deal is going to be something to watch as well, because I mean, that just got shoved down UBS's throat, and UBS isn't really a healthy bank anyways.
They're going to fire way more people than anyone realizes. They're going to close down the bank much faster than people realize, and you're going to have deposit flight because of concentration. 35% of deposits, you don't want all your money in one place. So that saga is not over. It's actually good for the asset management business overall, because they got $26 billion from the government in the form of the 9 billion of deferred comp they don't have to pay, and instead of 17 billion, sorry, let's say 14 billion of AT1 wipeout. But none of these things are stimulative.
Yeah, Jay, I'll end here because I know Blake has his hand up. See, my whole thing has been when you have to, manage, the dual mandate versus financial stability. I think the Fed has to give up the dual mandate and look towards financial stability. And right now they're not doing that. And that was always my thesis, as you know, even though it's been wrong, or let's say early. Now we're starting to see these kind of liquidity events start to take place. But, I think that this is where the Fed is. If Powell continues down this extremely hawkish path, I mean, I think, like you said, like those implications haven't even begun to be felt yet.
Yeah, there's no way people even can have a concept of how to price them in, because you don't know what's going to fall next. There will be several financial players to fall next. There's several hedge funds that have blown up in a week. I won't even name them because it's not worth the time, but you'll see a lot more.
By the way, Justin, I just brought Michael up. Michael, I appreciate you accepting the invite. We'll go to Blake, but just want to welcome Michael Kramer on stage. Blake, jump in.
Yeah, I just wanted to, really quickly backtrack to something that Deerpoint briefly touched on, and I thought is, really interesting. And to me, kind of one of the biggest things that I think kind of defines where we are in the broader economic cycle. And I think it's this idea of, declining productivity growth. And I think in a period like 2022 and 2023, where you saw U.S. debt to GDP or just the overall debt burden growing to extraordinary levels, currently sitting at somewhere around 120%. The question becomes, how exactly are we going to bring the debt burden back to earth, if you will? So we were talking about if we're going to see a decline in lending. I think obviously that is one way to lower the debt burden. The other way would be to increase productivity and grow GDP. And obviously, in 2023, that's something that's pretty hard to do. Obviously, you would need a lot of automation or just overall increases to how productive we are in manufacturing. And I think it kind of relates back to something that Amy and Jay both talked about earlier. Is this? Amy was talking about how these policy decisions have a lagged effect on the economy, and Jay was talking about this crazy decline in M2 growth that we've seen. And I think that it's possible that over the medium to long term here in the next few years, we could see this inflationary period turn into a deflationary period, as you're seeing this insane drawdown to M2 growth down to negative almost 2% is the lowest I've seen M2 growth on in the full data series that I can see on my computer. So I think if you start to see this deflationary period where you get a true collapse in the amount of lending and the amount of debt outstanding, I kind of see that as the only way to kind of bring the debt burden back to earth. But I just kind of wanted to raise this point and see if anybody else up here on the panel had any thoughts on the matter.
Yeah, if I could jump
to reduce one way to reduce that is through inflation. And you can think of inflation as kind of a partial default. And so,
Amy, jump in. Michael Strain, your mic is very glitchy. So Amy, jump in while Michael tries to fix the mic on his end. Amy? Yeah, jump in. Michael's mic. You want to jump in, Amy, or are you having mic issues as well? Okay, Michael? Michael Strain, you there?
Does this sound better?
No, it's cutting in and out. I'm not sure why. Yeah, I'll let you fix it. Amy, are you there? You're muted, bottom left corner. Amy? Or anyone else could jump in while Mike fixes his mic. I'm not sure what's happening, Amy. Go ahead, George.
Just one thing I'd add to the M2, it's definitely gone down, but I think it's important to get into the nuance because the recent decline that we've seen, I don't know if that's impacted the actual balance sheets of the average Joe and Jane, if you want to call them that, because I think most of that went into either money market funds or to treasuries. So it'd kind of be a wash as far as the asset side of their balance sheet. But what I'm most focused on right now is that credit extension by the banks, whether the metric you want to look at is loans and leases or something else, that has gone up significantly over the past, call it 6 months or so, maybe even a year. If that goes down, then we would assume that M2 would continue to go down, but in a way that would actually impact the asset side of we'll call it the consumer balance sheet. And in that environment, I just don't know how, assuming the supply side stays the same, we could get continued an acceleration of consumer prices unless you had a significant increase in velocity. And although that is possible, I think if we were seeing this environment, is rather low. That's all I'd add there.
Michael Kramer.
I think it was the right call to make. I think that over the last 15 years, the Fed has created a lot of moral hazard, pushed investors to force them to go out too far on the risk curve. I think that the Fed needs to regain control of the narrative and explain to the market how it's going to go about its approach. I think the market has gotten too used to the Fed consistently caving on it. And I think that ultimately speaking, we don't know what the fallout for SVB is, and it could very well turn out to be a nothing. I know a lot of people were predicting inflation was going to melt this year. That didn't happen. It's becoming a much more persistent problem than I think it was noted. And I think this SVB thing is likely to be overblown. It's not like the Lehman crisis. It's not like 2008, right? They don't have derivatives sitting on their books that we don't know what they're worth and being marked to zero. You don't have the contagion and counterparty risk that you had with many of these investment banks in 2008. For all we know, this could be a contained, isolated event because management didn't take the proper precautions with managing their books. I mean, all of this stuff has been in all of these banks, 10 Qs every quarter showing what their losses were on their books. I just went back and looked over the weekend. I mean, Bank of New York Mellon has similar types of write-downs that they were marking in the second quarter. So none of this really was a surprise. There was also, I mean, if you were reading some of the headlines, there were insiders taking lots of loans in the final 90 days. There was no risk officer for nearly 9 months. I mean, so I think there's just a lot of things going on there we just don't know all the facts on. And to assume that this is going to create some major credit crunch in the economy is really kind of, I think, too soon. And it may very well turn out to be that way, but you're certainly not really seeing that in the market. Yes, credit spreads have widened, but they are still well below where they were in October. Yes, we've seen, financial stocks get hammered, but why did they go up as dramatically as they did from October until January? There was really no basis for JP Morgan stock to rise 45%. So I mean, when you just think about some of these things, and then you think about the health of the economy, it has been very resilient. And, you want to talk about an R-star. I think the R-star is significantly higher than where the Fed thought it was. If the R-star was at a 0, let's say, you wouldn't have an economy still growing at an estimated 3.2% today with 500 basis points of rate hikes. And you can't even say this is all inflation anymore because, the inflation rate is starting to come down, although it's not really coming down in a consistent way that's going to be consistent with a 2% inflation rate. So I just think that the Fed did the right thing. I think that they don't know. They did the 25 basis point rate hike. They're going to hold their line. They've talked about their ability to want to hold rates there firm all year because that's what's going to be needed. They've made it very clear over the last year that they are going to keep rates high and elevate it for a year. And if financial instability came along, they would use their other tools, which they have. And, with $2.2 trillion going into the reverse repo facility every day, I mean, if banks were really starved for reserves and needed to really clear off their balance sheets, I would think that money would start finding other homes so that reserves could begin to rise again. But you're just not seeing that. So I don't believe all of this credit crunch stuff coming. And if I listen to Jay Powell correctly today, if there is no credit crunch coming, rates are going to go higher.
So, Michael, with Powell playing kind of a softer, more rosy, comparably tone, and Yellen coming out in front of the Senate and her hearing today with some alarming things around backing things up, was it just a good cop, bad cop routine. You talked about the Fed trying to really get a hold of the narrative. Is that part of it here, or is what are they trying to do here?
Well, I mean, I think it's crazy that the government's going to backstop $20 trillion in deposits from what the estimates I've heard are. Secondly, I mean, the only reason why the market even had that little brief rally today was when implied volatility melted at 235 like it does every single Fed meeting. So you got that 1.2% intraday move higher because you had IV on the S&P 500 for today's options expiration trading at 120%. And once that melted, the market took off for a little bit and then the news settled in. So maybe it was considered, maybe the timing was around the same time that Yellen was. But I mean, was the comments she's making really realistic at the end of the day? I mean, could we really expect the government to backstop every single deposit in this country? I mean, what's the point of having FDIC insurance set at $250,000 if there's no intent to actually use it?
And that's when all the liabilities move to the Fed's balance sheet.
It could be the case, but everyone knows that risk when they open the bank account. That's what, I don't understand. It's nice to say that we want to do these things, but at some point you just can't. And I think that's why we know when we open a bank account that you have a limit of $250,000. That's why not everyone puts their money in the savings account. They diversify it out across different instruments, right? I mean, I don't keep all my money in one bank account. I diversify it out over multiple places. Right? Isn't that what most people do when they think about it? Maybe you keep 300, 400, whatever. But I mean, do you really keep, all of your money in one place and hope that everything is going to work out okay? I would never think that way. I don't know.
All my money is with my 8 kids. So there you go. Michael Green. Well, you've been listening intently. Are you still there? Are you able to comment on a couple things here?
I have been listening intently. Sorry, guys. I've got 2 calls going on at once, so I'll come back in just a few minutes.
Thanks much. George, some thoughts there? You sort of chimed in briefly with a retort, but you want to expand on that?
Oh, I'm really this is probably a topic for.
So George, I'll ask you a question. I've seen that question a lot in the audience. What happens when another bank collapses and another? I know we're not expecting this. I know the sentiment has improved and the fears of a contagion have kind of eased by the looks of it. But if we do see other banks take a hit for one reason or another, more things breaking, what do you think the response will be?
The response from the central planners?
From the central planners and from the market in general.
Well, I think you'll see more of the same. You would see panic because it's something that's kind of unexpected. But I don't know that it is if people are paying attention to the discount window. But for most of the marketplace, I think there'd be panic. You'd see that yield curve really start to potentially steepen out, like we were talking about earlier with the 2-year going down. I think that, my goodness, the bid on the 4-week Treasury would be extreme. But then they would come back with another tool, another facility to try to patch things. And they'd probably be able to do that temporarily. But then the question is, what does that do to impact confidence long term? And if it doesn't bring confidence back up to a level where it would be in a free market, then you're just going to have this rolling cycle of crises until something breaks. So that would be the way I'd kind of look at it as far as a base case. But like I always say, there's no certainties. There are only probabilities. One thing I would like to add, though, I know I hear a lot of times people say that they've never gotten inflation down without having positive real rates. And I think they're just focusing on the 1970s. I think what I would do is also include the 1940s, where we did have yield curve control and rates at the long end, I believe, didn't get above 2.5%. But in 1947, the CPI was at 19%. And no more than a couple years later, it was -2. And so it is not true that the Fed funds has to go above the rate of CPI to bring it down. Now, you could say there are different circumstances there, and I think that's a valid argument. But I think that the main point is we can still have negative real rates on Fed funds, and see inflation come down significantly.
There's another question here about the bank term funding project. So that was that's the Fed response to the collapse of Silicon Valley Bank. It was earlier this month. How is that? No one's really talked about it. And the question here from the audience is, what are the consequences that you'll see from the bank term funding project? Is the program enough? Would that really help shore up confidence in the system again? It seems to have worked so far. Would love your thoughts, guys.
Yeah, I think
and then afterwards, D-Point, if you're still there, I've got a few questions for you on what you said earlier. I heard bits and pieces of it. I was on call, so I want to dig into it a bit later. But George, go ahead.
Yeah, sorry. My view on that is it's just the Fed being reactionary. It seems like they can never get ahead of a problem. The only thing they do is they wait until a problem occurs, and then they try to put some duct tape on it and then hope that nothing else happens. And if it does, they respond. So again, I think that this new facility, the bank term lending program, I think it is just some spit and duct tape. But I do think it will cause, or could cause, significant moral hazard from a standpoint of the banks now almost having like a call option, to where if rates go up, they kind of break even because they can get what they paid for the bond. But if rates go down, then they get a profit. So, I'm someone that believes that the whole mess that we're in right now is a result, not necessarily of QT or QE or this stuff, but really the central planners bailing out the system, going all the way back to the 1990s, and long-term capital management. I think that if they would have just let the free market work, if they would have let banks and businesses fail that should have gone under, I don't think we'd have Silicon Valley. I don't think we'd have Signature. And I think that we'd have a lot more confidence in the global monetary system. And I think that we'd be in a much better position.
But saying, like, if your narrative, if that was applied today and they let Silicon Valley Bank fail, so first, do you think they should have let Silicon Valley Bank fail?
Absolutely. I think they should have just let the free market work its magic. I know a lot of people in the libertarian space say, well, then you're only going to have 4 banks, and isn't that counterproductive if you want a quote unquote free market and competition? And I understand that short term, but I think that would make depositors wake up and understand that when you give your money to a bank, they're not just putting it in a vault. You're giving it to them to lend out or to do whatever they want to with it. You're lending it to a bank. And it's bizarre to me that most depositors, if you said you got $1 million and are you going to lend it to XYZ real estate project, they would do an incredible amount of due diligence to make sure that they got paid back and that there was good collateral there and it was a good project. But yet they don't even think twice by putting it into a bank just because some bank has good customer service. And so I think that the market, by letting people fail and the depositors, take a haircut, that they would realize that, hey, I need to pay more attention to the bank. And then I think the free market would start to come up with a variety of options, such as full reserve banks. And that would be a solution to the problem of all these deposits going to, 4 or 5 giant banks. I think you'd see a lot of competition spring up and get a lot more variety in the future if you just let Schumpeter's creative destruction take hold.
But if you do that in a system, in a fractional reserve banking system, not offering that level of support to banks as the FDIC does and as they did with Silicon Valley Bank, that jeopardizes the system in general, because a crisis of confidence, and that was kind of the narrative we saw when banks were failing during Credit Suisse and prior, a crisis of confidence is probably the biggest risk to the system. So if there isn't that level of support, it's an easy argument to make. You let capitalism do its thing. But I just don't think it's that simple. And I think the alternative could have been a lot worse.
Well, I think there's always costs and benefits to any system that you set up. I just think that although you would have problems, you would have bank failures, you would have depositors take haircuts, I think the banks would be far more prudent in their lending if there was no backstop. And, you look at the 1800s and you can say, well, there's a lot of ups and downs there. But, just imagine for a moment that there was no FDIC insurance and that people had the responsibility of actually being prudent when they lend their money to a banking institution. And the banks knew, probably more importantly, that if they made bad decisions, then they're getting wiped out. They're done. And I think that, there would be a lot more lending for productive means instead of consumption, and that you would have a lot more stability, I think, in the banking system. Although at the end of the day, we're imperfect human beings in an imperfect world, and you're by no means going to eliminate all the problems.
Yeah, I mean, so I'm sorry, just very quickly, George, I just think that's a libertarian fantasy. We had that world. It was called pre-1930s. And they didn't do the research. They didn't analyze the banks. We had bank failures over and over again without deposit insurance. The simple reality is most people can't do it. Wall Street analysts can't really do it. Somebody else pointed out the data was there. A few people called it. A few people at Dear Macro obviously wrote on it and identified these dynamics. And nobody cared because 3 weeks ago or 6 months ago or a year ago, Silicon Valley Bank was trading at $180 a share. Right? 3 weeks ago, it was trading over 100. Like, you can't actually realistically expect somebody depositing their weekly paycheck to stop and say, gosh, have I really looked at the tier one capital or the duration exposure of this bank? Like, that's just absurd.
No, but I think a lot more decisions would be based on reputation. And I think
by people who have the skill to do that, which is, 5% of the population at best.
Again, Mike,
that's just not realistic.
Well, I'm not going to sit here and say that there wouldn't be problems. And I understand that back in the 1800s, when you had free banking, there were a lot of failures and a lot of depositors, took a haircut and whatnot. I'm just saying, I think that on a cost, when you do a cost benefit analysis, I think on net, it would be a better system, although far from perfect. And I don't know. I agree that the average Joe and Jane isn't going to take the time or has the skill set to analyze a bank's balance sheet. But I think that they do have the ability to make good decisions based on other metrics. And again, I think reputation of that bank, how long it's been in business, and how many storms it's weathered. I'll give you an example, Mike. Back in 2012, I didn't have the ability to, I didn't even know what the Federal Reserve was. Let alone have the ability to manage a bank's balance sheet. But I had some options with different banks that I was going to use for the real estate business that I had. And one of the simple things I did is I just met with the VC of commercial lending at a local bank in Kansas City. And I just took the guy to dinner. And I asked him questions. And I looked in the eye, I shook his hand, and I asked him how their bank weathered the storm during the GFC. And he told me, and I believed what he said. And therefore, I started that banking relationship. And I'm still doing business with them today. And I'm quite confident that regardless of what happens with this current banking crisis, that they're still going to be around. And so I do think that there's other methods that, people have other than just having, your ability to assess a specific bank's balance sheet.
George, I just want to point out, you were wealthy enough to get the VP of lending at a bank to go out to dinner with you.
No.
That's absurd.
No, I wasn't wealthy enough. No, I just knew a guy that knew a guy, and he set up the meeting. And the guy he played basketball with this guy that happened to be the.
But I think the point, George, like, you can't expect everyone to have that opportunity.
Yeah, but I think we should expect people to have common sense. I have a lot more faith in the average Joe and Jane maybe than I should.
It's not a question of having faith in them. It's a question of they don't have that access. You just described a situation in which you had preferential access. Right? I mean, you're a privileged part of the system, and I'm not introducing woke concepts, but the reality is you knew somebody who was able to send you to dinner with somebody, and you believed him. Guess what Sam Bankman-Fried would have told you?
Yeah,
I mean, it's just not a realistic assessment. People can't be expected to do it. We've been through this, and it's also further ridiculous to go back and compare it to the 19th century, when it's important to understand that the vast majority of people in the United States were, some form of yeoman farmer who was doing their savings in the form of whiskey. Like, it's just not a realistic assessment.
Okay, so then I think, Mike, what we have to do is we have to look at the alternatives. So the alternative is you set up the current banking system with FDIC and you bail out everybody, and you just have these crises types of situations that get worse and worse and worse and worse until the global monetary system implodes. So again, on net balance, I don't know that that's better.
I just want to be really clear. I actually am not in favor of the bailing out of Silicon Valley Bank. I think it's completely ridiculous. And I think we actually had a system that was fully in place that said, if you have more than $250,000, you probably should have done some of the work that George did. I mean, that's pretty straightforward, isn't it?
But Silicon Valley would be an exception, Michael, considering that it's mainly startups that use it, and you can't expect startups.
There shouldn't be exceptions, Mario. There shouldn't be exceptions.
That's completely insane. I'm sorry. They have VCs recommending him to go there precisely because the VCs get preferential treatment in the same way that Congress people got preferential treatment from the Friends of Angela Mozilla and Countrywide Credit. Like, that's the actual sin here.
Yeah.
These were skilled, talented VCs who supposedly knew how to manage money, who are suddenly saying, oh, how could we have possibly known? That's just stupid. They should have lost their investment. They should have lost their equity investment in the companies. And yeah, people would have lost their jobs. And that sucks. And by the way, that is completely contrary to my interests as a resident of the Bay Area.
Yeah, Mike, I agree that everyone should have taken a haircut. You know, there should not have been any bailouts. And I think that there's a great argument for if we just had a system where everyone played by the rules as they are, then that would be superior. I just don't know the probabilities of, in the current environment with call them central planners we have, that it's realistic for them to play by the rules that have been set in motion, such as if you have a deposit that is not insured, you are not going to get a bailout. I think what you're talking about requires the politicians and the leadership to enforce the law and to let the chips fall where they may. And I just think that if once we start down that path, even with FDIC, it plants the seed in the politician's head that there needs to be bailouts, and it gradually gets you to this point where we are today, just based on human nature.
And George, it seems like you're saying like the bankie is not necessarily the problem. The idea is if you let these things fail, there isn't an SVB to begin with because bankers aren't instituting these sort of these motions because they're more risk averse and things travel more efficiently that way, and the risk is less attenuated.
Yeah, absolutely. And you have to, I mean, just going back to the original question with this new facility that was put up, what does this incentivize banks to do in the future? It incentivizes them to make the exact same mistakes that Silicon Valley Bank made. And you could say, well, now there's a program there to bail them out. Okay, well, what happens when there's some sort of situation that arises that we don't see? And then you just get a problem that's 10 times bigger than the one that we see today. I mean, it just creates so much moral hazard. I know Mike's not arguing for a bailout. I just think that, when you get on that path, that's always the end game. That's always where that path leads. That's where it concludes, is when you're just bailing out the whole system. And I think where we go from here, most likely, is where the Fed's balance sheet will bail out everything. When we see whatever's coming our way, whatever the yield curve is predicting, I think it's just going to, again, everything moves to the Fed's balance sheet, and that's where it gets pretty Orwellian. But I know that's not what this conversation is meant for.
Yeah, from the political perspective, you, as the old saying goes, you get more of what you subsidize. And if you subsidize failed bank accounts, you get more of them. Blake, your hand is raised. Tell us what your thoughts are.
Yeah, so I just, the original question was about the implications of the bank term funding program. And I kind of wanted to get, George's thoughts on, what the implications might be from an inflation perspective. So kind of the way that I'm seeing it is, if we're going to continue to see regional bank failures, you're likely going to see, more banks taking advantage of the BTFP. It's already been to the tune of whatever that was, 300 billion or so. But I see it as, banks would be crazy not to take advantage of this. You're swapping collateral at par for liquidity. And as George just mentioned, if you're going to continue to see the balance sheet of the Fed rising, or you're going to see the amount of securities that the Fed is taking custody of rise greater than, QT runoff, you're going to see obviously Fed assets rising, and you're injecting liquidity into the system is sort of like a de facto QE is almost the way I see it. Obviously not the same as QE, but I kind of see it as having a similar effect on the markets, which obviously monetary inflation, doesn't always equal consumer good inflation. And if it does, it has that, severe lagged effect. But I was just curious, George or anyone else, do you guys see that as a concern of, if there's going to be more regional bank failures or just more usage of the BTFP that could over time, drive higher inflation in the United States?
Yeah, I think there are a lot of variables, but I don't know that would, in my view, my base case would be that wouldn't significantly impact consumer price inflation. And the reason why is because I always go back to M2. So if I think about this QE that you referenced, meaning that the Fed is coming in and just giving bank reserves for treasuries, let's say, that doesn't impact M2 because that's just really a transaction between two banks, the Fed and whatever bank is coming to them for the handout, right? Now, if the Fed does quantitative easing by going into the marketplace and actually buying treasuries through the primary dealer, then that can impact M2 because if they're buying from a non-bank entity, then they're basically going to be trading dollars or M2 for those treasuries that they're purchasing. See, so I always go back whenever I'm trying to think through a specific transaction, I'll set up the balance sheets of the entities involved, and then I'll ask myself how that impacts M2 money supply or the number of currency units that are chasing goods and services. And if you look at that transaction, because it's just between two banks, in my view, it would not impact M2.
Michael Kramer.
Hi, so I just had a question or a point. With this new bank term facility, I mean, isn't it just on bonds that are prior to, I think, March 12th of this year, right? So I guess unless they change the terms of the facility at some point in the future, it really doesn't create any new sort of moral hazards, I guess, down the road. I mean, they would have to create a new facility, I guess. Am I correct?
I'm not sure of the specifics, but I think they're going to create whatever they need to create based on the crisis at hand. It just kind of sets a precedence, going back to my discussion with
I get that. It creates no, I get it. I wasn't sure if you were referencing a possible, in the future, or if you were just referring to this one. Okay.
Yeah, Michael, I'm not sure about those details.
Gordon?
Hey, yeah, I just wanted to state one thing. People keep blaming the management of SVB and Signature and Credit Suisse, and I think rightfully so. But here in the U.S., the Fed is the ultimate regulator of banks. And I know I said this before, but I can't stress it enough. The ultimate failure here was to regulate these banks by the Fed. So I do think it's clearly the guys at SVB who knew exactly what they were doing. They knew that they should be managing duration risk. That's banking 101. You learn that in elementary school. But also the Fed, Mary Daly in San Francisco, and a complete lack of oversight. In fact, she highlighted, her Fed highlighted issues with SVB a year ago, and they did nothing about it. That's also a big failure, and I think people should keep that in mind. Thank you.
Hey, this is David Towell. Regarding, bank failure, and to go back to the, Powell's points today, he explicitly said that there's more bank regulation coming, and he, without even knowing exactly what it is, I guess, fully supports it, he said. And that's kind of outside his domain, and it to me, I wonder what Yellen will say to that. In contrast to when he said in his remarks that all depositors' savings are safe, and then we heard Janet Yellen immediately contradict him. So I just want to know what the future looks like as an investor, whether all depositors' savings are in fact safe, and we're going to go ahead and insure deposits infinitely, and therefore massive banking regulation is going to come. Or no, in fact, not all depositors' banking savings are safe. Maybe from time to time, I guess selectively, depending on circumstances, we'll bail situations out, and the stringency of banking regulation is not going to get notched up that much higher. And I'd be curious if anyone has, a feeling on which way this is going to go.
I personally think that whether it's this crisis or the next one, the solution for depositors is just going to be to move that liability from the commercial bank's balance sheet to the Fed. And I know that's against the Federal Reserve Act, and just like everything else, I think they're going to ignore it. Does that happen in 6 months? I don't know, but I think that's the overall direction we are headed.
If we are headed in that direction, right, we could get a crisis at some point that will rival all crises before this, right? I mean, the risk quotient is multiplied considerably if that's the road we go down. Again, I'm okay with that. I just want to know if you agree that is the case.
I think it's definitely a probability worth considering when you look at the yield curve, and when you combine that with things such as the utilization at the discount window.
Well, and isn't that the entire thing is just the market volatility, because things are so unpredictable, and then you hear kind of the bad cop, good cop routine from the Feds here. Everyone's trying to put a shiny face on it or trying to knock it down. It just you look at the stock market right after the FOMC, and it was like a Richter scale reading on some spreadsheet. It was just up and down so quickly, people had no idea which way to look, which way was up and down. Is that the bigger risk here, or like we talked before, is this just the bet is made and we're going to go there?
I want to go back and as you all answer this question, I want to go back to a question I asked earlier in the space a few hours ago, just right after the FOMC. And I'll read out what ING Economics said. They said Fed hikes U.S. interest rates by 25 basis points, but acknowledges we are close to the peak. The Fed has raised the policy rate, but signals it may, quote, may only hike once more. So that everyone has highlighted that may. This is a little more dovish than anticipated, but the Fed is not expecting recent banking woes to significantly derail the economy. We are more cautious and fear tightening credit conditions, and that raises the chances of a hard landing for the economy. That's by ING Economics. So my question to the panel, especially anyone that hasn't answered it a few hours ago when we were covering this, in your opinion, was the FOMC more dovish or hawkish than you were expecting? Who wants to jump in on that first?
I'll
ahead,
give
Naeem.
my opinion again. I think the change in language just from those two words of, the past statement was they anticipate ongoing increases in the target range will be appropriate, to now today they change it to additional policy firming may be appropriate. That and then you saw that Powell during the press conference highlighted that again, like he emphasized that specific point that just the change in wording there is obviously more dovish, but then again what you saw today, and then I think it was a couple meetings ago where he sort of discussed how they view risk management, and we all remember how many times Powell has sort of driven the point that there's going to be pain in this process. And then I think he got a question from one of the reporters it was a couple meetings ago about, well, how much pain are you willing to accept before, you pivot? And then Powell hit back at that, or answered, basically driving the point again that they're more focused on, inflation being under control rather than, and then also making the point from a risk management view that they have the tools to sort of, if there's a crisis or a credit event that they have, or he believes they have the tools to address those. So back to other points we were talking about, they are Fed's reactionary. They're always behind the curve, but not to go on that. But in my opinion, the statement was dovish, and there were things in the press conference that were a bit hawkish. But I think Yellen sort of stole the limelight today with her comments, and that's why the market sold off.
Now, before going to Blake,
Yellen was definitely. Go ahead. Sorry.
No, Jay, go ahead. I'd love your thoughts, and then we'll go to Blake and Michael.
Sure. So I think it was Yellen predominantly, right? And it reflects on her saying that we don't expect to increase the FDIC guarantee immediately. It took a lot of people by surprise. And I think what she realized was that you don't want to half-ass it, and you're either doing, an unlimited guarantee or not. She doesn't have the authority to do that.
So well, hold on, Jay. You're saying it took everyone by surprise. So you expected them to increase the 250 from the 250K?
I expected them to increase it a little bit or announce something, right? Apparently, the market was surprised. Otherwise, the carry wouldn't be down 6% in 2 hours, less than 2 hours. So we really can't, in that scenario, we can't expect that Yellen's going to come to the rescue anymore, right? I think what you have to assume is that now it's going to Congress, and we all know how long it takes Congress to make a decision. Now, that is going to, in the short term, put some pressure on banks that do have deposit outflows. And, there's a graph that Nikki T from the Wall Street Journal put up. And I think it was an interesting graph that I'll post in a second. And the reason why it's interesting is it showed that 7 out of 15 Federal Reserve governors saw that risks to PCE were balanced. I'm not saying they're right. There's no reason to get anyone's panties in a knot because of that.
Can you quickly explain PCE?
Yeah, absolutely. Sure. So PCE is the inflation metric that the Fed looks at primarily versus CPI. And what that, what it means is that PCE is just a basket of goods, and the change in the price of goods are year over year. And there's a chart that I'll post in a second that shows, what Federal Reserve governors think about the risks to PCE being higher or lower than where they are now. And in December, you had almost everyone at the Fed saying that the risks to PCE are higher. And in this meeting, you'll see that I'm just copy and pasting, putting up this graph as we speak. But you'll see that only 7 of the 15 saw risks of PCE going higher from here. That's just what it is. It's just what they reported. So there's no way anyone can argue that. And I think that, was probably seen by some as showing uncertainty, and they may change it in the next meeting. But, that's one factor you can look at that was dovish. And the Yellen comments, I think, were frankly more hawkish than anything Powell said.
But Jay,
I agree with that statement.
Jay, isn't this reaction really because the market had priced in a 1% cut by the end of the year? And he basically said, we're not cutting this year. Like, they're going higher.
I think you can look at the dot plot, and the dot plot, kind of shows that. But I think he also said that the expectation in the dot plot was for rates to peak around 5.1%. And so he kind of cut on both sides. I think on one side he said we're not cutting, and on the other side he said we're getting close to the end, and he's going to defer to the data to tell him, what he's going to do going forward. So I think he thread the needle, and there's a graph right here up top. I think he thread the needle very, very well. And it was really just Yellen at the end that came and spooked the market.
Can I jump in here?
Please do.
Yeah. So, I mean, on prior Fed days,
Jay, I usually don't disagree with you strongly.
I think Michael, you can't hear Gordon. Gordon's speaking. I'll give you the mic right after Michael, but you can't hear Gordon speaking.
Okay.
Go ahead, Gordon. I'll go to Michael after. Go ahead, Gordon.
I'm going to hop down because I'd like to hear what he's saying.
Yeah, all good. And I'll bring you back up, Michael.
Yeah,
Go ahead, Gordon.
Yeah, no problem. So I just think that if you look at prior Fed meetings and how the stock market has reacted, it's been all over the place. So I agree with the comments that initially when the Fed, the Fed decision came out, the market went up, and then when Yellen came out, the market went down. But if you look at the Fed Watch tool on the CME Group website, and you look at expectations for a 25 basis point hike at the May 3rd meeting, as of yesterday, the odds of that were 59.8%. A week ago, 36.2%. Today, right now, as of 4:02 Central Time, the odds are 61.2%. So based on that tool, which I think is more accurate in determining the quote unquote smart money in the market's reaction to the Fed, this was a hawkish reaction. So I just wanted to highlight that, just FYI.
Michael?
And that graph is up top. Michael, please go ahead.
Yeah, I was just going to say the immediate reaction in twos and Fed futures and everything else was actually to rally. So I'm not sure where that analysis comes from.
That's right. And the graph above also shows that, the number of Fed governors that see PC as being a risk to the economy actually decreased from almost everyone down to 7.
Michael, jump in. Michael Kramer and Blake.
So
let me do this quickly before you jump in. I'll just read out the next part. I had it ready. Just a few more updates. Moody's says the baseline expectation is that regulators will broadly succeed in containing ripple effects from stress at individual banks. Looking ahead, the longer that financial conditions remain tight, the greater the risk that stresses spread beyond the banking sector. And before you jump in, Michael and Blake, just a quick question. The outflows from regional banks, is that still ongoing or has it eased in the last few days?
It has eased, but of course it's going to keep going, right? It's just the fact that the deposit beta exists where there's some banks that are paying almost nothing on deposits. And eventually you're going to see people watching the news and looking at their accounts and they're like, okay, well, why am I earning less than 1% when I can go to Treasury Direct and not have to pay taxes on my municipal taxes? So if you live in New York City, you don't have to pay your city and state, right? Why wouldn't I just go on Treasury Direct and earn close to 5%? So it's slowed from what I understand, but it's not over.
And maybe do you think those comments that we saw from Yellen could get that going stronger again like before? Do people worry more that the FDIC is not stepping up the minimum?
I don't know, to be honest.
Sorry, go ahead, Michael Kramer and Blake.
Hi. So just curious, I'm looking at the dot plot and all that here, and I am looking at it, and for the core PCE, in December, you had participants looking for rates below 3.5%. And on this one, now you have no participants looking for the rate below 3.5%. And when I look at the dot plot for the PCE for December, it looks like it shifted higher. So I'm not exactly sure where you're seeing that. And how would the median increase if almost half of the panel was looking for a lower PCE rate? So I'm not understanding that. And then I guess the second piece is that, the Fed, clearly the expectation in the marketplace was for the Fed to cut, to give an indication it was done in cutting rates. The Fed didn't do that. It wasn't in the statement. Powell reiterated in the press conference, noted that more rate hikes were coming and that cutting rates was not in their baseline. So, I mean, I don't know how you could really put a dovish tilt on that. It just seems to me that it was not what the market expected. And I think the front end of the curve's reaction with the dollar as well seems to suggest that the market is saying that the Fed is going to cause a recession here. Now, that can obviously change in a day or two. We also know there's a lot of positioning and short covering going on in the front of the curve with systematic flows. But that was sort of my take. And I was just a little confused about the core PCE and PCE numbers. It just seems to me like the Fed is expecting higher inflation this year and next year for core PCE.
Okay, I know you've mentioned trueflation as well. I think it was you that also mentioned trueflation.
Yeah, trueflation is an interesting website, and they have a basket that they monitor that it's freely available. And you can kind of track that. And I mean, this is nothing new. I mean, there's I don't know who took it down, but there's a graph up here that just showed what expectations are from Fed members. So it just is what it is. I mean, but it's a poll.
Have you seen the drop lately?
Yeah,
This is different than a poll.
But I'm looking at the actual press release from today, and I see that the PCE, you had some participants below the 3.13, and those all shifted, it looks to me, higher. I maybe I'm looking at the wrong thing. I don't know, but I was just curious to know where you had gotten that information from. So I appreciate that.
Sure. So I wouldn't look at the press release. I would look at, it's not a prediction of where PC is going to go. It is the FOMC participants' assessments of uncertainty and risks around their projections. So they're more uncertain about where PC is going to go. Before it was 100% assumed it was going higher. And now it looks like half of them are thinking it's going higher.
Okay, I'll look at it a little more closely. I'm not seeing that, but maybe I could be looking at something different than you.
Yeah. Okay, if you use sources like Trueflation, which isn't really a poll, and you see the drop that it had this month, and we're not even done the month. And this thing, I don't know how long you've been following it, but it's been pretty accurate for me for at least 6 months, like typically within, 0.5% to what the numbers come in at. Like, how do you typically use it? Is it useful for you? Do you agree it's typically pretty accurate? And
it hasn't been 100% accurate. No, I think they missed. They were right in October, November, December, and then they were wrong in January. So I wouldn't say that it's 100% accurate now.
So just very quickly, this is Mike Green. I just want to interject on that because I know the guys at Trueflation pretty well, follow their stuff really closely. And when Jay says that they're wrong, that's an implication that they're trying to match the BLS or predict the BLS. That's not what they're doing. They're taking the same categories and they're using an instantaneous methodology to track them under similar weights, but not identical weights. So they're effectively doing something much more like PCE, where it automatically adjusts to the underlying rate exposure, to the underlying basket exposure. And with that dynamic, they're just telling you what the numbers come out, right? It is a more accurate, in many ways, reflection of the actual prices that you experience on the purchasing basket. And as others have pointed out, it's decelerated rapidly. So it's not being used by the Fed. That's not what the Fed is paying attention to. I agree with one thing that Gordon said. It matters how the Fed reacts to information in terms of the price setting. But what we got today was a very clear assessment by the market that the Fed is just wrong. And it is really important to remember they are human beings operating off of data sets that they pay attention to. The fact that Jerome Powell continually cites job openings, despite the known issues associated with it, this is an indication of that, right? In the same way that Greenspan used to regularly cite railcar loadings. You get a data series, you rely on it, and you assume it's going to continue to work. And then afterwards, when it didn't work, you say, well, how could I possibly have known? It's just the way the world works.
You think that there could have been some seasonality adjustment that made Trueflation's data be different from the Fed's data?
Oh, absolutely. I mean, everything, remember what happened to the CPI in January, right? They changed the methodology. So the weightings methodology rebalancing was different than it's been historically, right? At the same time, you have significant seasonality adjustments. You've got model year changeovers. They changed the components associated with that. So all of that basically kicks in and suggests to you that, if anything, problem is with the CPI rather than a data set that, just tells you what the actual numbers are as compared to all the adjustments that are being made.
Correct. So the conclusion is that there's a deviation between truflation and the Fed's measures of inflation, and they're both going in the same direction for the fourth quarter. And then in January, there's a deviation, and it's probably due to some seasonality. There's no way to know that there won't be a deviation next month, but eventually, if truflation is right, things should be going down.
I just wanted to add that I did find that chart that you were referring to. It's on page 12 of the PDF file, and it does show that the number of people looking for risks to the PCE inflation as broadly balanced increasing, which was everyone had previously been noted as weighted to the upside. So I did find it. It's on page 12 if anyone wants to look at it.
A question for you, Michael. I know typically, there's always conversation about the Fed manipulating the numbers to help them make inflation look correct, lower than it is for the past decade. And I'm curious as to your thoughts on whether you think that's true or not true. Seems like you follow the methodology in Basket pretty closely.
So the claim that they're manipulating it is not true. They're making adjustments that they think are accurate. There's very clearly published reasons why they think that's the case, and there's very valid reasons why they're correct, right? But that does not mean that they don't get different answers, or that the experience that you as an individual have matches the information that they're receiving for a theoretical participant. So it's just, it's really important to understand that the reason that these tools exist is to facilitate policymaking and to set the price of Social Security and cost of living adjustments for the federal government. If they were actually manipulating, just stop and think about that for a second. That requires some mid-level puke somewhere in the BLS who's making $87,000 a year with their undergraduate degree or perhaps master's degree in economics to decide to conspire actively against the American public. It just doesn't make any sense.
Yeah, it's just, I think what most people have a hard time with is the fact that it doesn't feel like there's only a 2% inflation for X amount of time, right? When you look back 7 years, 8 years.
But right. So totally understand that. And in many ways, that's actually correct. Right, because the way the basket is constructed, it's effectively designed to be the George Gammon dynamic. If you were a really motivated shopper, if you really focused on buying the cheapest version and substituting chicken when it went below beef, or on deciding that you were going to not buy a brand new television and instead buy one on sale, right? Then your experience would look much more like it. But that's not most of our experiences, right? Most of us want to go buy a brand new car. Most of us want to go buy the best TV. And the simple reality is that in many situations, in an economy in which an increasing amount of wealth is being made by the top 1%, are not going to have that experience. And people in general were under consuming versus their desired levels. That's what the boom in consumption when we lifted the income constraint in COVID was. Because people suddenly saying, oh my gosh, now I get to do all these things. They wanted to do them, they just couldn't afford it. And that want shows up as, and things suck.
Yeah, I get that. Gordon, I'd love to hear your perspective because I know you have in your profile derivatives or weapons of mass destruction.
Sure. What's the question?
About a lot of people assuming that these CPI numbers are manipulated by the government to help them out and kind of adjust things the way they want.
Yeah, I couldn't agree with Mike Green more. You have a bunch of kids, I shouldn't say kids, but you have a bunch of government employees who are underpaid and looking to exit immediately at 4 o'clock to get to after hour. The idea that they're actively conspiring against the U.S. government is, for lack of a better word, ridiculous. I don't think that that's accurate at all. I think that the Fed attempts to get it right. And, I think whoever thinks that is just kind of, really getting into grave conspiracy theories. Thank you.
I appreciate it. So let's say the trueflation numbers do come out. Let's say the CPI matches the trueflation numbers, and we come out at 4%. What does the Fed do next? I'll go to Jay. And if anyone else wants to get in the conversation, just raise your hand and I'll call on you.
Oh, just please come back to me. I'm having a sandwich.
Michael, do you want to address that? What would the Fed do if it does come in at 4%? As it is right now on trueflation.
So first of all, understand that what you're seeing on trueflation is a year-over-year change. If you look at the quarterly change or the monthly change in trueflation, that's decelerating very rapidly across every aspect, including housing, which is where the key differential exists, because trueflation uses published rents and published housing prices to measure that, as compared to, data that is being heavily massaged and managed using the Fed's owner's equivalent rent component, which makes up about 40% of the CPI and about 60% of the core CPI metrics that we're seeing. So, if it were to come down to that level, if we were to see that reported, I think that would be perceived as very dovish and indicative that the Fed had achieved the mythical, hey, guess what? We hiked Fed funds above CPI rate and therefore it begins to fall. That's bullshit, of course, but it is what it is. And so I think it'd be very hard for people to ignore that. If you actually look at the trueflation data and the comparisons and what's developing in real time, it suggests that we'll be down into the 2s on their reports of inflation by June. And then it gets harder, right? Because inflation actually already slowed down dramatically. If we go to kind of the September time period, the compares start getting more difficult because you already saw the rates of inflation on a monthly and quarterly basis, barring obviously the January and February reacceleration that Gordon has highlighted. You saw it decelerate sharply. So, we'll see bounces in these data sets. The comparisons in year over years really matter. Do I expect that I'm going to walk back into the store and find that, the price of everything in the store has fallen back to pre-recessionary period or pre-inflationary levels? Well, of course not. Right? Like that's actually deflation, not disinflation. We've probably moved to a higher price level. That's part of the process of deglobalization, which I broadly disagree with. But again, think about the mechanics of how inflation occurs under excess demand or restricted supply. There's a cost curve, a supply curve at each level of cost. You've shifted outward the demand function. That means that the average cost is going to go up. That means that the companies that are closer to it, or if you've hit a restricted supply level, they can hike prices. And they're going to be as slow as they possibly can to reverse it, particularly with the lack of competition in today's heavily consolidated markets. So, is it an easy path? No. But I think Jay was alluding to this, and I would suggest it as well. There will be kind of a bouncing ball phenomenon where workers say, hey, I should get a 5% raise, and bosses will say, yeah, you probably should, but guess what? I'm going to fire some of your colleagues and give you a raise because you're a top performer. Right? And that will set wages higher, even as aggregate wages fall, creating deflationary conditions, creating real gains for those who remain employed, while those who have lost their jobs experience a significant degradation in their quality of life.
Breaking and Kraken is suspending ACH deposits and withdrawals.
There you go. Gosh, if we could only foresee that there would have been a regulatory crackdown on crypto, who could have possibly seen that?
Choke point.
Like that, if you want to talk about a conspiracy, by the way, that actually is something that I do believe. I don't believe that it is coincidental that the banks that were lined up
Silvergate, exactly,
were tied to crypto. They were breaking the law. Rather than go through the lengthy process of trying to prosecute it, just shut them down.
To protect the dollar?
No, I don't think it's about protecting the dollar. I
to
think
protect people from fraud.
Yeah.
But
every single one of these people were bad people. Just be really clear on that. They were not good people. I know that they were your standard bearers, but they were not good people.
You mean the crypto banks? Yeah, but crypto as a whole, from my experience in crypto, you have as much or even more fraud that use the dollar, right?
I'm not sure if that's me or if that's you, but you just.
I mean, in terms of the number of people, you're right. In terms of the concentration of people, I think you're wrong.
Yeah, as relative to the amount of users, Joa, you can't say crypto has less. I'm a crypto bull. Obviously, I've got my crypto punk and stuff, but you can't say there's less scam in crypto than traditional markets. This is factually not correct, at least not yet. Do you agree, Joa?
I don't know because there's a lot we don't hear. We only hear the really big ones.
No, but you can't. Not just logically though. There's not even the same amount of regulation for crypto. The ease of being able to mix money, mix different coins. It's a lot easier to scam in crypto. Plan a wallet. I'll get you off. But yeah, it's a lot easier to mix different cryptos than.
I agree with that 100%. Except you have a lot of fraud that happens in the normal monetary system. Of
Coinbase just got a Wells notice.
For what?
From the SEC, some irregularity. We'll find out.
That means they're under investigation.
For what exactly? Do we know?
Oh, that just happened, guys? Sorry, that just happened?
Both those things just happened.
Thank you.
The timing is epic.
No, it's not. The timing's not epic. The timing is planned. That's part of the point.
No, I mean the timing, considering that we're just talking about it now, it just came out now.
We're talking all the time. Come
on. Let me just get that. So, do you have more information yet on this?
Not yet.
Special?
But it's up top. No, not yet.
Cool. Jeez, you guys tweet shit so quickly. Oh no, that's Watcher Guru. SEC sends Coinbase Wells notice warning of potential federal securities violations. Woo! Crypto's just been hammered and hammered. Let's see how the markets are reacting. I do want to ask a question, like kind of a bit of a final question, and that's the comments made. I know it's a bit off the FOMC discussion, but it's something the audience is asking as well. The comments between Putin and Xi Jinping. Not sure if you know exactly what I'm referring to, but let me go on my profile. I've tweeted about it and read exactly what it says. Let's see where it's at. All right, there it is. So change. So that's President Xi Jinping tells Putin, change that hasn't happened in 100 years is coming, and we are driving this change together. I know we're seeing consolidated efforts by a few countries to challenge the U.S. dominance, and that includes the dominance of the U.S. dollar. From an economic perspective, because we covered this politically, we'll cover it again politically in our spaces, but from an economic perspective, does that mean anything to you guys? Do you guys look at it in any concern, or it's just useless political rhetoric?
So what's interesting is like when you put someone in a corner, like let's say we're all kids, right? I got bullied a lot as a kid for various reasons, right? Being the son of immigrants, being in a town that was 100.
From which country? Where are you from, Jay?
Parents are from New Delhi. I was born in New York, and just being son of immigrants, I was probably the only non-white person in my school. But it worked out in my favor later on, and made a lot of good friends. But as a kid, I'd get my shoes tied together, get punched in the face. When I was young, things were not as easy as they are now. And I think when you put someone in a corner, you don't know how they're going to react, right? So there's one day I was put in a corner on a bus, and there are 3 or 4 kids just wailing on me, right? And I just came out off the seat for the first time and just knocked a guy out right in the left eye socket. He didn't expect it. He didn't expect it. So when you put people in a corner, when you don't know how they are going to react. And you'll say, well, how does this relate to anything we're talking about now? And when you think about Xi is seeing the worst, economic outcome when it comes to the real estate market, which is a $60 trillion market. That's T for trillion in China. It's the biggest asset class on the planet. It's bigger than U.S. equities. It's bigger than bond market of several countries. And he has no choice but to become more insular and to get more control over the financial market, to regulate tech companies, to pull societal dividends from them, and to put a Band-Aid on all of the losses that the Chinese Agricultural Bank and all the other banks are going to be seeing, because their problems are 100 times worse than ours. And just like Putin, when you push someone to a corner and their economy is slowing down and they have negative demographics, Russia and China both have negative demographics, and they see the problems that that are inevitable, you put them in a corner, what happens? Russia invades. You put Xi in a corner, what does he do? He starts saying, whoa, US is bad. We can't steal chip technology from them. All of a sudden, Tencent AI is going to be behind ChatGPT. And all of a sudden, you're like, what is going on? Is he winning? He's saying all these things that are wild. And it's because he's losing. He's going to do more ridiculous stuff because he's in a corner.
Exactly. Like everybody wants to interpret Xi and Putin literally. They are behaving like Trump in the losing and waning days of his presidency.
Point, do you agree with that narrative?
Yeah, I do, but I also think,
and I'd love some. And how does that play much of a role in the decisions you guys make from an investment or trading perspective? Narratives like this.
Yeah, I avoid everything associated with that man. It saved me when I avoided every Russian stock, and the stock market froze over, and people still can't get their money out. And I believe that it's going to save me this time. There's a reason why Vanguard just left with their tail behind their legs. They left the country after spending years trying to build
JJ,
a
what's happening
market.
What's happening? I'll go to you right after. But a quick question: what's happening to the Russian economy? And I've seen a few reports that the impact of the sanctions wasn't as bad as, and on the ruble and the economy wasn't as bad as people expected. And the same applies to the impact
You
on the
had
European
oil
economy.
prices double. Where are oil prices today? The economy was down, regardless of whatever media people are reading. The economy was down like double digits, and will likely be worse this year than it was last year.
To your point?
yeah, I would agree with that, but I also think that China's kind of on its last leg, and it's trying everything that it can to kind of consolidate power, because like even within the regional kind of bifurcation that we're seeing, there's a lot of things that have to be kind of analyzed in terms of watching what Putin and Xi Jinping are doing, and even if you start to look at the context of what has recently happened as well with Iran and Saudi Arabia, which again I think is kind of a nothing burger. I don't think that relationship's ever going to really materialize, but China was becoming extremely more reliant, or wanting to become more reliant on Azerbaijan for their Belt Road Initiative, because they could just go across the Caspian Sea instead of going down through Iran and up. And now, the Azeris have taken, an opposite stance where they're anti-Iranians, and, not too favorable of the kingdom and strengthening ties with Israel. And so, I think that, even within that regional context, and then you look at another dominant superpower, Turkey, Erdogan losing kind of favorship after what's happened with the earthquake, and Kılıçdaroğlu kind of saying we want to start to establish Turkey's relations with the West relative to these Arab countries, kind of, as Erdogan has taken it. I think China's worried about losing some of these players within the region, because, you look at some of those countries that are extremely significant, and they're kind of moving away from this whole China and Russia initiative. So I think they're trying to consolidate as much power as quickly as they can. And that's why you see them trying to broker peace agreements between, the Iranians and the Saudis. But at the end of the day, I think that China's whole growth story is kind of long in the rearview mirror, and I think that Xi Jinping realizes that, and he's just trying to do whatever he can to save face.
Just remember, it's not in the U.S.'s interest to say, guess what, we're friends with India, right? Because everybody already assumes we are. So we don't make the announcements that say, look how well we're working with everybody else. Look at our incredible, capacity and capabilities that we've done. We carry a big stick and we act like assholes on the world stage on a fairly regular basis, but we don't need to brag about that stuff in the way that Russia and China do, because they're losing.
And what's your take on the Chinese economy, Michael? I know that Jay, Kim, and a few other panelists debated this a few days ago. It just seems there's a lot of cracks that are showing, but it's the economy still seems to be humming along, at least based on the numbers we're seeing. I'm not sure what we can trust.
I mean, I kind of fall into Jay's camp and would just highlight that, you know, I have been castigated for being bearish on the China reopening story. That certainly seems to have played out the way that I was anticipating it would. So, like, I just generally fall into the camp that says that they are a rapidly sinking ship, and they're going to do everything they possibly can to tell you something else.
Let me quickly jump in. So Coinbase, just about 10, 15 minutes ago, did put out a thread. So the CEO of Coinbase put out a thread on the Wells notice. So I'll read out what he said. I haven't read it yet. Let's just see what he says and see how serious this is. Today, Coinbase received a Wells notice from the SEC focused on staking and asset listings. A Wells notice typically precedes an enforcement action. 2 years ago, the SEC reviewed our business in detail and approved Coinbase to go public. Our S1 clearly explained our asset listing process and included 57 references to staking. Coinbase runs a rigorous asset review process and has rejected more than 90% of assets that have applied to be listed on the platform. While we understand that this is all part of the journey to reforming our financial system, we are right on the law, confident in the facts, and welcome the opportunity for Coinbase, quote, and brackets, and by extension, the broader crypto community, to get before a court. 4, we are proud to stand up for our customers and the industry in these moments. 5, going forward, the legal process will provide an open public forum before an unbiased body where we'll be able to make clear for all to see that the SEC simply has not been fair, reasonable, or even demonstrated a serious purpose when it comes to engagement, when it comes to its engagement on digital assets. Last point. 6, in the meantime, Coinbase will continue to do what we do best, build the most trusted products and services in order to advance our purpose of updating the financial system and creating more economic freedom. 7, we're excited to work with all governments and regulators around the world and are focused on putting in place rules and rates. So essentially the notice is for staking and asset listings. Does anyone have experiences with Wells notices? Can anyone give us, either in the audience, DM me if in the audience you can offer a bit more clarity on this, or anyone on the panel?
Sure.
What does that mean, and how serious is it?
It is serious, but what are you specifically looking for?
In terms of clarity, you mean, but with my question?
Well, I mean, what are you looking for? A definition? Are you looking at the implications?
Implications for Coinbase, and what could be the outcome? Like, what's the best case and worst case scenario from this, and what would you expect? Not sure how much you know about Coinbase, Jay.
Sure. I mean, staking has definitely been an issue that there's been a crackdown on, and private entities, not even Armstrong. I think he is the least. He's the most transparent of all of the guys being targeted here. But a Wells notice is essentially when regulators like the SEC, they reform either a company or an individual about an investigation. The investigation here is with respect to staking, and I think that from the SEC's perspective, you are looking at these are securities, and they don't want staking to happen. They view it as a form of leverage and getting around securities law. So I'm not an expert in this area, but I will say that the accused has 30 days to respond to a Wells notice. You oftentimes see it in investigations around fraud, et cetera, et cetera. That's not what this is. But if Coinbase
is down 8% after hours, now down 11.5%. Sorry, continue to update.
Sure. So when you respond to a Wells notice, the SEC essentially gives you a chance to explain why what they're investigating is not an issue. You have to write a legal brief. It is onerous to do so, but I think the SEC has kind of made up their mind on this. And after 30 days, you're going to see them clamp down on staking. That is my interpretation.
Okay, so bounced back up. So it's down 10%. Coinbase down 10% from the lows. I wanted Eugene to come up. Let me see if anyone from the audience can offer more clarity on that. Oh, Eugene, you came up. You're on a plane. How'd you come up, Eugene? Eugene, can you hear me? I don't think he's going to be able to speak. Yeah, I thought so. Eugene?
You can usually listen from a plane, but
Yeah, he can listen, but he accepted the speaker invite. So I'm like, maybe he's got Elon type, because Elon joined us from a plane and it worked. He's the only one that was able to join from a plane and
There's
speak.
only one Elon.
Yeah, true. Any other thoughts on this from anyone else on the panel? Super Bubble, I know you just came up. Before we move away from Coinbase and kind of start wrapping up the space. Super Bubble, you there?
Hey there. Can you hear me?
Hey. Yeah, so I'll bring you up. So it'll be good to get your thoughts. Not sure if you came up for the Brian Armstrong story.
I don't know about that. I've got a question from Mike Green, whose views I always find interesting. And I'm just wondering about the different banking crises in Europe and the United States. If they kind of show that the Fed and the European central banks are actually headed for very different destinations. Because if I look at the United States, it's like all about consolidating the banking system, making the big banks bigger, eventually at the expense of the currency, I guess. While if you look at the big banks in Europe, it's like Deutsche Bank, Credit Suisse, they've all been steadily shrinking for a few years. And as someone said to me, being made small enough to fail. So I'm wondering, does anyone see different destinations there in the different banking systems?
Hey, Mario, can I just do a quick update on the Coinbase thing? I can do it real quick.
Yeah, I was going to go to you, but I'll let Michael or Deerpoint just answer that quick question from Super Bubble, and then we'll go to you, Mikkel. Thanks for coming up, Mikkel. We'll go to you to get an update on the Coinbase situation. But go ahead, Michael or Deerpoint, just on Super Bubble's question.
Yeah, no, I actually think it's a really interesting point, and would broadly agree with that. The 2008 cycle, particularly in Germany, was very difficult for the small and local banks, as well as the state-sponsored Landesbanks. And what you were left with was a series of national champions, the Deutsche Banks, Credit Suisses, Bank Paribas, et cetera, who have outsized businesses relative to Europe proper, because they are the ready turn to for many forms of prime brokerage, many forms of derivative products, structured products, et cetera. It's a really interesting observation because they are overbanked in the complex or exotic product space, and significantly underbanked from the regional perspective. Richard Warner at Scientific Econ has written about this significantly if you step outside of Germany. So I do think that's an interesting observation. I would actually agree with it, that the problem is getting the European banks down to national size, whereas in the United States, we've actually just got a totally separate issue, which is basically duration exposure that was caused by rates being kept as low as they were for as long as they were, and from the dramatic increase in fiscal stimulus that led to an expansion of deposits. And I've pointed this out repeatedly. I put it into my Substack writings that anyone who does not understand that the minute deposits are created, that money is deployed and used to purchase assets, doesn't really understand banking, right? So everything that has happened in the U.S. is a function of the Fed rapidly hiking rates and hitting high quality liquid assets. Europe is much more a crisis of confidence in them as counterparties than anything else. Would be my takeaway. I'm open to Deerpoint disagreeing with me on that, though.
No, I don't necessarily disagree. I guess what I'm more worried about, at least in the European context, is kind of what we've seen with dollar funding costs. If you look at LIBOR minus OIS, and I know some people say, well, LIBOR no longer has volume, you should be using SOFR, but I'm not going to debate the semantics of that here, but if you kind of see what's happening with dollar funding costs and swings within offshore dollar funding costs, that is what I'm really worried about in terms of what happens with European banks. And money market funds, I think roughly of which in Europe 30% of are US dollar denominated. That's kind of where I get worried, because those money market funds, they essentially buy short-term paper from a lot of these banks, and therefore they kind of end up supplying these dollar funding for European banks in the terms of US dollars. And if you start to continue to see outflows just due to the fact that there's a lot of uncertainty around Europe. And I put something up actually on Deutsche. Somebody retweeted. I posted a tweet and they actually captured it and then retweeted it before I took it down. But that's up in the nest. If you look at, what's happening with Deutsche, what's happening with UBS, the Societe Generale, BNP Paribas, I do think that a lot of this is going to start to have spillover effects. And so that's kind of where I'm more worried is what ends up happening with these CoCos. 17 billion of that from Credit Suisse essentially wiped out. It's already a relatively small market. And the fact that a majority of those are all perpetuals as well is something that I think poses stresses to pension funds within Europe as well as the banking sector. So, I mean, those are kind of the two things that I'm worried about is dollar funding, which is extremely important to European banks, as well as what ends up happening with all of these the contingent convertibles or the CoCo market. And so I think for me, that's kind of front and center of how we have to go about, analyzing future ECB policy as well as future Fed policy, because, it's the fact of the world that, we essentially set monetary policy for the rest of the world, and that's, I think, as Michael, you've pointed out, partially because of Bretton Woods, but as well as because of, the Eurodollar system and how it operates. So, I think that those things are extremely important in kind of analyzing what's going to end up happening from the banking sector. But we've seen that risk continue to build. And, I don't think even the US banking sector or any banking sector in the world really ever kind of repaired itself after 2008. And how I kind of, I guess, conceptualize that is by looking at deviations within, covered interest rate parity and all of those things. That's kind of how I've gone through analyzing if we really fix the financial sector or if we just kind of postpone this to a later date. And now kind of the hens are coming home to roost.
Mike?
Hey, thanks, guys, and incredible insights as always. So I believe I joined late, but I heard some commentary about Russia. Just I don't know if this is useful, but the last couple of days we've had calls with investor relations from a number of Russian companies that unfortunately we had ADR investments in. Specifically, Yandex, digital housing company, the Russian equivalent of Zillow, a company called Sion, VK, and also Headhunter, which is their primary digital recruiting, online recruiting company. Anyway, just everyone kind of corroborated the following. So the Russian economy in 2022 was expected to be down close to 20% in real terms year over year. It wound up being down low single digits. Inflation was expected to be above 20%. Inflation ended the year. Now, obviously, this data could perhaps be unreliable, but all five companies corroborated that inflation ended about 9.5% year over year. And the companies themselves, and these are actually these are public filings you guys could see on their respective investor relations websites. They do have reporting requirements with the SEC, so they do put out 20Fs. Their businesses, these are digital technology companies. Their businesses actually grew quite well throughout 2022. I don't know if that's helpful, but the Russian economy does not seem to have been affected negatively to the extent that analysts expected.
Yeah, which is surprising. I do want to go to Michael just to get more updates on that Coinbase story. Michael, anything to add? Go ahead, Michael.
Go ahead on the Coinbase thing. I was just going to say on the Russian economy, like there is almost no way that could be true. Like it legitimately they've had to pay. They're receiving a below market price for their oil. Oil prices have collapsed. They're engaged in war. They're shipping stuff from Siberia, old tanks from Siberia. We're now seeing this. Like the idea that their economy only fell by 5% is somewhat absurd. Propaganda.
Right. Well, there are a number of Western investors. Persis was an investor in Headhunter, and we've been investors in Russian ADRs and ADSs and GSRs for quite many years. And unless their auditors are complicit with these lies, you can go on these
auditors just take what they get,
websites
right?
and pull off the 20Fs and see that revenue, for example, for Headhunter, which is a multi-billion-dollar revenue company, business was up 35% year over year throughout 2022. Unemployment in Russia.
Right? Auditors always take the data
I'm
that
just
they
giving you
receive.
objective data. I'm not saying it's not reliable. I'm just saying they do have audited financial statements on our websites, and I'm just telling you what the company investor relations have told me over the last few weeks. Take it for what it is. But in the case of Headhunter, they from their perspective, unemployment is 3.5% in Russia, and there is a oversupply of.
Yeah, no problem. So I've been watching this pretty closely, actually, and we actually got signs this was going to come as soon as the SEC kind of went after Kraken. Now, I have no idea where Coinbase is going to end up on the law here, but just to break it down real simple, Kraken kind of did violate securities violations because essentially Kraken was saying, hey, you can stake your crypto with us. We'll give you this percent. But they were doing more than just staking it. Essentially, they were lending it to on the back end. And because of that, it was kind of a product where people were giving them their money and they were generating a return, which kind of is a security. With Coinbase, they make the argument that they're staking the tokens directly on the network and they're just providing the users the network reward. So they're trying to differentiate their argument between, hey, anyone can stake their crypto. The SEC can't stop someone from doing that in a private wallet. We're just making it easier for them. So their argument here is that, hey, we're just using the network rewards and we're putting it right in people's wallet. Whether or not that argument's going to hold up, that's kind of the difference between what they're putting forward and what Kraken put forward. Kraken kind of had a mix of different products together generating yield. Coinbase is really just basing it off of the network rewards. And it's important to remember here, whether or not the SEC wants people to stake crypto, you can do it with a VPN. So it's going to be a very interesting kind of argument here, whether or not Coinbase facilitating the staking is creating the security, or whether or not that can't be counted as a security because the network is generating the rewards.
So enforcement is a difficult mechanism for them. Is the wells shot across the bow basically their way of trying to get something done, or what's going on there?
Well, they want control of the industry, right? I mean, the crypto industry is growing rapidly, and the more control they have over it, the more money they can get. Now, they started off going after tokens, and we saw that with the Ripple SEC case. We saw that with the Library versus SEC case, and the SEC really wanted to start out their pursuit to gain control of crypto by going after the individual tokens. Now, unfortunately for the SEC, they're running into a big issue here where the secondary tokens, or the tokens on the secondary market, it's really hard to call those a security because obviously me just transferring cryptocurrency between me and someone else on the secondary market, will say that should have been registered. It really just doesn't fall into a security. Now, it's a different argument based on when the company sells the token itself. That could be a security sales, but ultimately the SEC is having a hard time proving that the token itself is the security. So it's a lot easier for the SEC to go after these exchanges on the staking products and say, hey, these exchanges need to register, because by getting control of the exchanges and making them register, they kind of have control of a lot of crypto without having to win the harder argument of whether or not the token itself is the security.
What's the first one? If you've been following the court cases, obviously there's a slew of them going through the court system right now. Is this going to make it up to the Supreme Court, or what's the sort of canary in the coal mine that we should be aware of? These first ones here, the one against Justin Sun, the one against Coinbase, all these different efforts here, these are just starting up, but there's lots of stuff that's down the road, XRP and everything else. What should we look out as the next sort of, as I said, canary in the coal mine to make us concerned about something or other?
Well, the biggest thing by far, and this is what I really focus on personally, is the Ripple SEC case. And we should be expecting a decision in that case within the week. Now, we're hopeful in that decision the judge is going to make it clear whether or not the XRP token itself is a security or not. What it most likely looks like in that case, and this case is going to be monumental for the entire industry because it's the closest thing we have to determining whether or not these tokens are securities. What we're hoping is the judge is going to come out and say, hey, in the past, Ripple might have made some sales that could have been a securities violation. Now, that's a slap on the wrist, as long as she makes it clear that the token itself is not a security. If you're following this case closely, you would know the judge actually let sales and XRP holders into the case, claiming that XRP is not a security and they have XRP for reasons outside the company Ripple. Say they're building their own product on the XRP ledger, and you obviously need XRP to utilize the XRP ledger. People came forward and said, hey, we're using XRP as not an investment in Ripple, and the judge let these people into the case. So by doing this, it kind of implies that she does want to make a determination on the secondary sales. So people are hopeful that when this case is said and done, XRP on the secondary market will not be a security, and Ripple could get a slap on the wrist for some of their early sales. Now, obviously, it could end up any which way. It could go to trial. Most likely, it won't go to trial based on what lawyers are saying who follow this case closely, or certain issues could go to trial. But whether or not XRP is a security, which is going to be massive for the entire industry, we'll likely know within the next month. And a lot of lawyers are saying they're surprised we haven't seen the decision yet. So it could be any day now.
Well, meanwhile, the lawsuits come hard and heavy, and it looks like they're trying to slap the hands or curb down the crypto industry. But with their other hand, they're actually creating their own digital denominacy. What do you think is happening on that end? We've seen lots of things in the Federal Registry about this, but what do you think the U.S. government will actually back its own coin at some point, right?
Yeah, I think that's a tough one. And I see a lot of the stuff with the CBDC stuff and all that. I mean, ultimately, the way I really see innovation working, and I focused on technology before cryptocurrency. I was a cryptocurrency skeptic for forever, finally learned about the technology and really became fascinated with it. Ultimately, I see with most dominant technologies in the world, they are invented by the private sector. A lot of times governments will have some back end form of a technology for their own purposes. Ultimately, I don't pay much attention to it. I think what you really need to focus on are these public blockchains, these public networks that are gaining a lot of utility. Because at the end of the day, these are value protocols built into the internet, and the internet wouldn't have worked if it was private. There's a very important reason why these blockchains are public in nature. It's one of the most critical parts about what they are. So I'm sure all these different government agencies are going to have their own back-end settlement layers, their own back-end blockchains. For me personally, yes, those are going to add value to the entire ecosystem in a way. They might subtract value in a way. But to a certain point, I just don't think they're a massive thing to be paying attention to. They might try to shut down the public blockchains and promote their own centralized systems. I just have never seen that work in the past. It didn't work with the internet. I don't think it's much to be worried about going forward.
We've seen kind of that vaunted decoupling everyone wants to see between the market and BTC. We saw hints of that this week. Do you think that will ever take place, or do you think the roller coaster ride is something that BTC will just basically mirror the market?
Well, it's kind of funny because I actually think you had a lot more decoupling in the past. And I think what's kind of happening, and this is kind of probably against what a lot of the cryptocurrency enthusiasts wanted, is the more big money that gets into this space, the more these assets are going to be treated like what big money thinks those assets are. And big money sees a lot of these assets as speculative risk-on assets. So I think right now, until there's a significant change, that's how they're going to trade. Now, I also think right now we're analyzing things in a very unique perspective. I mean, I have never heard in my entire life investing so many people talking about the Federal Reserve, so many people tuning into every single interest rate meeting. So I think right now we really have macro lumping in together a lot of technologies and forcing them to trade together. How long that lasts, I'm not really sure. But until there's a significant change in the market, I kind of would expect most cryptocurrencies to trade on kind of what Wall Street thinks of them, which right now is risk on.
Let's go down to Mickey. Mickey Parks, what's going on?
Hey, folks. Nice to be up here. I wanted to reiterate some things and kind of give some color on some of the Russia comments. I have many years experience in Russia, lived in Russia, and had some exposure until 2014. Worked in Ukraine as well. And I want to reiterate some of the things that I heard. I think Mike made some excellent points, and it's what we're seeing as well. Not only are we seeing, signs of deep recession, we're seeing I can tell you story after story after story of entrepreneurs, business owners, that intellectual capital, that intellectual class leaving Russia at a rate probably Russia has never seen since probably like perestroika, that sort of period. And I think there's something to keep in mind about Russia, which I think hasn't been spoken about enough, and which is sort of related to this dollar milkshake thing everyone is talking about. This idea that what's sort of happening is like global macro, that this flight to the dollar, right? That countries are fleeing to the US dollar as a life raft for uncertain economic times, which leads to sort of this dollarization thing where some countries will inevitably need to print money in order to get access to the US dollar. Dollar strengths, and this is the dollar wrecking ball that macroeconomists talk about a lot. The one thing to think about this is what country doesn't get access to the dollar. If there is this dollar milkshake phenomenon, this wrecking ball where everyone flees the dollar and you see non-dollar currencies losing their value relative to the dollar, what happens to Russia is Russia really can only hold the currencies which are the empty life rafts, the life rafts with holes in it, that were printed in order to get access to the dollar. Of course, they have baskets of commodities, and there's a lot of talk about this supposed new currency, this BRICS currency, which I think most of us would probably dismiss. But I think that's the sort of nightmare scenario that Russia's facing. And we're just seeing, I think that the numbers, most of the numbers haven't been reported from Russia accurately for a few years, and I just want to reiterate things that Mike said. There's a lot of misinformation out there, but I can tell you from what we're seeing, it looks pretty bad.
Where are they going, Mickey?
Where's who going?
Well, these expatriates from Russia who are...
You see most of them going to Dubai. The people who are doing well are in Turkey, but I think Dubai is soaking up much of these people. There's sort of a new sort of trading triangle happening. Sort of Dubai is the center of it, I think, with Saudi. And you're seeing a lot of these entrepreneurs moving there. Really smart people, good people who had nothing to do with the war. People who are at ad tech or in commodities, likewise moving to the Middle East.
Yeah, it's a fascinating realm. I spent time in Serbia. I speak Polish and Russian, and to know the tech scene over there and the talent that goes with those folks who are so eager to be part of this great revolution. I guarantee you, they're all spinning up Chat GPT runoffs on what they can do here. That's the most interesting thing I think about this current financial predicament. Is it's also coinciding with perhaps one of the most revolutionary realms I've seen in the history of the internet age. So we'll see how that takes place, because I'm sure there'll be some great heads to grab as they make their way west.
I wanted to jump to let me go to Jason briefly, because I do want to wrap up the space. But Jason, I'm not sure if you spoke already, because I had to hop off for a quick call. Can you hear me?
Yes, I can hear you. Can you hear me okay?
Yeah, man. Yeah, give us a quick overview on crypto. We saw the Coinbase announcement. We saw crypto go up almost 29K, back below 28K. I think it's like down low to 27. I think 27,100 or something. I could be wrong.
Yeah.
Yeah, give us your thoughts. How's the sentiment? Where do you stand on the market? It was below 27K a bit earlier. Bitcoin is still a risk asset. It doesn't seem to be decoupling as a store of value. Unsurprisingly, it's going to take a long time, if ever, for that to happen. But let's hear it from you as a way to kind of wrap up the space.
Sure. Yeah, I think the same thing. It's still a risk asset. We were looking at bottoms coming in around that November period. So we're looking at the bottom being in for Bitcoin, and this move is out of the accumulation range. So any sort of pullback at this stage, probably to around 22 to 25,000, is still quite bullish. You need to have pullbacks. I'm sure most of us here can understand that. Markets don't go up in a straight line, unlike Bitcoin likes to teach us sometimes. So Bitcoin, we're seeing it as a bottom. A couple of comments I just heard from that last one there, just because we focus on the macro cycle as well. The US dollar is in a downtrend. US dollar will continue to go down over the long term as we run into the second stage of the cycle, which will probably also help cryptocurrencies, Bitcoin.
How's the US dollar in a downtrend? Are you sure? And what makes you say that? Is you see the reversal of the Fed?
Well, we saw the peak in September, which was something that we covered a lot, looking at just the hysteria that came in. So I think I heard just briefly there was the dollar milkshake theory. I remember looking at that years ago from, I think it was the guy Brent Johnson or Brett Johnson. That I think has played out. I don't see it going past 115 where it was at the peak in September. And we're basically in a bear market for the USD. We just had a rally. But if we break down from 102 again, that 100 to 102 on the Dixie, DXY, we're going to continue down at that point. So that's going to be good for the rest of the economy at this stage. As in, I just had one more thing on Russia. I've been traveling around Bali, Thailand, Dubai. Yeah, the Russians are moving out, but it's setting off some property booms in other areas. Bali's going absolutely nuts. Development's going crazy. Thailand's going crazy. This is all part of the macro cycle, which is why continue to come back to crypto and the stock market, because we're seeing people leave those places and these real estate markets go up. In terms of a recession, I mean, there could be a recession called or not. That's not the point. The stock market has likely bottomed in October of 2022. It's been a position that we've maintained for over 12 months now, looking at June as the first low, and then October didn't go that much lower. So I think we're probably different to a lot of people where we see the markets turning, and this is a transitional period into that next stage of the 18-year economic cycle where we're going to go up for another few years before we get a catastrophic collapse. So we've still got a few years left to go, which is going to be good for cryptos and Bitcoin as we get one of these final big 4-year cycle pumps, probably in next 2024, 2025 is where things will really start to heat up for it as we potentially pass some highs. And from that point, maybe we'll start to get that collapse after 2025 for crypto, but for real estate, stocks, we'll probably sort of peak somewhere around there, 2025, 2026. I think crypto will peak out earlier than the market. Maybe we'll get a second little pump there, but yeah, everything's looking up for us.
Cool. All right. Well, Jay, I'll give you the mic to kind of wrap up the space. Any final thoughts, what to look for in the next few weeks, next few days and weeks, especially relating to the contagion that we saw and we covered really heavily in the last week or so? Jay, you there? All right. Well, I think that's it. We've covered he's on, but could be glitching or he could be off on a call. But I think we've covered it really well. We've had great panelists. Thank you all for joining. We'll see you. Probably won't do another space today unless something comes up. Anyone that's watching out for the Trump indictment, it was delayed. It was meant to be today, I think, and it was delayed. Sources said that earlier today or late last night. I can't remember. So whenever that comes out, we'll be covering it. Otherwise, I'll see you on the next one. Thanks a lot, everyone, and thanks for all the speakers on the panel right now and on the panel earlier today. And Jason, thanks for coming on. I think it's your first time on stage, you and Mickey.